fear, as there is in other industries, that AI could take their jobs?
I mean, I don't think it'll happen anytime soon, and maybe never, because humans are such creative beings, right? We're always thinking of the, next unknown question, right? There's so many deep mysteries of the universe. There's so much we still need to understand. And AI is a tool. This will enable lab scientists to rule out a lot in simulation before they can go and do their experiments. So they only need to do a few. But then I feel like there'll be always things that'll be still unknown and to be conquered.
There's a lot of, I don't want to use an unpleasant word, but there are a lot of people who don't believe in things like climate change. And there are a lot of skeptics who believe that science is out to get them, or that, we're all just sitting here lying. Is there work being done that you think could actually win over some of these skeptics? Is there a way to demonstrably show them?
Yeah, I do think all the work we're doing will help towards this, because, this is not some model that's in some supercomputing facility, right? Not available to the public. I mean, you can download this and go try some of this yourself. Just like a video game, you can play the game of climate change one day, right?
Quantum physics.
So everything becomes accessible. At least my hope is, chunk of the community that is curious will have resources online that is much more open, so they feel like they can participate in that.
If you think about the scientific journey that humanity's been on over the last 300 years, it's been quite good. Just take us 10 years from now. Like, how different will things be?
I think the whole process of scientific research and development will be accelerated many, many times, right? Even orders of magnitude in some areas. And that'll just mean that we can quickly rule out things that don't work and hone in on things that work. Certainly, drugs designed by AI, they're already coming into trials, and that'll just increase fully. Personalized medicine for cancer and all of these, where we really haven't been able to understand, right, for various different targets, how to quickly design drugs. This can make it much faster and also cheaper, because right now so many of these treatments are too expensive to be done at scale. So it'll make this democratized and cheaper. And yeah, I think this will hit every area. I don't think any area is immune to this.
I think it will be interesting, won't it? 10 years time, if it takes the average drug 10 years to come to market, and if AI systems right now are coming up with some of the potential candidates for a future successful drug, then in 10 years' time, are we going to see a waterfall of new drugs?
I mean, it may not be a huge number, right? Because you can't test all of them. It'll be more targeted. It will be personalized. It will
actually work.
Exactly, effective.
Thanks so much for joining us.
Thank you.
Thank
it's been
you,
fascinating. Yeah. Thank you for taking the time.
Yeah.
Over the past decade, China has gone from a Silicon Valley copycat to a top contender in technology on the world stage.
Its ascent is peaking at a time when geopolitical tensions with the US and Europe are intensifying, and the rise of artificial intelligence has sparked a new arms race.
The US is rushing to curb China's influence in AI while balancing the need to regulate the powerful technology within its own borders.
How America manages these competing priorities will have implications for where the balance of power in tech will shift to next.
On this episode of AI IRL, we'll explore how China's playbook went from imitation to innovation and discuss what's at stake in the competition between these two superpowers.
Mustafa Suleiman, thanks so much for coming in. Now, you are the co-founder and CEO of Inflection AI and a venture partner at Greylock. Some people will know you as one of the co-founders of DeepMind, now owned by Google. Tell us, what made you want to start fresh with Inflection?
Well, now is really the moment. I mean, it was very clear to me during 2020, 2021 at Google when I was working on Lambda, the conversational AI that now powers Bard, that these large language models were truly going to be the future. And I wanted to start a company to build personal AIs, an intelligence that is completely aligned to your interests on your team and really functions as a personal assistant or a chief of staff, one that knows you intimately and over time can actually help you with practical tasks like scheduling, prioritizing, planning, and those kinds of things.
And that's what you're working with Pi.
Exactly, yeah. Pi stands for personal intelligence, and we see it as your personal assistant, essentially.
How do you feel about the concentration of power in technology right now among the big companies coming out with their own AI models? Microsoft, Google, Meta.
Well, I mean, I think you're right to point out that the big companies have the resources and the people and the compute infrastructure to be able to adapt and compete faster than ever, right? And that is a very impressive, reality of how technology works these days. It requires a huge amount of compute. And at my own company, Inflection, we've managed to raise a lot of money and build one of the largest supercomputers in the world. But on the flip side, the other trend that's taking place is that the open source movement is now almost at cutting edge. I mean, it's probably about 12 months behind the very largest models built at the big tech companies. And so that's kind of a contradictory trend. Like the big companies are getting bigger and better faster, but also everybody is now going to be able to get access to these same capabilities in open source.
Let's fast forward a little bit into the present day where the world order has changed since you first entered the tech industry. How did China go from being a copycat culture to a contender when it comes to digital innovation and specifically AI?
Yeah, I mean, China is more than a contender. I think in many respects, it's one of the leading players now. I mean, they've always been incredibly creative. And I think that we may have, sort of overstated the extent to which they were simply copying, what we were doing. And I think it's important to remain humble about the fact that, these ideas are going to be widely available to millions and millions of people. And, in many respects, all of our cultures are equally creative, and they've been able to take, tools and ideas that are available both in open source and the academic literature and move them forward, innovate at the cutting edge. They've produced a lot of very good papers, contributions to the academic conferences that have been peer reviewed. So, I just think overall it's better to take an approach of humility, acknowledging that, they're also going to be a really significant player in this field over the next few decades.
How would you rank the United States in terms of technological prowess in that world order?
Well, I mean, there's no question that we, in the US and in the West more generally, are currently in the lead. I mean, we have the very best, most innovative technology companies and technology hubs. Without doubt, Silicon Valley is leading the pack. And I think we'll continue to. I think we worry too much that we're going to sort of be dislodged from our podium position.
For how long do you think?
Well, I think the question is, what does it look like to be dislodged? And is that really the right framing in the first place? Like, what is the difference between first and third? And, people talk about there being a race for AI, and it's very unclear what that looks like to come second or third in that race. I think it's sort of the wrong metaphor.
Are we talking about superpowers, Clash of the Titans sort of stuff? It reminds me of back when the previous US administration banned companies from doing a lot of business with Huawei, and Huawei ended up basically having to get a lot better very quickly at making its own chip designs and all that kind of stuff. And it feels like it backfired a little bit.
Yeah, you've also advocated for the US restricting sales of some NVIDIA chips, which are crucial in training AI systems, to buyers who don't agree or who refuse to use them ethically and safely. So what do you think is the best way the US can actually flex its power? Is it through the technological innovation, or by stifling effectively some of its adversaries through regulation?
The first thing I should say about that is I don't think now is the time to do that. I mean, I think in theory, when the time comes, if the time comes for us to adopt a kind of global anti-proliferation strategy, we're worried about technologies being so powerful that we have to stop their spread. If that moment arises, and I think we're quite a long way from experiencing that, then technically that would be an appropriate containment strategy. Because much as this technology is manifested in software, it lives on the internet, it still sits on chips, whether you're training a model or serving a model. So in order to ask a model a query, you have to have access to one of those NVIDIA GPUs. And, for what it's worth, there are really only like one major company in the world that produces those high-end GPUs, NVIDIA, and they manufacture the vast majority of their chips at TSMC in Taiwan that use one single company, ASML, a Dutch company that manufactures the core chip that produces the chips, and they sit in the Netherlands. So it's actually a very narrow supply chain. And so I think the point I was sort of trying to make is that if you wanted to adopt a containment strategy, there is a supply chain where you can impose chokeholds on it.
And in 10 years from now, which country do you think will be leading the world in AI? Is it going to be the US? Will it be China? Will it be Europe?
It's going to be the US, I'm pretty sure of that. I mean, the fundamentals in the US innovation ecosystem are unquestionably the best in the world. I mean,
what could flip that balance of power?
Well, I mean, I think it's hard to say. I mean, I really do think that the US is in the strongest possible position. At the end of the day, it's talent that drives, this innovation. And talent still concentrates around a small number of physical places. Despite everything that we've experienced in the pandemic and people wanting to work remotely, it's still really important to be physically proximate to other people who, are working with you in the office. I mean, I think that trend isn't going to change. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities. But that is going to take 5 years or so. The export controls that the US has implemented, are real, and they really will prevent China from getting access to the next frontier of models, so the GPT-5 onwards. Right now, I don't really see how China could train those kinds of models.
Is there any downside, any unintended consequences that could come from this containment strategy the US is employing?
Yes, I think it is a very aggressive strategy. The counterattacks have already started, right? China restricted gallium, which is a raw material used in chip manufacturing. And I expect them to have their own reactions in time. We're very dependent on their supply chain. And so the idea that we could completely decouple, I think, is misguided.
I'm going to just put you on the spot really briefly and wonder, can you tell, because we're all friends here.
Sure, go for it.
Do you have a major regret about your work in AI? And do you also have a major single goal?
Yeah, my major single goal is to show that it is possible to create safe and ethical artificial intelligences which are accountable to humans. There is a possible trajectory where some groups may recklessly experiment with algorithms that can self-improve. And if in 10 to 15 or 20 years' time, those kinds of AIs are set loose on the open web in a reckless way, then I can imagine that possibly causing serious harm. And so for as long as I can remember, almost 15 years that I've been involved in AI, I've been trying to raise awareness and concern about the possible ways in which it can go wrong. And part of doing that is to show a bunch of practical ways that it can go right, both with writing my book and laying out a series of containment strategies and things that we have to do in politics to improve our governance and regulation, but also in actually building and making Pi, which I think is hopefully going to continue to remain a very safe and controllable personal AI that can work for you.
Mustafa, thanks so much for coming in. Been a pleasure.
Thanks very much for having me. It's been great.
Helen Toner, thank you so much for joining us. You're a director at Georgetown Center for Security and Emerging Technology, and you're also an OpenAI board member. Dan Wang, thank you so much for joining us. You're a visiting scholar at the Tsai China Center at Yale Law School, and you've been studying technology and China for many years now.
And we've just heard from Mustafa Suleyman, and he thinks that China's emerged as one of the biggest contenders in AI. So Helen, I'm just curious to start with, do you think we're overestimating China's capabilities?
It's certainly true that they're a big player. And it's also true that we shouldn't underestimate them and that we have a bit of a history of underestimating China's ability to innovate. I mean, I think 10, 15 years ago, the story, at least in Washington, D.C., where I'm based, was, yeah, China can't innovate. If they're producing things that look like new technology, it's because they've stolen them. I think that's clearly no longer true. At the same time, I think it's also very possible to overestimate them. And sometimes I think I see that as well. So are they a serious competitor? Yes. Are they eating our lunch? No.
So that copycat culture, it's fair to say that most people are thinking we're past that stage. Dan, what do you think of that?
Well, I think it's certainly the case that China focuses on different things. So President Xi Jinping is, I think, a little bit less enamored with the internet platforms, with a lot of the cryptocurrencies, with a lot of the AI businesses that Silicon Valley specializes. He's also a little bit less enamored of Wall Street and financialization and hedge funds. And if I had to think about what Xi's broad views are, it would be much closer to being something like capitalism with German characteristics, which is much more about building cars, building hydraulic pumps, building heavy machinery, the heavier the better, about all sorts of these major industrial projects. And I think China is very much a leader in things that include electric vehicle batteries now, solar photovoltaics. It is making a lot of electronics products, and it is innovating on a huge sort of a lot of the automotive supply chain. But I think they have a little bit less of a focus on AI, and therefore there is not so much political direction anymore to really push forward these consumer applications.
I think it's fair, though, that some of those areas, the US is also innovating very, very strongly. So are there any areas where China is innovating significantly better than the US?
Well, I would say something like electric vehicle batteries, where China has something like the 70% of all global expansion, all global capacity of electric vehicle batteries is now mostly in China. When it comes to the clean technology supply chain, again, these very industrial projects, these pieces of heavy machinery, that is a little bit more the focus. I think the U.S. is really strong in things that include semiconductors, artificial intelligence, biotechnology. These are things, the smaller things, where China is not so good, but there are big areas in which China is way outbuilding the U.S.
I mean, the semiconductors is getting significantly better in China. I mean, partly maybe as a result of the Huawei issue. Helen, what's your view on the semiconductor side of this?
So China's definitely been investing for decades in trying to have their own independent semiconductor supply chain, and they've been making some progress. The thing to know about semiconductors is there's a huge range of sophistication, from the really basic semiconductors, computer chips that go in basic devices, your smart fridge, your car, up to the kind of more advanced chips that might go in a brand new iPhone, up to very advanced chips that go in kind of the data centers, gigantic warehouses full of computing, which is what you're training advanced AI systems on. So China has made a lot of progress on the more basic end of the semiconductor sort of scale, and is still really struggling to hit the most advanced end. And that's where, it's not even, you can't even say the US is, alone able to create those advanced semiconductors, but what you have is an incredibly advanced global supply chain.
Many describe artificial intelligence and its development across these two superpowers as an arms race. Is that framework misguided, do you think?
I think it's a bit misguided. I think you really want to look at what kind of AI are we talking about, and in what way might it be a race. I think the place where it's clearest that it makes sense to think in a competitive framework is in kind of military domains. So, it's just true that the US military really wants to make sure that it is keeping pace with, and ideally a little ahead of, the Chinese, or a lot ahead of the Chinese military in terms of what technology they have.
Dan, Washington has taken some steps to curtail some of China's ability to get their hands on the cutting edge chips that really power these AI platforms. What's your take on that? Is that an effective strategy, or will China just find a way to build their own?
I think that China is going to try to figure out a lot of the way to build their own. A lot of the chip makers now have been under very significant stress from U.S. sanctions dating back to about a year ago now, released by the Biden administration, that is really stopping their ability to access not just the high-end chips, but also the semiconductor production equipment as well.
And I think in general, it's really difficult to distinguish between what kinds of technologies should the U.S. really not want China to be able to develop, and where is it fine. So, you mentioned, clean technologies before, where China, if you're looking at, manufacturing solar panels, as you mentioned, EV batteries, a lot of other areas, China is doing amazingly at that. And what you're starting to hear in some, U.S. policymaking circles is that maybe that's a bad thing, that China is making a lot of kind of clean technology stuff. And I find that a little sort of tricky to reckon with, is at what point do we want to really shut them out or prevent them from being, able to manufacture anything if it's something good, useful that we can use. Of course, if it's technologies that we think have really significant military value, I understand, but then it starts, the lines between those categories start to get very, very blurred.
It seems like these tensions are just ratcheting it up even higher as time goes on. With each administration, they're intensifying. So to your point, if we do need these other technologies, solar technology for this transition into a greener future, what kind of happens next? How much do we place on kind of the AI arms race that could then potentially work against us in climate change? Is that a concern, or is that too far in the future still?
Well, a few months ago, Beijing did announce some export controls on certain solar technologies involved in making production wafers.
So it's already happening.
It is already happening, that there are some threats out there that, relatively speaking, Beijing has been pretty restrained against retaliating against American companies of the likes of Intel, of the likes of Tesla so far, but these things could escalate more.
how does the relationship between, the ruling party in China play out against the kind of the development of companies?
I think the Chinese system is definitely more top-down when it comes to AI development. You see less kind of individual tech companies like OpenAI or Google taking the lead, and more these kind of multi-institution partnerships, or maybe you have a university and a tech company and a government, department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we in the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is almost, it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, or that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's not the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China. in terms of what you're saying?
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to, opt in to different uses. Of course, in China, there's always the exception, unless the security services, think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology, really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
This is Horizons Middle East and Africa, our top stories this morning. A widening war. The Houthis attacked 2 Saudi tankers in the Red Sea as the U.S. conducts further strikes on Iran. Oil rising as the market reckons with the possibility of a second front in the Middle East. And the nuclear path. The U.S. signs an agreement with Saudi Arabia to share nuclear technology, opening the door for the country to enrich its own reactor fuel. and burning the cash. Alphabet shares fall after another boost to its spending forecast. Meanwhile, Elon Musk warns of a massive capex year at Tesla as the AI race heats up. I'm Oliver Crook, live today in Brussels. It is 8 a.m. across the Emirates. It is 6 a.m. here in Brussels. Let's take it straight to the markets this morning with a full focus on, obviously, the fossil fuel trade. Brent this morning up above $96 a barrel. You can see there on the screen up about $2 a barrel, up 2.2% this morning. We're watching the euro very closely this morning because we have that all-important decision from the European Central Bank in Frankfurt a little bit later today. You can see the euro gaining a little bit there against the dollar, up 0.15% in full focus. We're not expecting a rate hike from the ECB after that hike last meeting, but the future path very much in focus in terms of what we'll see in inflation across the European continent. Of course, MSCI Asia Pacific Index up about 1% this morning. The chips and semiconductors gaining after we saw that big capex spend from the United States. And of course, you see the other side of that trade, NASDAQ futures there on your screen, down by about 1/3%. Let's keep it on the markets. Let's take it to Hong Kong with Winnie Su, who's got an update for us this morning. Good morning, Winnie.
Yeah, good morning, Ollie. Well, we are seeing a pretty positive session in Asia today with the MSCI Asia rising for a third session. As you just mentioned, technology shares really leading gains today after Alphabet say that they are raising their spending expectation to top $200 billion for this year. Now, that is really fueling the expectation for that money to trickle down to the supply chain in Asia. That's why you are seeing South Korea's Kospi Index here up more than 3%. With foreign investors continue to buy, and that foreign inflow is also driving the won higher. As you flip the board and see how the Korean won today leading gains among Asia peers, we are seeing a strengthening by 0.7% against the US dollar. Now, when it comes to Japanese yen, still hovering above that 163 level against the dollar, still around those weakest level in 4 decades. Now, yesterday we have heard that the Bank of Japan is open to raising rates faster than consensus, and that kind of bet, the hawkish bet for the Bank of Japan to raise rates, is also driving the 2-year yield here higher, and that is why we are seeing the yield curve also steepening, while the 10-year yield still also slightly higher, tracking those moves from the treasuries overnight. Back to you, Ollie.
Thanks very much, Winnie Su, over there in Hong Kong, keeping us abreast of all the market action over in Asia. I want to keep you abreast of some of the earnings stories out of the Emirates this morning. Emirates NBD, the second quarter operating income coming in at 13.5 billion dirhams. That is very close to the estimate of 13.31 billion dirhams. The net income figure for the second quarter there for Emirates NBD at 6.4 billion dirhams, and a net impairment there. Maybe we'll keep an eye on that of about 600 million dirhams in the second quarter, bringing it to the First Abu Dhabi Bank as well, FAB, second quarter operating income at 10.17 billion dirhams for the second quarter. That is a beat, a very modest beat there of the estimate of 9.7 billion. And of course, we're watching, of course, profit there at 5.7 billion, beating the estimate of 4.48. So we'll keep you abreast of those stories as they develop through the morning as the trade gets started over in the Emirates. But from the sort of earnings story to the geopolitics, which are front and center this morning, Yemen's Houthis say they have attacked 2 oil tankers in the Red Sea, threatening to open another front in the Iran war. Minutes before the Houthi statement, the UK Maritime Trade Operations Center signaled a report that a ship had been struck southwest of the Al Shukaik on the Saudi Red Sea coast. Saudi Arabia did not immediately comment on the attack. Meanwhile, as the U.S. completed a 12th straight night of attacks on Iran, President Trump out on social media posting that anytime the Islamic Republic of Iran shoots at a ship in the Strait of Hormuz, the United States will bomb and destroy one bridge or power plant, including those located next to or in the capital city of Tehran. Let's get more on this story with Oner Ant. He's Bloomberg's managing editor for the Middle East, North Africa, and joins us now from Dubai. So listen, now we're trying to reckon with, we've had a sort of some idea of how to price the Strait of Hormuz, the sort of disruptions from there. There is now a conversation within the markets of how to price a possible second front in the Red Sea. Are the markets able to do that? What is the reach of the Houthis at this stage?
Well, the overnight attack on shipping by Houthis marks the first time they struck an oil tanker after they announced that they would be imposing a blockade on any ship calling for Saudi ports in the Red Sea, Oliver. And as you said, that's critical information because after the war on Iran began and after the effective closure of Hormuz, the Red Sea coast is where the Saudis redirected a bulk of their oil exports, and they became so reliant on the area that loadings at Yanbu alone exceeded 4 million barrels a day in June, and that was the highest on record. So any successful attempt by the Houthis to prevent that export route being used by the Saudis will have a huge impact, not only on Saudi oil exports alone, but for the oil market in general, as it would risk removing a key part of Saudi crudes reaching the markets. And important to note, as you already mentioned, is the fact that this attack came literally hours after President Trump made an explicit warning calling on Iran to stop attacks on shipping through Hormuz, which is the other key choke point for oil trades out of the region. He did say that every time a ship comes under attack in Hormuz, there will be a plant or a bridge in Iran that will be bombed by the U.S.
Well, Owner, at the very center of the war in Iran is this conversation about enriching uranium. And I want to take you to another story with the United States and Saudi Arabia, who have now finalized a nuclear technology sharing deal, which could see American companies building reactors in the kingdom, but also the kingdom enriching its own uranium. We also heard from the U.S. Secretary of State Marco Rubio a short moment ago. Have a listen to that.
Well, I'm not going to opine directly on that agreement. We're going to put out even when the moment is appropriate, we'll put out that in writing. We have to do it with Congress anyways, so we'll certainly do it publicly. But suffice it to say, the U.S. is not going to reach any agreement with any country in the world that leads to the risk of proliferation.
So, Owner, give us a bit of the details of this agreement and give us some of the context around this at a moment where enrichment of uranium and this nuclear material is such a focus in the region.
Well, this deal was long in the making, but the actual signing paved the way for criticism that you just pointed out. According to the Wall Street Journal earlier this week, this deal would allow American companies and Saudi companies to conduct a joint study into whether or not domestic enrichment of uranium in Saudi Arabia would be feasible or justified. Now, that is especially important given the fact that the primary justification for the recent war on Iran was basically the fact that it would prevent Iran from acquiring nuclear weapons. Now, what critics say, including U.S. senators, is that if the deal actually allows Saudi Arabia to enrich uranium on its soil, it could pave the way, or it could spur a race for domestic enrichment in the larger Middle East region and eventually an arms race. U.S. Secretary of Energy Chris Wright said that the deal includes highest standards for nuclear security and high standards for non-proliferation. But nonetheless, what critics argue is that allowing the kingdom to enrich uranium domestically would eventually spur a race for similar deals with the U.S. Down the road, Oliver.
Well, Onuran, thank you so much. Bloomberg's managing editor for the Middle East and North Africa for the important update on those two stories. I want to take us to another important update on the other story that is occupying markets this morning, and that is, of course, the AI race. Alphabet is doubling down on the AI race, lifting its spending outlook as it rushes to build out data centers, and the company reported stronger than expected cloud growth for the last quarter, but the higher price tag is likely to intensify scrutiny of its AI returns. Let's bring in Bloomberg senior market strategist Neil Campling. Listen, we've got the numbers out from Alphabet this morning. Obviously, the CapEx is the sort of attention grabber, now breaking above that $200 billion mark. How significant is that? What were your other takeaways from the numbers from Alphabet?
Yeah, firstly, we look at the key in terms of those revenue growth drivers. As you mentioned, cloud growth was incredibly strong. Cloud grew 82% year on year from a very large base. It's an acceleration from the previous quarter. That was against expectations from the street of 65% and against even the most bullish buy-side experts of 75%. The problem is, as you mentioned, is that the race for AI means that the CapEx is exploding higher and shows no signs of slowing. They've already said that 200 billion is likely to be significantly higher still in 2027. The problem they have is this is like a cash machine, an ATM in terms of the business for the last 10 years or so, printing so much money in terms of cash. And for the first time, we've now got a free cash flow negative quarter. So that high growth is also coming with high expenses. And the big issue here going forward is what happens in terms of returns on invested capital. The race for the frontier AI model leadership, of which Alphabet is one of the key players, there's no guarantee in the future as to which companies will win out. So for the time being, that CapEx spend, especially having come above huge amounts of money raised in the debt markets, is a question investors will be weighing up to offset against the growth questions.
Yeah, Neil, and it's a question investors will also be weighing up over at Tesla. We heard from the CEO of Tesla, Elon Musk, speaking about their earnings. Obviously, this is a car company. It's kind of also not a car company. Have a listen to what Elon Musk had to say.
We should be spending on CapEx as fast as we can spend, as fast as we can, without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time.
So Neil, the takeaway there, we need to spend money as fast as possible, and we don't need to do it in the most possible efficient way. What are investors to make of this? Is there still sort of the charm of the Elon Musk factor? What do you take away from that?
I mean, on simple terms, the auto business actually had a really good quarter. The problem is, in terms of if you look at earnings and margins, and as you mentioned, the cash spend, they raise more questions. And the money that they're spending is on things like the robots and the robotaxis and the autonomous vehicles, which really are very small in terms of the overall business. So in terms of the race to spend the money, but there's no discernible sign that there's going to be any kind of growth increase or any kind of returns on that CapEx spend. So fiscal discipline is not something that really comes across in terms of what Musk was saying last night. So it raises more questions than answers, I think, for Tesla in particular, when they are actually so far behind the AI race compared to companies like Alphabet.
Yeah, well, thank you very much for Bloomberg Senior Strategist Neil Campling there, keeping us across the AI story and, of course, the all-important CapEx story we're really seeing moving markets this morning. But still ahead, we're going to be talking about the fixed income market and unpack how the latest shocks caused by the Iran war is delaying a global easing cycle by keeping inflation elevated. This is a conversation we'll be hearing later again at the ECB. It's a conversation at the Fed, and it's certainly a conversation across the Middle East. We'll have much more on that next, and this is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Well, oil prices are climbing this morning after Iran-backed Houthi militants said they targeted 2 Saudi Arabian tankers in the Red Sea. The escalating Middle East conflict now threatening to cause further supply disruptions and, of course, opening up potentially a second front to that war. For some analysis on what it means for the broader markets, we're joined now by Amol Shitole. He is head of fixed income at Mashreq Capital. Amol, thank you so much for joining us this morning. I'd like to just get your very sort of top-line view here. We've had a sort of lesson over the last couple of months of how to price disruption over the Strait of Hormuz. What lessons do we need to learn about pricing disruption in the Red Sea?
Morning, Oliver. Good to hear. Clearly, I mean, the volatility in the regional bond market has picked up, especially since 9th of July. And we see that continuing through the summer. As you pointed out, oil prices are up $96 per barrel. That's about 55% higher than the pre-war levels. I think one thing to note here is that most of the Gulf economies have fiscal break-even oil prices anywhere between $40 to $90 per barrel. That makes them, fiscal surplus category, right? And I think the one economy which really, falls out of this bracket is Bahrain, which is a different story, which is likely to be a structural issuer of bonds. But barring that economy, I think most other economies benefit from higher oil prices in the interim.
And thinking about what the effect is going to be on the sort of various rates of the nations that you cover, how do you see that filtering through the region?
Clearly, I mean, Gulf economies have pegged currencies to US dollar. They don't have their own monetary policy. They rely on Fed policies to really mirror when they price in local rates. Having said that, some of the oil importing economies like Egypt, they really suffer because of higher oil prices. And the reason being they are one of the largest oil importers in the region. Their interest rates are at 19%. It tends to delay their easing cycle given inflationary pressures and FX pressures. So I think some of these economies are going to have a delayed easing cycle given the backdrop.
Well, thinking about the Fed, since you bring it up, what are you expecting as we look into next week? I mean, I thought that we were pretty confident that there would be basically no move at the Federal Reserve. I now look at the market pricing. We're seeing about a 35% chance potentially of a rate hike. Why do you think we're seeing that within the market? Is this a communication situation over at the Fed? What are your expectations for the Fed looking into the back half of the year?
It's a great question, Oliver. Yeah, I mean, we are expecting Fed to be on hold on 29th of July. If you remember at the beginning of the year, markets were pricing 2 rate cuts, and at some point during this quarter, we are looking at 1 rate hike. I think market is correct in anticipating a hold during this meeting, and the reason being we haven't really seen pass-through of oil price shock into core inflation yet. If anything, both headline and core inflations were softer in the US if you look at the last print. So I think until we have evidence to see that inflation is actually passing through into service sector of the economy, there's no reason for a Fed to actually raise rates at this point in time. And also, you got to consider the growth outlook for the US. I think we are rolling off from supportive growth to slower growth at some point later this year. So I think if you put it all together, I think hold makes more sense. And I think market is accurate in pricing that at this point in time.
And I want to talk to you about the broader conversation globally around inflation. So obviously we've had a focus on the Strait of Hormuz, and that has been principally a focus and a concern with energy prices. However, a disruption in the Red Sea, for example, will affect other shipping and other goods and other commodities. We're also seeing within Ukraine and Russia more targeting of ships there that is having a massive disruption within wheat prices. That's up about 20% since the beginning of July. How much of a threat do you think there is of a new inflationary surge to deal with all of these different bottlenecks we're seeing in global shipping?
Absolutely. It's a very relevant question at this point in time. And if you look at bond yields across the world, they're elevated and they're close to cycle highs. I think food and oil inflation really passed through headline numbers, and central banks around the world really track core inflation when they take rate decisions. So I think core inflation is still orderly, determined. I think if this situation extends with Iran, there's a real risk that some of it actually passes through core, and then there could be a reason for central banks to actually raise rates at some point later this year. But that's not our base case scenario. We still expect the war resolution to happen at some point this quarter. And if that's your assumption, I think central banks around the world are likely to stay on hold for the rest of the year.
Well, Amol Shitole, thank you so much for your time as the head of fixed income as Mashreq Capital this morning, taking us through the various consequences of what we've been seeing in the escalation, particularly in the last few days in the Red Sea. Well, the White House Office of Science and Technology accuses China's moonshot of violating U.S. export controls in the creation of its Kimi K3 system. We'll get the details on that story next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, a White House official is accusing China's moonshot of improperly using American AI models and NVIDIA chips to create its Kimi K3 system. It's the latest U.S. claim of a possible IP theft by Chinese AI platforms. For more, let's bring in Bloomberg managing editor Jill Desis. So, Jill, give us the sort of details of the latest sort of twist in this sort of saga with the sort of Chinese AI firms, the details and, of course, the context.
Sure, Oliver. So, look, what this accusation revolves around is this idea that this U.S. official is accusing this company of basically using these GB300 chips sourced from Thailand. So these are NVIDIA's more advanced chips from its Blackwell line, and this is largely, these are really cutting-edge chips that are ultimately banned from being exported to China. Chinese firms do have access to some sort of lower lower tech chips from NVIDIA's line, but not these more advanced chips. So that's essentially what this accusation is revolving around, is this idea that Moonshot used cutting-edge chips that weren't supposed to be available to Chinese companies in order to develop its latest AI models, which I will point out that Kimi K3 model, when it came out, really shocked the tech industry there. What Moonshot is kind of claiming here is that these are, AI models that are competitive with all of the other, big ones, maybe outside of the most advanced Anthropic Claude, Fable 5 model, as well as the latest ChatGPT model. So, I mean, some really serious stuff. You have to point out that NVIDIA and Moonshot so far have not responded to requests for comment.
Yeah, well, really quickly on this, Jill. I mean, how can the United States really expect this to be completely watertight? And the other real question is there going to be any consequence for this, given the sort of strange relationship we have between Donald Trump and China, at one time very hawkish and sometimes very dovish?
Right. I mean, obviously, there's been these ongoing allegations against Chinese companies for years at this point about whether or not they've circumvented various export restrictions and all other kinds of controls in order to gain access to advanced tech. Comes to mind some Huawei smartphone developments from just a couple of years ago, where some of these similar concerns came up. I mean, you may have an indication where, maybe there's attempts to close the loopholes, but again, there's kind of this push and pull. And I think when it comes to, as you mentioned, some, strangeness within the U.S.-China relationship, we also have to look forward to, that sort of personal relationship between Donald Trump and Xi Jinping. These two world leaders are supposed to be meeting, in just a couple of months' time from now. So some indication there that, is that going to continue to go forward? I think we'll have to see how that factors into the equation here for the U.S.
Always watching that relationship very closely for us. Jill Desis, our managing editor there. Thank you very much. Well, coming up, we're trying to reckon with the possibility of a second front in the war with Iran. We'll do that with some of our reporters on shipping and the consequence that it'll have, of course, on the oil market. This is Bloomberg.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
This is Horizons Middle East and Africa, our top stories this morning. A widening war. The Houthis attack 2 Saudi tankers in the Red Sea as the U.S. conducts further strikes on Iran. Oil rising as the market reckons with the possibility of a second front in the Middle East. And the nuclear path. The U.S. signs an agreement with Saudi Arabia to share nuclear technology, opening the door for the country to enrich its own reactor fuel. And burning cash. Alphabet shares fall after another boost to its spending forecast. Meanwhile, Elon Musk warns of a massive capex year at Tesla as the AI race heats up. It has just gone 8:30 a.m. across the Emirates, 6 a.m. here in Brussels. I'm Oliver Crook. Let's get across your markets this morning. The focus, of course, this morning on Brent crude oil, trading higher this morning by about 2%. You can see that breaking through $95 a barrel, just flirting with that $96 a barrel level, up about $2, 187 this morning. Euro dollar also in full focus this morning, up 0.1%, up at 114. That is ahead of the European Central Bank rate decision that we are expecting out of Frankfurt a little bit later today. We will probably not get a hike. We will probably get no action, but we will, of course, get some guidance from the president of the European Central Bank, Christine Lagarde, and her view of inflation across Europe. Of course, MSCI Asia Pacific Index trading up by 1% this morning after those reports of big capex spends from those companies in the United States, benefiting some of those companies across Asia. And of course, the other side of that trade, you see the NASDAQ was down a bit more earlier. It's trading basically flat this morning, down by about 30 points. Let's get under the hood. Let's get into the real market action over in Hong Kong with Winnie Su. Winnie, what are we seeing this morning?
Yeah, good morning, Ollie. We are seeing Asian stocks extending gains for a third day now. This is the longest of such streak we've seen in a month. Still, the support is mainly coming from the technology shares, as you just mentioned. Hence, we are seeing South Korea's Kospi index here up by about 4%, with foreign investors buying for a fourth session so far this week. So every day we are seeing buying from foreign investors after them having, in fact, sold for the past 4 weeks. Now, that flooring inflow is really helping the South Korean won here to outperform all the other Asian peers. Here strengthening by 0.7% to the highest, to the strongest level against the dollar in about 10 months. Now, this strength in the Korean won also being supported by the better than expected GDP numbers that also raised the bets around the rate hike to come. Now, when it comes to Japanese yen, still hovering around that 163 level against the dollar, which is the weakest in about 4 decades. Now, flip the board, we take a closer look at the technology shares because, yes, we have that news from Alphabet raising their capex estimates for this year to top $200 billion, and that is likely going to benefit the supply chain here in Asia. In fact, you are seeing SK Hynix here up about 5%, and the company is getting about 7% of its revenue from Alphabet. And also, we are seeing Japanese suppliers, Advantest and also LaserTech, also rising because we do have lots of these equipment makers of chip making here in Japan. So we are seeing across the supply chain shares in Asia rising. Back to you, Ollie.
Thanks very much, Winnie Su, over in Hong Kong with the market action over in Asia. Now let's bring it back to the oil market, where prices have hit their highest level in over a month after the Iran-backed Houthi militant group said it attacked 2 Saudi Arabian tankers in the Red Sea. The attack has escalated the Middle East conflict beyond the Strait of Hormuz and now threatens a deeper energy supply chain disruption. Joining us now is oil and shipping reporter Wei Lun Soon. So listen, we've been very focused on the Strait of Hormuz. The Red Sea and the sort of passage over there has really fallen to the back burner over the last sort of year or two. What is the significance now of this possible disruption from the Houthis? And do we have a clear idea of what Houthi capacity is and how much they can actually constrict motion?
Right. Thanks, Oliver. If we talk about the Red Sea, we need to talk about the port Yanbu in Saudi Arabia on the Red Sea, which has been really crucial during the role that it plays during the Iran war, because Saudi Arabia was able to divert a lot of the flows from the Persian Gulf to avoid the Strait of Hormuz and pump it out through Yanbu, where vessels will pick it up and go to Asia. So about last week, we analyzed that around 6 million barrels per day was shipped out from Yanbu. This has continued a little bit, but with the recent attacks that was just seen overnight, there's a potential that ships might not want to go into the Red Sea anymore. And this would put about 4 to 5 million barrels per day of those flows at risk. So we would need to see how ships will want to move out of the Red Sea. There are two ways for them to go out. One is via the southern route, which is the Bab el-Mandeb. But that is where the Houthis apparently have dug in positions with missiles, with drone strikes to attack ships that go through the choke point. And then towards the north, you have the Suez Canal, where if they were to pick up the Yanbu cargoes to go to Asia, they will incur a lot of cost and a lot of delays to those deliveries for ships going through the Suez Canal.
So we have an idea of what the sort of trading range possibilities are for the Strait of Hormuz, the effect that it has on the oil market, you know, breaking up just above $100 a barrel. Do we have any idea of the sort of pricing that this kind of disruption would have on the oil market from the Red Sea side of things?
So the Wall Street Bank, Goldman Sachs, has just issued out a note saying that they don't see a lot of near-term disruption to prices. That's because any constricting, any lower supplies from the Middle East is actually offset by weaker demand from Asia. But no doubt with a further upside with the two choke points, that means the Bab el-Mandeb and also the Hormuz situation getting worse. We see traffic, shipping traffic actually going down. This will further knock on into like future oil prices, and we can see it hitting higher, maybe towards $100 per barrel.
Well, that's something that we're watching very closely, but I'd like to guess our minds a little bit into the future because, of course, now, particularly in Europe, it is the summer season, so there's going to be slightly less demand, certainly for gas, for oil. If we see this as sort of sustained disruption, what's going to happen within the oil market? Are we going to see a sort of bifurcation for pricing? Because as you were pointing out, that oil that's coming from Saudi Arabia can probably still make its way up to Europe, but potentially not to Asia. What are we going to see within the oil market?
We're going to see a lot of scrambling for buyers on the front on trying to pick up barrels from elsewhere on the world. We do see scenario planning for ships, especially for Asian buyers, which is where I sit in. A lot of them will think of how to reroute ships, pick up barrels from the Atlantic Basin instead of going through the Middle East, because the cost and benefit analysis in terms of freight, in terms of delivery times, it's now much narrower. And those are safer routes for Asian buyers to pick up. So you would see definitely some shifts in buying patterns.
Well, Bloomberg's Wei Lun soon for the latest there from we're seeing the disruption over the Red Sea and the effect that it is having on the oil market this morning. Now, Canada's foreign minister has told us Prime Minister Mark Carney has spoken to U.S. President Donald Trump and agreed to intensify talks relating to trade. Anita Anand spoke to us on the sidelines of the ASEAN meeting in Manila and began by discussing the markets of top importance to Canada as it looks to diversify away from the United States.
We are doubling non-U.S. trade over the next 10 years, but we also want to make sure that we have a very stable and distinct sovereign approach to our economic future, and that means diversifying trade.
I suppose this is partly to shield from the impact of U.S. tariffs as well. And speaking of that, there is an additional 50% tariffs from the U.S. hitting Canadian goods in 30 days' time. During this 30-day period, is Canada willing to look at offering concessions to the U.S. in exchange for lower tariffs?
So let's just remember that Canada and the United States have been close trading partners for decades and decades. We are bound together by geography. The Prime Minister spoke with the President yesterday, and they agreed to intensify talks relating to trade, and that will be undertaken by our Minister for Canada-U.S. Trade and our Chief Trade Negotiator. At the same time, we have to remember we can do multiple things at the same time, and therefore pursuing this diversified trade agenda, making sure that we have these free trade agreements with other countries, such as the Philippines. We're negotiating a comprehensive economic partnership agreement with India right now. We signed a free trade agreement with Indonesia in late 2025. Those are just examples of the way we'll diversify while those trade talks with the United States are ongoing. Right now, we are the only G7 country that has a free trade agreement with every other G7 country. That's the foundation of our trade diversification policy. But we are going a step further with those over 20 agreements in security, defense, and economic matters, with free trade negotiations that are occurring now.
One of the big concerns here is the inflation that is brought about by the Iran war. And I wonder, as an energy exporter, as Canada is an energy exporter, is your energy sales to Asia increasing after the Iran war?
It's a good point to highlight Canada's competitive advantage in the area of energy. Whether it's LNG from our west coast, whether it is clean or conventional, whether it is nuclear or solar or wind power, Canada is a leader. We will be the only G7 country working on the SMR technology, for example, out of Darlington, Ontario. All of that to say that energy figures quite prominently in both our bilateral and our multilateral conversations. And around the table this morning, I heard significant interest from ASEAN countries about ensuring that there's energy cooperation and climate change.
The thoughts there from Canadian Foreign Minister Anita Anand speaking to Bloomberg's Min Min Lo over in Manila. Well, coming up, Emirates telco DO reporting steady second quarter performance and growth. We'll get a little bit more detail with the CFO in a conversation that will be taking place just after the break. We'll go through their numbers and, of course, the outlook for the Emirates. That's the conversation we'll be having next. And this is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Welcome back to Bloomberg Horizons Middle East and Africa. Emirates Integrated Telecommunications Company, also known as DO, have reported a steady first half performance for 2026 and their latest second quarter earnings report. The telecom service provider saw revenue growth of 4.6% for the quarter and net profits up 12.6% for the first half of the year. And we're very pleased to be joined by the Chief Financial Officer, Kais Ben Hamida of DO. Thank you so much for joining us this morning. So listen, I'm sure it's been a very complicated couple of months for anybody running any business in the Emirates. Give us an overview of what we saw here in the second quarter.
Good morning, Oliver. DO has an excellent set of numbers, as you have highlighted in the first half of 2026, despite a quite complicated, volatile macro environment and regional environment. Revenues at 8.2 billion, 5.8% growth year over year. EBITDA at 4 billion, 10.5% growth year over year, and net income at 1.6 billion, 12.6% year over year. The board approved an interim dividend of 26 fils, which is a growth of 8.3% compared to the interim dividend of last year. So this shows how defensive is the industry, how is effective our operating model that allowed us to show this set of numbers in the environment that we were talking about.
Yeah, and so as you mentioned the environment there, a challenging environment, which you make a reference to a couple times. In your earnings report, you also make reference to the fact that growth and moderation from prior periods has been moderating in terms of the growth rate. Still a growth rate, but one that has moderated. Giving access, as you do, to the sort of information about people that are coming, potentially getting SIM cards, what do your numbers in the last quarter tell us about the volume of people coming into the Emirates, specifically on tourism?
Yes, definitely. I mean, we've seen in the number our base, our prepaid base in particularly, we saw a moderation of the growth that is fundamentally driven by the reduction of the tourism activity in the country. However, on the other side, our postpaid base held strong with a 9% growth year over year, and our fixed base also has been growing at 5.5% year over year, and this sustained an excellent level of revenue growth in the fixed at 11.6%, and also in the prepaid base. So we see a little bit of disconnection. On one side, the long-term contract, the ones that are taken by the resident, are holding up, while we're seeing a moderation, as I highlighted in the part that is affected by the tourist activity.
And the word of the day seems to be CapEx. That's what we heard from Alphabet earnings, spending a lot of money. The same with Tesla, and of course, building out all that AI infrastructure and data centers is absolutely paramount, not just for them, but of course also for you. How does this sort of conflict, does it change anything in terms of your outlook, in terms of spending on the projects that you're focusing on, and particularly on the data centers?
Look, the short answer is no. We've been maintaining our CapEx plans, both when we talk about CapEx related to our network and also into what we call beyond the core, which is fundamentally the data center. So we've been driving as per our plan, and we even accelerated the deployment in the data center to cope with certain commitment that we have vis-a-vis of our partners to deliver certain blocks of data center capacity at the end of the year. What we're doing, however, is we're monitoring carefully the evolution of the situation, and we will adapt when it comes to the deployment. But we believe that as of today, we're deploying as per plan. I think also the strong balance sheet of DO is an important factor that is allowing us to maintain all our plans, while at the same time serving to our shareholders a very healthy and generous return.
And we're speaking this morning as we see the possibility of a further escalation in the war, this time on the side of the Red Sea. We've heard from the Houthis in the past talking about potentially cutting undersea cables that carry fiber optics. Is that something that you, as sort of on your risk radar, how do you insulate from that kind of risk? What kind of effect would that have?
I mean, as you can imagine, for an infrastructure that is as important as the telecom that we're operating, we do have several alternatives and several recovery systems that will allow us to operate and redirect the traffic to cope with the various situations, including the one that you're talking about.
Well, Kais Ben Hamida, thank you so much. That is the Chief Financial Officer this morning of DO, bringing us that perspective on obviously the broader region, but of course on the morning of their earnings report. Well, coming up next, we will go to Frankfurt ahead of that all-important ECB interest rate decision. Not expecting a move, but we are expecting some guidance from the President of the ECB, which will be very closely watched by the markets. That's next, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
Welcome back to Horizons Middle East and Africa. Expectations have hardened for South Africa's Reserve Bank to raise interest rates after annual inflation rose in June. Consumer prices increased 5% compared with 4.4% back in the month of May and exceeding the medium forecast for 4.7%. A survey of Bloomberg economists see the central bank raising rates by 25 basis points to 7.25% when it meets a little bit later today. Now, the other central bank that is in full focus is the European Central Bank, where they will meet and expected to keep rates unchanged this time. The deceleration of euro area inflation in June set to eliminate the need for urgent action until September, when borrowing costs could yet again be raised. For analysis on all of this, we're joined now by Bloomberg's Jana Randau, who is at the ECB headquarters for us this morning. So, Jana, what are we expecting to hear from today's meeting? Is this just sort of an opportunity for the ECB to buy its time in order to see what happens in the next couple months?
Yes, for sure. Good morning, Oliver. So no change, you said it. Really nobody expects it, not economists, not traders. It's a meeting where words matter more than action. So it's all about what the president has to say about how the economy has done so far from the June meeting. And more importantly, maybe even how the risk balance has changed, how risks to the economy, to the growth outlook, but also, most importantly, of course, for inflation have developed with this new escalation in the Middle East. Now, there was a moment, of course, after the ECB's June meeting when they raised rates for the first time since 2023, where things really look good. A ceasefire in place, oil prices down, the economy closer to the milder scenario the ECB lined out that had inflation come back to the target sooner. But of course, the escalation that we've seen also again overnight, that means it's back to square one, as one of the governors recently said. So more monitoring the situation, collecting data, waiting for very important projections in September, and decide then whether more hikes are needed.
Yeah, and the escalation of the war obviously is not a good thing for anybody, certainly for the European economy and for the ECB. But it sort of validates, I think, probably what happened in the last decision, when there was potentially some doubt about that if you did have a resolution. Casting our mind forward over to the September meeting, what are we watching there? What are we watching in terms of the potential spillover effects, secondary effects, and of course the concern for growth?
Yeah, I mean, September, that's when a lot more information, a lot more data will be available. 2 more inflation reports, GDP figures for the second quarter, and most importantly, projections. Now, the ones in June, they had inflation back at 2% around 2028, so the end of the forecast horizon. In the medium term, so broadly, you know, the timeline the ECB looks at when it defines price stability, that may change, and that would be the clearest indication. Now, the other thing that we're watching and policymakers are watching very carefully is how those energy prices, oil prices, gas prices that are very, very elevated, how they filter through to the economy. We've seen indirect effects. So if you think fuel prices, if you think, you know, transport, airline tickets, these kind of things where energy really fits in. We've seen those, of course, react. Second round effects, the one that policymakers tend to be very allergic to, wage growth, for example, is in that category. We haven't seen that, but those are lagging indicators. They take a bit of time to filter through. Yeah. So any sign, you know, in that category, that would be alarm bells ringing at the ECB, and that would essentially really push them into that direction of a hike.
Well, thanks very much to Bloomberg's Jana Randau there. As you can see outside of the ECB headquarters over in Frankfurt, watching very closely that press conference that we'll be getting from the president of the European Central Bank a little bit later today, with a keen focus on the inflation picture across the world and what we're expecting in the months to come. That's it for Horizons Middle East and Africa. Stay with us. Bloomberg Daybreak Europe is next. That'll be next. And this is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. European tech players report, including Nokia and ST Micro. Stateside Alphabet shares slide overnight as it says capex will likely top an unprecedented $200 billion this year. Meanwhile, oil gains after Houthi attacks on 2 tankers in the Red Sea threaten a new front in the Iran war. And the ECB grapples with inflation fears ahead of today's rate decision. Investors watching for any signals of a move higher in September. Well, a very good morning. Here's the picture in markets this Thursday. Just a snapshot, but a contrast between East and West. We've got shares higher in Asia, fueled by the chip makers on expectations that they're going to benefit from AI spending. Brent has been higher again after the Houthis attacked 2 tankers in the Red Sea. And if we look over to the right of this board, we have the 30-year yield still sticky. The Treasury yield at 5.14, so holding above that crucial 5% level. It's been above that level for the longest streak now since the dawn of the financial crisis. So that is concerning, of course, also pushed higher by concerns about America's growing debt pile. Plenty to bring you. Lots of earnings this morning. Let's set you up for the day ahead. Well, we begin with breaking earnings out of France. The bank BNP Paribas, the expectation had been that its investment bank would be one of the key earnings drivers. Clearly, the market volatility of the past quarter has been the backdrop for banks. The question is whether EU banks like BNP will ever be able to benefit from that volatility to the extent of US banks. What we are seeing is the redhead second quarter net income coming in at 4.35 billion euros. The estimate was for 4.23 billion euros. So indeed, it is a beat there for BNP Paribas. And if we look into a little more detail of what we're seeing here, BNP reporting not only better than expected profit, but also revenue. Stock traders blowing past estimates here. So equities revenue rising 43% from a year earlier to 1.4 billion euros. And that's maybe a little shy of the gains reported by some of the biggest Wall Street firms, as I say, but it's well ahead of the 1.1 billion euros forecast by analysts. So we're going to be speaking to the CFO, Lars Machenil, on the opening trade later this morning. That conversation coming up at 7:15 a.m. London time. Also going to be really interesting to get an update on its Sudan litigation, if we can, and indeed Lars's views on the future of European banking consolidation. Well, that, of course, is also a theme for UniCredit, and their earnings out of Milan dropping as well. So let's switch to that. Second quarter net income coming in at 2.91 billion euros. The estimate was for 2.8 billion euros, so a beat there. Analysts were expecting upgrades to the guidance. We've seen the shares up 44% in the past 12 months. Well, they say that the full year is well above, for net, 11 billion euros. They saw equal or above that level. So they're raising their goals as the CEO pursues this Commerzbank deal. And this is Andrea Orcel moving closer, really, to the takeover of Commerzbank. So upgrading that full-year profit guidance and lifting also the mid-term profit targets as well. Remember, of course, just a few weeks ago they completed the takeover offer for Commerzbank, so that putting Orchel on track to control close to 50% of the bank, and a full taker would mark the biggest bank deal in about 2 decades. So really interesting to see these numbers out of UniCredit. We also need to switch over to the tech space because we have results from Nokia as well. They're coming in thick and fast, these earnings this morning. So let's switch over there. The redhead crossing the terminal, that second quarter adjusted operating profits at 434 million euros. So a big beat here. The estimate was for 372.3 million euros. The CEO saying they're still tracking somewhat above the midpoint of the guidance. Operationally, the full-year outlook is unchanged, they say. So this was expected to profit from the optical cable business, which, of course, sells components to the data centre industry. Last week we had rival Ericsson revealing that margins would be under pressure in Q3 from higher prices as that data centre construction boom constrained the memory chip supply. But a big beat here when it comes to adjusted operating profit from Nokia, so a little brighter. We also, just staying in European tech, have results from ST Micro, and they say that data centre revenue is going to be well above $2 billion in 2027. In 2026, it's above $1 billion. They've raised their revenue ambition for data centres. And the redhead is that they see third quarter net revenue at $3.7 billion, which is just shy of the estimate, actually, of 3.79 billion euros. So a slight disappointment there, actually, for ST Micro, but the chip maker largely benefiting from strong AI data centre demand, as we see from Nokia as well. Well, let's get some analysis now. We can bring in Matt Bloxham, tech analyst here at Bloomberg Intelligence. Matt, I've just run us through the numbers, the top lines, but what stands out to you for ST Micro and Nokia, first of all?
Yeah, I think with ST Micro, maybe there's that kind of little bit of margin softness, which maybe is to be expected given there's just so much inflationary pressure on components into these things. But yeah, an optimistic outlook for the data center opportunity, and also that comes through in Nokia, as you mentioned. Both those companies are kind of peripheral plays, if you like, on the whole AI data center boom. Nokia's invested heavily in a particular company called Infinera, very much in the kind of optics part of data centers. Similar story for ST Micro, and I think when you look at the big picture and the kind of revenue opportunity, they're both talking optimistically about their opportunity there. But yeah, some pressure still on profitability, because even though perhaps the revenue opportunity is looking better, both of them perhaps a little bit soft on the profit side, and that's definitely been an ongoing concern. As you said, we saw this with Ericsson last week, that input costs are a problem for them to manage, and it's constraining the profit outlook to some degree.
Well, you talk about Europe, these companies kind of being on the periphery or maybe further down the supply chain. The boost that we're seeing in Asian stocks this morning follows the results that we saw for the mega caps yesterday. They're maybe in Asia looking to benefit from this capex, but the capex sort of worrying for some of these mega cap players. So if we start off with Alphabet, first of all, doubling down, lifting spending outlook, but that's concerning, it seems, to investors.
Yeah, it is, and I think it's concerning because although the top line print was a bit better than expected, it's only about 1% or so better, so just about $103 billion of revenue in the quarter, and actually the profitability on the services side was a little bit weak. Better on the cloud services side. So I think although the business is still growing north of 20% year on year, it's been growing those levels for quite some time without these massive capital expenditure spikes. So I think the market's looking to see more to kind of balance against the capex spend, and it's pushing the capex spend very much into the kind of speculative territory, in that we've been in an AI arms race for quite some time, and that's just getting even bigger, and you start to get this kind of irrational spend coming through. And I mean, it's a few years back, but I can remember Mark Zuckerberg talking about we don't know whether we're going to make any payback on these investments, but we kind of have to do it, because if we don't do it, we're not in the game anymore. And it almost feels like we're kind of getting a little bit back to there, and I think that's what worries investors.
But you kind of wonder whether, if everybody's pumping money into CapEx, surely the bigger worry would be if they weren't doing that. I just want to play you a bit of what Elon Musk said, because, of course, we also had Tesla results, but shares tumbling there, too, off the back of their results. And, again, CapEx a concern for investors. So let's take a listen to what Elon had to say.
We should be spending on CapEx as fast as we can spend, as fast as we can, without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time.
So why is that not reassuring, Matt, to investors?
A couple of things. I mean, for me personally, the fact that he even put wasteful in his kind of response is a question mark. It plays to this concern investors have. Why is any of this CapEx wasteful? I think, and there's quite a big difference, I think, between Tesla and a Google. As much as there's uncertainty about the opportunity facing Google, it's much clearer what the AI opportunity is for them. For Tesla, it's about humanoid robots. It's about robo-taxis, it's about self-driving cars. Some of that is kind of clearer, but there's lots of question marks, particularly around the humanoid robots. So the CapEx for Tesla feels, for me at least, a lot more speculative than it is for Google. So I think that's a question mark. So the whole industry has a lot of questions still to answer about the return profile of these investments. So I don't think we've got yet any clearer answers about that from anybody that's reported so far.
A little more sci-fi, perhaps, when it comes to Tesla. Matt Bloxham, really appreciate your analysis. That's Matt Bloxham, tech analyst here at Bloomberg Intelligence. Well, those expectations for increased hyperscaler spending are boosting tech stocks, as I say, in Asia. We're looking at the MSCI Asia Pacific Index up nearly 1% this morning. Let's zoom in. We can speak to Winnie Su in Hong Kong. Winnie, what should we be watching this morning?
Yeah, good morning, Lizzie. As you just mentioned, it's quite interesting to see that divergence in terms of reaction towards Alphabet's earnings from the U.S. investors and here in Asia. Here, at least, as you just mentioned, it seems like it's more the excitement of how those massive spendings can potentially trickle down to the supply chains here in our region. For example, SK Hynix here, you can see up about 4%. And in fact, it is getting more than 7% of its sales from Alphabet. And also, we are seeing the gains in the Japanese equipment makers, which are likely also going to benefit from the more spending of the U.S. hyperscalers. But flip the board, we take a look at the broader Asia market, because gains being led by tech. We are seeing MSCI Asia here up for a third session, its longest of such streak in about 3 weeks. Leading gains today, we have South Korea's Kospi here up more than 3%, seeing another day of foreign investors buying. Now, we are seeing foreign investors buying every single day so far this week, coming after net selling for the past 4 weeks. So that net inflow from investors are actually boosting the South Korean won here, strengthening by 0.7%, outperforming all the other Asian peers. Also being supported by the better than expected GDP numbers that reinforce the bets on further rate hikes to come. Flip the board, we take a look at Japanese assets, because still all eyes are on the Japanese yen, which is still trading above that 163 level against the dollar, around its weakest level in 4 decades. Yes, yesterday we did learn that the Bank of Japan is open to raising rates faster than what the consensus is expecting. And that expectation now for a more hawkish tilt from the Bank of Japan is also raising the 2-year yield here higher. We are seeing the curve flattening further, while the 10-year yield is still slightly higher, tracking those moves from the treasuries overnight. Back to you, Lizzie.
Winnie, thank you very much. That's Bloomberg's Winnie Su. Well, to another corner of the market now, looking at Brent trading up 2.2% at $96 a barrel this morning. This as Yemen's Houthis say that they've targeted 2 oil tankers in the Red Sea after threatening to open another front in the Iran war. Now, the UK Maritime Trade Operations Centre reported that a ship has been on the Saudi Red Sea coast. And meanwhile, as the US completed a 12th straight night of attacks on Iran, President Trump posted on social media threatening to bomb 1 bridge or power plant for every time Iran shoots at a ship in the Strait of Hormuz. So let's unpack this with Bloomberg's Paul Wallace now. Paul, we've got two fronts here opening up. The war widening, it seems. How much does it reduce the chance that the US and Iran are not going to come back to the negotiating table?
Hi, Lizzie. Well, I think we can now say we do have a new front having opened on the Red Sea coast, because the Houthis a few days ago effectively threatened to attack ships in that part of the world, but they hadn't done so until these claims last night. We still have to get them confirmed. The UK MTO seems to have confirmed one of the attacks, but not the other. But nonetheless, this is a very worrying development for Saudi Arabia, for the US and its allies. And in terms of getting Iran and the US back to the table, yeah, it seems like it makes that even less likely. Iran and the US have really been signaling in the last few days that they're not ready for a new round of negotiations. Of course, we had the 12th night in a row of US strikes on Iran yesterday, and Iran continues to hit countries like Bahrain and Jordan and Kuwait, and also ships in the Straits of Hormuz. So at the moment, it seems as if the signs are pointing towards escalation rather than any easing of tensions.
Yeah, and interesting to see the US and Saudi Arabia finalising their nuclear technology sharing deal. Surely that risks sparking a nuclear race in the Middle East when, the US is giving Saudi Arabia exactly what it went to war with Iran to prevent: enrichment. Paul, really good to get your take this morning. That's Bloomberg's Paul Wallace out of Dubai. Well, let's take a look at the risk events for the markets on the docket for today. At 1:15 p.m. London time, it is an ECB decision out of Frankfurt, a hold expected. But do we get more hawkish hints when it comes to a September hike? We should be discussing later on in the show. At 1:30 p.m. London time, it's US weekly jobless claims expected to stay about the same level as last week, despite some of the AI-driven changes in the labour market. And then we also have more earnings from SAP out of Germany, of course, the software company. The bar a bit lower for expectations given the AI worries, especially after that IBM profit warning earlier this month. But still ahead, the ECB, as I say, expected to hold rates this lunchtime, but traders waiting for clues on what happens in September. And speaking of central banks, first of all, how Kevin Warsh's lack of forward guidance has left traders scratching their heads, guessing the Fed's next move just a week before its next meeting. We'll get you all the details next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. 6:18 here in London. Well, the lack of forward guidance from the Fed has left traders guessing next week's rate move. Swaps markets suggesting that traders see a roughly 30% chance of a 25 basis point hike and a 70% chance of a hold. Now, that kind of split so close to a meeting has been exceedingly rare in recent years, but maybe it's going to be a bit more commonplace under Kevin Warsh as Fed chairman. Let's get some analysis now. We can bring in Ven Ram, cross-asset strategist at Bloomberg MLive. Ven, is this inevitable when you have a Fed chair who wants less forward guidance? What sort of positioning is going to be the result of this uncertainty?
Absolutely, Lizzie. I think it's a sign of things to come. Because if Warsh doesn't want to give forward guidance, I think this is the way the markets are going to price. And as you were mentioning, this is extremely rare. We haven't seen this kind of shift in pricing in the past 2 years, actually. So the markets are thinking, you know what, if you're positioned, depending on how you're positioned in the portfolio, you need to be hedging your bets. And the best way to hedge these bets, hedge the bets going into these Fed, is to buy the short-dated swaps. So if there is a surprise that the Fed throws a curveball, then the portfolio is adequately insulated against any unforeseen changes. And if you see what is happening in the MOVE index, that captures very well what is going on. And the market, VIX in the MOVE index has more pushed higher since Warsh took office. And if you look at the 2-year and the 10-year yield, they're also telling that where yields in the front end were trending lower than 4% before Warsh took office. We have seen 425 as the new equilibrium on the 2-year and 450 as the new equilibrium on the 10-year. And I think that's going to prevail because Warsh is talking very hawkish. And I think that the markets are increasingly going to be positioned for the risk that, the Fed will deliver something more hawkish than they ever imagined.
Yeah, maybe we see a bit more volatility around the data taking on increased prominence, as well as the developments on the geopolitical front. Ven Ram, thank you very much. That's our cross-asset strategist at Bloomberg MLive. Well, coming up to M&A, Paramount's takeover of Warner Brothers wins conditional approval from the EU, but the deal could still be derailed by a US lawsuit. So we'll get you the details on that next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Durrett.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, Paramount shares have risen in the US after its $110 billion takeover of Warner Brothers won conditional approval from the EU. The green light comes after both companies agreed to address competition concerns, but the merger still faces a US lawsuit that threatens its progress. Let's get some more detail now with Bloomberg's deals reporter Manuel Baigorri. Good morning, Manuel. So first of all, what did Paramount have to do to get this approval? And second, what's next when it comes to US legal hurdles and maybe even a possible UK public interest intervention when it comes to this deal?
Yes, Lizzie, we've seen this deal taking so many twists and turns, and now obviously after they got it announced, they need to get clearance from regulators. We knew from the beginning that it was going to be a very tricky and bumpy path ahead to get the clearance, and obviously, as we just learned just a few days ago, 12 states in the U.S., including California, they are suing this deal on grounds of competition, right? So that is the major hurdle that they will have to clear to get this through. Obviously, as we saw with the European Union, European Commission now getting a nod and clearing the deal, that is a major step. So it's definitely a good win for the companies, but at the same time, it's not enough. And we've seen a lot of deals actually getting stuck for very lengthy periods in Europe. That's not the case on this one, so that's definitely positive, but yet not enough. And we're seeing that also translating to the spread, the stock versus the actual bid and the agreement on the table between the companies. So that's widening as well with regards or reflecting those growing concerns. Again, I think we're going to see a lengthy period, especially out of the US. Whether or not the UK will weigh in as well, it remains to be seen, but obviously that will potentially be another hurdle to overcome.
OK, the saga continues. Manuel, thank you very much. That's Bloomberg's Manuel Baigorri. Now, to some other top stories we're following for you this morning. Bloomberg has learned that OpenAI's advanced AI models completed an attack in hours that would normally take a skilled hacker several weeks in the incident which breached the internal systems of AI startup Hugging Face. OpenAI said it notified law enforcement and other authorities and has been transparent about its findings. And elsewhere, European car sales have hit their highest since October 2023 as more drivers shift to electric vehicles. The European Automobile Manufacturers Association says sales rose 13.1% in June to 1.4 million units. Battery-powered vehicle sales rose 51%, with France and Germany making up the bulk of the rise after new incentives helped drive sales. And sticking with cars, Aston Martin has secured £550 million of fresh funding from BlackRock-owned HPS investment partners to strengthen its finances. The luxury car maker said the funding will help repay existing debt and lift its liquidity to about £340 million as of the end of June, as it grapples with challenges including product delays, quality problems, weak Chinese demand and US tariffs. What a list. Well, coming up on the programme, the ECB is expected to stay on hold today, but how do escalating tensions in the Middle East affect the outlook? We've got a keen eye on September, of course. That's our conversation next, so stay with us. This is Bloomberg.
the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Bumper bank earnings as traders triumph at BNP Paribas. UniCredit raises its guidance for the year after higher than expected profit. Meanwhile, tech takes centre stage as Nokia posts an earnings beat as well, while the chip company ST Micro guides to revenue below expectations this quarter. Stateside, Alphabet shares slide overnight as it says CapEx will likely top an unprecedented $200 billion this year. And oil gains after Houthi attacks on 2 tankers in the Red Sea threaten a new front in the Iran war. Well, this is the picture in markets this morning. Good morning if you're just joining us. 6:30 a.m. here in London. We've got Asian shares rising, fueled by the chip makers on expectations that they'll benefit from the AI spending that we've been discussing. Mag 7 earnings coming through last night. But today we have European and US futures pointing lower. Alphabet and Tesla dropping after earnings, and the S&P yesterday slumping for the 4th time in 5 days on the oil price jump. Now, speaking of which, flip the board cross asset, and you've got Brent up again, 1.6% higher this morning at 95.55 the barrel. That fueling concerns about sticky inflation. It's, of course, off the back of Houthis attacking 2 Saudi tankers in the Red Sea. If we look at the very long end of the curve, the 30-year yield's still above 5%, and it's held above that level for the longest streak now since the dawn of the financial crisis, also pushed higher by concerns about America's growing debt pile. And you've got the dollar a touch weaker this morning, down 0.2% on the Bloomberg Dollar Spot Index, despite, you might say, higher prices for oil. Now, let's turn to the front pages this morning. What do we got from the Financial Times? It's reporting on Google's gargantuan AI spending as free cash flow turned negative for the first time. The paper says it adds to investor anxiety about the scale of its bet on AI. Meanwhile, the Wall Street Journal reports on a surge in US forces to the Middle East. This paper saying that special operations forces have been deployed to the region, and bomber aircraft at bases in the US and the UK are on high alert. Finally, here in Europe, the headline on Les Echos out of France reads, why the confrontation between the United States and Iran is destined to escalate. It says the war risks spiralling out of control. You can get a roundup of all the stories you need to know to get your day going in today's edition of the Daybreak newsletter, which terminal subscribers can find by going to D8YB Go. Now, let's head to Frankfurt because the European Central Bank meets today, of course. It's widely expected to keep interest rates unchanged. And while the deceleration of euro area inflation in June eliminated the need for urgent action, the ECB is likely to leave the door open for a move in September. Let's go now to Jana Randau. She's outside the ECB for us in Frankfurt. Morning, Jana. So a hold expected, but how divided is the Governing Council? You speak to all of them. What have you been hearing from different members of the GC?
Good morning, Lizzie. It's good to be here. So there was a bit of a division earlier this month when the ECB had its forum in Sintra We heard there that some were arguing, well, we definitely need to raise interest rates one more time in September just to make sure that inflation is coming back to the 2% target. Others were saying, well, maybe, with the ceasefire in place, maybe 1 in June is enough because in growth, will react and growth is slowing down. So that there was a bit of, a division there. That has changed now. Everybody's on the same page when it comes to this month, so no change expected. And as for September, I mean, as you know, the Greek governor put it a few days ago, it's back to square one, and that's of course because of the escalation in the Middle East of new fighting. New attacks, of oil prices going up, energy prices in general going up, and that of course means new inflation risks for the Eurozone. That slowdown in inflation we saw that was bigger than expected, that is now certainly going to be reversed. So yeah, really back to square one, looking at data, looking at fresh forecasts in September. That's what the ECB is really waiting for, and then we'll see.
Well, give us more of a flavour of the data then, the economic backdrop heading into this meeting.
Yeah, so inflation a bit weaker, growth surprisingly resilient. We saw PMIs that were essentially out of contraction, not quite growth, but right on the border between growth and contraction. That is good news. Sentiment indicators going up recently, but the big question, of course, is will that hold? And what's going to be interesting today is not so much the decision itself, of course, but how Lagarde really describes the economic outlook, how she describes the risk assessment, because what they're wondering, of course, is second round effects, inflation expectations. Inflation expectations we've seen going up in the short term, which is normal if you think that prices are higher today. But the medium term is important. They've trended higher, not so much concern from the ECB so far, but that can of course change. And then second round effects is really the enemy, if you want, for any central banker. And that's wage growth, of course, a lagging indicator. So if there is something to see there, that's probably going to happen later this year. So they're on alert. They're watching out. The data so far we've seen looks pretty good, but again, whether that holds, whether that remains to be true, very much depends on the situation in the Middle East. It's very fluid, as we all know. So not much of a commitment that we expect from the ECB today.
OK, Jana, really looking forward to your coverage throughout the day. I'm sure you'll be able to tease some clues out of Christine Lagarde at the press conference on what might be happening in September. That's Bloomberg's Jana Randau outside the ECB for us in Frankfurt. Well, let's get some analysis now. We can speak to Josie Anderson, European economist at Nomura. She joins me in studio. I want to start, Josie, with a quote from Christine Lagarde back in March. It's in your notes. The public may find it difficult to understand a reaction function that does not react. Well, Jana just said it out there. You've got re-escalating tensions in the Middle East. Oil, $95 the barrel. Does it make sense to you then if the ECB holds today?
Well, I think the ECB sees what is likely to be a hold, probably as a review period. They're not saying we did one hike and then one and done. They're saying we're watching how the data develops, and in September we'll have more forecasts. There's so much uncertainty. After the last meeting, it was almost that evening, the next day, we had news of a de-escalation in Iran, oil prices falling. They've done almost a perfect U since then, and they've come back up. So the ECB will actually probably be feeling the effects of that, where it produced forecasts that we thought were quite hawkish last time. But then almost immediately after that, everything was looking a bit more benign, and now they're in a more concerning situation. When she said that quote about reacting to its own reaction function, she also noted that its own forecasts included the assumption of 2 rate hikes. So at that point, we made it pretty clear their baseline was 2 hikes, but not necessarily in quick succession, over what we thought was likely to be a quarterly period. But at the last meeting, she left things a lot more open because of high uncertainty, and we imagine that she will want to do the same today.
OK, because on the comms today, you've got 2 hikes already priced in by year-end. It's surely going to it's going to be difficult for Lagarde to sound more hawkish than that. Are we going to come out of this meeting thinking, oh, that was a dovish hold?
Well, yeah, exactly. We do think there's potential for that. We do see another hike in September. And then, of course, markets are pricing almost another one by December. But that December question, Lagarde, I think, will just be thinking that it all depends on what happens in Iran. And so she won't want to commit in any way to a December hike, even if she hints at September. And so we think there's potential to disappoint markets from that respect.
But you say ECB market pricing is largely an oil trade. If that's the case, and as I'll say again, oil at $95 a barrel today on Brent, why not go for 50 basis points in September?
Well, yeah, that is a good question and one we have looked at, but we think it's unlikely. So the last time we saw some 50 basis point hikes, that, of course, was in a much bigger energy crisis in 2022 when we saw inflation rapidly accelerate. We're not yet in that scenario, and we don't think that ECB will want to signal that it's in a scenario where it needs to take an aggressive stance to get inflation back to target. We think Lagarde has set out 3 different scenarios, kind of a scenario that doesn't require a transitory inflation scenario, a scenario that would require a small adjustment. And we think she still likely views we're in that scenario, although rising oil prices do risk that we're in a third scenario that's a bit more like what happened in 2022 that requires a more aggressive hiking cycle. But at this point, we think a 50 basis point hike might signal that third scenario that she's not yet ready to say we're in.
OK, well, let's put our optimistic hats on and turn to the flip side of all of this. Let's say we have this meeting and then diplomacy resumes and oil falls. How low would it have to fall for how long to write a September hike off?
So we actually think September was always likely, even if that fall in oil prices that we saw after the last meeting had continued and oil had stayed roughly similar to prior to the start of the war this year, because, of course, we had that fairly lengthy duration of much higher oil prices between early March and June, and that will have already done some damage in terms of higher inflation expectations, energy prices feeding through slightly to the rest of the economy. And so we think the ECB would have always likely hiked in September just as a signal and to manage any potential second round inflation effects, particularly because actually the ECB said recently that what it regards as neutral policy rates, and so one that doesn't place upwards pressure or downwards pressure on economic growth and inflation, is likely between 1.75 and 2.5%. So another hike to 2.5% would still be broadly neutral at things, so not even particularly restrictive.
So can you split how much the further hike or hikes you see would be because of, on the one hand, the oil price, and on the other hand, the second round effects?
Yeah, so, I mean, obviously they're very interlinked, right? Higher oil is for a longer duration, the more that will feed into people's inflation expectations, therefore wage negotiations and second round effects. And this is all really the ECB can work against in its policy rate, because it can't stop wholesale energy prices rising and households' energy bills and pump prices.
Well north. We're sort of approaching 5.1% or so on the 10-year gilt. So there is some bad news in there. I actually think gilts look attractive, but there is going to be political volatility, I think, until we get a greater sense of exactly what the new government want to do.
How short is the leash? What would frighten the bond market?
I think if you start to talk about breaking some of the fiscal rules, additional spending, that's what the bond market's going to be concerned about. We heard all on Monday, again,
talk of war bonds, but walked back.
Again, but it was talking of sort of extent, like using the fiscal framework till it's almost full power. And I think again that starts to concern markets. And I think that's just a general theme around all. And it's not just the UK. I think we need to be mention that it is a global phenomenon at the moment, fiscal spending, and ultimately yields are moving higher on the back of it.
But if you, to Anna's point, if you did something like an off-balance sheet kind of idea around what happens with the defence spending, would the market say, OK, we'll treat that as separate, or is the market looking at the totality?
I think the market's always going to look at the totality. I don't think that the market's going to say, "Oh, that's fine." It's sort
any
of off-balance
attempt to kind of circumnavigate the rules will be pushed back on fairly hard.
Well, I think we saw a very small clip of that on Monday when it was it was very loose terms. Let's use some more flexibility around that, and we saw the instant reaction. Gilt's underperforming the rest of the market, and if they want to do a lot more than that, then I think the gilt market would show its face.
Right. So quite a short leash then.
Yes.
Ian, nice to see you. Always a pleasure. Thank you very much indeed for joining us. Ian Steely, International Fixed Income CIO at JP Morgan Asset Management. Coming up, we're seeing some very big fluctuations this morning in the European tech space. We're going to work you through the reaction and also the numbers that have caused that reaction.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow with the close. Weekdays on Bloomberg. Context changes everything.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Welcome back. This is the opening trade. Things moving pretty fast this morning. This is the picture across European equity markets. There are so many different dynamics here to the European earnings story. So we'll get to some of those in a moment. But we've got European stocks as a whole down by 0.8%. Yes, energy is doing OK and real estate's doing OK. Some M&A in there. But a lot of other sectors under pressure. We've got an oil price that is now up by more than 4%. 98 is the handle on Brent. And that is having an impact, perhaps on stocks, certainly on bonds. Let's have a look at where we are on the bond market story. I can tell you that the German 10-year is up by 3 basis points. This is the 10-year yield climbs to 3.2% at its highest. That's the highest since 2011. So we're breaking through some important levels here. We're seeing this in France, where we're up by 4 basis points. The UK 10-year up by 5 basis points. Traders are boosting their bets at the Bank of England, fully pricing 75 basis points of hikes by the middle of 2027. So things are fast moving on the inflation and energy front, Gary.
I think Anna's channeling her inner Ferris Bueller this morning. Things are moving pretty fast out there. Around here, I think that's the quote. Anyway, they certainly are. European tech is one of the areas where things are moving pretty fast, and you've got some really big divergence emerging as well. Look at this screen. Look at that. ST Micro is down by 15%, and you've got Soitec up by 20%. This is a pair trade, definitely, this morning, that could be working out if you've managed somehow to put that on. Let's talk to Neil Campling about all of this. That would be the pair trade of the morning, wouldn't it?
If it was, and if I put it on, I wouldn't be here now. I'd be out on my yacht.
Why?
It's part of the AI trade, for sure. I mean, what we saw last night with the Alphabet CapEx supports the picks and shovel stocks, the chip makers. However, why these two chip makers, or one being the chip equipment provider, being Soitec, up so much and the other not? It's quite simple in that Soitec managed to beat on every single metric and raise guidance on all metrics. So that's the key thing. They're now guiding to next quarter being up 30% year-on-year revenue growth. Great number. In contrast, ST Micro effectively came in line. No upside to the margins, no upside to that guidance. Both stocks are up triple-digit year-to-date. When you've got such high expectations, merely matching those expectations is not good enough. That's the simple answer to that question.
It's kind of good to know that it is possible to impress in this Turk earnings season, because we're not very far through it, are we? And I was looking at, yes, Alphabet gets complicated and it is so enormous, but we can talk about what they said, but there's also Texas Instruments. They didn't look so bad, but yet the stock dropped on those. So it's kind of comforting, maybe, to know that it is possible to impress. What did you make of the Alphabet story? What did you take away from it?
I took away from it that despite all of the great expectations into that print, what we saw is the most important metric for numbers was the revenue growth from the cloud business. They came in at 82%. The street was at 65% year-on-year growth. Buy side was at 75%. So they beat all of those numbers. But it was definitely the fact that they said they were going to continue to invest massively on the CapEx side. So we're now looking at over $1 trillion for the hyperscalers being spent. And at some point, there's going to be the question that these big cash machines, which big tech has been for many, many years, are they now becoming industrialized companies, which therefore, over the long term, would naturally justify a lower multiple and probably lower growth. At the moment, the growth is fantastic, but can it be sustained?
How much do I need to start thinking about depreciation? And how much of what we just saw also came from the cross-ownerships that they also have?
There's definitely the elements of that structure. They've got a big piece of Anthropic, which is a great trade as an investor.
And they have some SpaceX as well.
They have some SpaceX. I'll reserve judgment on that one for the time being. But certainly, in terms of if we look at the outlook for now, in terms of going forward, I think they're pretty well positioned in terms of their overall platform. But we don't know which frontier models are going to survive. Now, one thing to be clear on is in every tech cycle, there's only really two winners. There's only really two platforms. And at the moment, we have many, many platforms out there. Meanwhile, the bond investors that are more important than equity investors with the CDS spreads of the hyperscalers blowing out, there are concerns building up on a wider basis, I think.
Neil, thanks very much. Bloomberg's Neil Campling with the latest on the tech sector, moving at pace, that particular story. We're watching the fiscal narrative around European bond markets as well. And with that in mind, let's listen once again to the Chancellor of the Exchequer here in the UK, John Healey. He's committed to disciplined control of Britain's public finances to protect against economic shocks, as he made his pro-business pitch to the City of London during a meeting at Bloomberg's European headquarters here in London.
Fiscal credibility is the bedrock of economic stability, just as it is of national security. And the Prime Minister and I have talked together about how we will work in lockstep to ensure that we meet our fiscal rules with a buffer against uncertainty.
The new Chancellor there. Let's bring in Skylar Montgomery-Koenig from our Markets Live team. Those words, we talked to Ian Seeley at JP Morgan. He was saying that that's what stood out to him. The commitment once again to the fiscal rules and the Chancellor doing it, not just the Prime Minister, so the Chancellor now also doing it, and also talking about a buffer, which seemed a newer bit of information there.
Yeah, I mean, it's very reassuring. I think for gilts right now, oil is a much bigger risk than what you're seeing from a fiscal standpoint. I'll make a couple points about why I just think we've largely moved on or should move on.
Yeah.
And that, you know, we've had a lot of fiscal scares in the last 2 years. The biggest one was the first one. It was Reeves' first budget. And you did get material gilt underperformance after that. But since then, you've priced in a risk premium related to politics. And I think because you have that buffer, you need pretty bad moves from a fiscal standpoint to feed negatively into the gilt market. And then the second point I'll make is it just very much seems like policymakers in the UK are standing down in that any comments that you've had from Burnham in terms of being in hawk to the bond market, et cetera, they've been walked back, and they're very respectful of that. And I think just, no one really wants another Liz Truss crisis on their hands. So that keeps the fiscal bit in line, and it means that you should really be focusing on oil.
OK, let's focus on oil. It's up by 7% over the last 2 days. I'll get you a number in terms of the last 4 days, in terms of the session we've seen this week. Oil's rocketing higher. Have we priced in already the full implications of if this process continues, you get to 100, you get beyond 100, where do the cracks start to appear?
I mean, we certainly can go higher from here, right? We've already seen higher prices. Yes, we have some mitigating factors. But at the start of the week, we knew that Hormuz shipping was essentially shut down. You had threats to oil infrastructure. That's very bad. And then on top of that, you have an additional threat to a choke point this week in that Iran-backed Houthis have threatened Saudi Arabian supply. Now, this is really important because that's one of your mitigating factors, right? Oil was going through the East-West pipeline, which has a capacity around 7 million barrels a day, and then through the Bab al-Mandab Strait. Now, if that is closed, yes, there's another route. You can go around the Cape of Good Hope, and that's a much longer route, though, and it means that if you're thinking about physical supply right now, where oil demand is relatively inelastic at the front, if you have more disruptions, you could see a rapidly higher price there if you're no longer able to go through that strait. And we've seen in 2023 that Houthis can certainly have a big impact there on oil flow.
Yeah, we're hearing from Marco Rubio, actually, just speaking to media over in the Philippines, I think. He's saying Iran will continue to pay every night the price gets higher, and oil prices are on the rise. As you've been pointing out, 97.53 is where we trade on Brent. Skylar Montgomery-Koenig from our Markets Live team, thank you very much for joining us. That is it for the opening trade this Thursday. The Pulse will continue to take you through a really busy morning here in Europe. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Alphabet raises its capital spending forecast to as much as $205 billion this year, reigniting concerns about the cost of AI. The Houthi militant group in Yemen says, well, they have targeted 2 oil tankers in the Red Sea, threatening to open another front in the Iran war. And John Healey, the new UK Chancellor, vows to meet fiscal rules with a buffer as he makes a pro-business pitch here to the City of London. Now, first thing is first, let's check on the markets, and there is quite a lot going on because we're looking at the German 10-year yield. There's also just a lot in terms of capex spending in AI, asking some of the questions for stocks. So stocks overall seems to be falling. A bit of unease again over these ever high AI investment outweighing another strong earnings report from Alphabet. So I'm looking at the outlook for higher spending. They does seem to be boosting some of the chip makers in Asia. For example, the South Korea Kospi index coming in at 4.4%, and then you can see the German 10-year yield 3.201, the 10-year in the UK 5.081. It is ECB day as well. Now, the look for European markets map, we're seeing quite a lot of red on the screen. When you look at the CAC 40, look, the FTSE 100 is pretty much unchanged. The CAC 40 and the DAX down between 0.4% and 0.7%. So Alphabet raised its capital spending forecast to as much as $205 billion this year. And pre-market, you can see Alphabet down some 2.5%. Tesla profit also tumbled despite a strong quarter for its automotive business. Tesla pre-market is down 4.4%. So let's guess what we're going to start with. It's all about AI. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Another busy morning. There could be a new front in the Iran war. We just heard from the new Chancellor, of course, of the Exchequer. We also will discuss in just a moment all of this with Demos Fotakis from Barclays. But first, CapEx has been the focus of the tech earnings overnight. Alphabet's increased spending plans, raising concerns that the company will forego fiscal discipline in the race to dominate AI. Let's get more with Matt Bloxham, technology analyst at Bloomberg Intelligence. Matt, I mean, it's all about earnings and it's all about tech earnings, especially focused on AI. So in addition to Alphabet, Tesla's AI ambitions are also coming at a cost. So how concerned are investors? There's just a lot of capital spending out there.
Yeah, I think the concern is definitely on the rise, particularly given the increased guidance from Google. I think if you put the capex story to one side, if you look at the Google numbers, they're actually pretty good. Slight beat on revenue, about 1%. Most of that coming from their cloud business, so selling capacity in the data centers. The core search advertising business holding up well, but slightly less growth than people expected. But what we're not seeing is like a big step change in the revenue to kind of go alongside that higher capex. If you look at their forward order book, it grew, but not massively. So they didn't bring in any other big orders beyond Anthropic. And so I think really for investors to feel confident that this capex increase is directly linked to incremental revenue opportunity, people wanted to see more in those numbers, and we didn't get it. And then that extends to the worry that, well, if Google's raising their capex, then Meta and Amazon are going to follow too, and you suddenly get into an incremental arms race, and it starts to kind of stretch the credibility of the return on capital story.
Matt, so this is without a doubt our number one focus, but then I'm looking at ST Micro shares, and they're actually also under pressure this morning. So did they disappoint investors?
Yeah, they did. I mean, there was a soft Q3 guide on revenue, not much below market expectations, but below, and then talking about making that up in Q4. But, I think people want to see it earlier rather than later. They slightly upgraded their outlook for revenue from data centers, so north of $1 billion this year and well north of $2 billion next year. But they'd kind of signaled that already. And I think given the positive momentum in AI, that's the least that people are expecting to see. The problem, I think, with ST Micro is that the profitability was way, way lower than people expected. And that's obviously a big part of the story, too, that input costs are rising across the sector. And that's something that all of these companies need to manage more effectively.
Matt, thank you so much. Terrific briefing, as always, to get us started. Matt Bloxham there from Bloomberg Intelligence. Now, oil extending its rally after Houthi militants say they're targeting 2 Saudi Arabian tankers in the Red Sea, reigniting fears that higher energy prices will stoke inflation and push central banks to hike rates. Now, I'm joined by Themos Fotakis, Global Head of FX Strategy and EM Macro Strategy at Barclays. Thank you for joining us, Themos. We'll get on to the AI in a second, because that's also pushing up inflation, probably at the margins. But what's your take on oil right now? If you look at the markets and actually inflation expectations, what are they most worried about?
I think that it's a combination of the fact that you have some pressures coming from the spending, particularly in the U.S., AI and all that, and this solid growth. The fact that you never really had a bond rally when oil prices dropped, partly because of the supply of fixed income, also from the private sector, but also from the public sector. And also inflation expectations not collapsing either. And now, on top of that, you have oil prices going back higher, which tells you that the dip that we saw in global inflation prints may be a little bit too technical, a little bit too temporary, which puts central banks in a difficult spot, because it's not just about the delta. It's also about the question that the central banks are asking us now: do we have rates at the right level for the current inflation activity?
And you think we do? I mean, in the U.S., they're not in a bad spot.
Yes and no. If you think that hyperscalers are going to be spending trillions for the next few years, that puts you in an output gap that is wider than what you thought last year. Last year we were expecting $300 billion of capex. Now we're expecting trillions, and that number keeps going up and over time. So you need to have some accounting for that. And obviously, if you have oil prices high but also volatile as well, because it's also possible that this situation in the Middle East is a stop-start situation that affects the volatility of inflation expectations.
And that could last for quarters, if not years,
Correct.
To come.
And given the starting point of inflation never really reached the target in the U.S., they might have to reconsider.
So, Themos, what do you say? So what do you see as the next move from the Fed?
I think that the risks are for a hike. And I think that, obviously, our call as a bank is flat for now, but we're acknowledging the risks for a hike. Now, the problem is that if they hike, they're unlikely to go once.
Right.
It wouldn't make sense as a calibration, right? You're not saying you're wrong for 25 bips. So if they do move in that direction, the market is not going to price one hike.
But the capex, I mean, again, the correlation between actually a hike and what that means for capex spending from AI is unclear to me.
It is unclear for now. From what we understand from our analysts, these issuers are price insensitive to some degree. Yeah. So, and to me, I think the bigger question with capex, with respect to the U.S. economy in general, is this: is this a higher cost for doing business in cloud space, let's just say, more generally? Or is this something that is going to create a transformative monopoly for the U.S.? Because it will be the only country that will have that kind of infrastructure.
Themos, talk to me a little bit about the UK. Now, we also caught up with the Chancellor, of course, the new Chancellor, John Healey, this morning at Bloomberg headquarters, and this is what he had to see. This was his message to the city.
Fiscal credibility is the bedrock of economic stability, just as it is of national security. And the Prime Minister and I have talked together about how we will work in lockstep to ensure that we meet our fiscal rules with a buffer against uncertainty.
Themos, this is clearly the Chancellor trying to reassure markets. In fact, his very own pick, the fact that it wasn't Ed Miliband but John Healey, points to the fact that they want to reassure the markets. But where do they find the money to do all the spending they want to do?
First of all, let me just start by saying that I think that the UK's public accounts take unnecessary negative critique. The situation is not too bad.
What, from bond investors?
From bond investors, yes. But the market sees that with that kind of an angle, and it is what it is, basically, right? And with that angle in mind from the market, I think that they're walking into a very difficult situation. Obviously, they need to have their market their way. I mean, this is the lesson that every single UK politician has learned since the Liz Truss situation. But I think that also every new prime minister that comes in, they have a lot of people to satisfy, a lot of different sides that have demands, basically, right? So inevitably, they'll have to give something, and they have to cost it, and they have to compensate for it. And that accounting is very difficult in the UK today.
So what would you, I mean, are you buying gilts at the moment?
Actually no. And in fact, we have a short recommendation in the pound, actually, having it traded a little bit too positively on the back of reassurances. As things get specified, might get a little bit murkier.
Yeah, we have a lot of questions. Themos Fourtakis from Barclays stays with us because we also talk about the ECB next, because the European, of course, central bank is widely expected to keep interest rates unchanged when it meets today. The decision would allow officials to buy time to weigh the implications of renewed fighting in the Middle East, leaving the door open for a move in September. Now, for more, we're joined by Bloomberg's Jana Randau, who's at the ECB headquarters in Frankfurt. Good morning, Jana. So nice to see you. So what are we expecting from today's meeting? And is this really an opportunity for the ECB to assess what happens in the next few months?
Good morning. Yes, it is. So we are not expecting a change in interest rates today, but we are keeping a very close ear to what the president has to say on the economic situation in the Eurozone, and even more importantly about the risks. Now, on the former, things had looked up really earlier this month. Inflation has come down much faster than expected. The economy was really holding up well, and then, of course, tensions escalated again in the Middle East. New attacks between the US and Iran, and that has basically thrown the ECB back to square one. So what we'll hear today is how they assess those risks and what they intend to do about it potentially in the future. We expect the president to throw it towards September when new staff projections will be available. They will be really, really key in deciding whether another hike is coming. Economists and traders, of course, expect one. And also in September, we may know a little more about whether the president herself will stay at the ECB. She keeps fanning rumors of an early resignation. She hasn't really said she's leaving. She also hasn't really convinced me that she's staying. So more on that, maybe even today as well.
Jana, thanks so much. Jana Randau there with the very latest from ECB headquarters, and we're back with Themos Fourtakis from Barclays. I mean, Themos, actually, so we'll get onto the ECB today in a second, but if you look at the difference in rates between the UK and the Eurozone, I mean, that goes back to our earlier question. Does it really make sense? I mean, I know the economies are in different cycles, their composition is different, but actually the rate differential is quite remarkable.
It is remarkable, and particularly if one contrasts it against growth. On the other hand, I have to say that ever since Brexit, the UK economy has been a lot more, has faced a lot stickier inflationary dynamics, basically, right? And if you are the Bank of England, you are facing a situation where inflation has overshot your forecast quite consistently. Yeah. And there are some voices, as we know, some of them I used to work with in the past, in the Bank of England, that say that regardless of what our path is and our path is, there's something we're missing that is making the economy a lot more inertial in terms of inflation. And that is an issue that is being compounded again with energy prices.
What do you think? I mean, what do you think that is? And again, is it something structural? You know, is it a structural concern?
My own sense is that with Brexit you get an inevitable supply shock, and that supply shock has also been to some degree moderated by some fiscal easing during COVID, and then some fiscal easing again at the beginning of this administration. So sort of like trying to address the pressures that you get to the supply side of the economy with a little bit of fiscal impetus, I think that generally tends to lead to stickier inflation dynamics.
Themos, overall, I mean, I'm going to ask you what you're expecting from the ECB, but actually, what's your favorite FX pairing at the moment? Because we also have Japan. There's just a lot going on, and we have renewed, maybe possibly trade concerns when it comes to the U.S. and China, and certainly the U.S. and Canada.
I have been on the side that has like the dollar, despite all the bad sort of like press it gets, and I do think that the dollar tends to do best against Asia at a time where yields are going higher, and dollar yen I think is likely to continue going basically. So that's where I'm looking at.
So interesting. Themos, thank you so much for being with us today. Themos Yotakis, Global Head of FX Strategy and EM Macro Strategy at Barclays. Coming up, UniCredit closes in on Germany's Commerzbank, plus a trading boom at BNP. All of the details on the latest European banking news, that's coming up next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. July 30th. The Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts July 30th, 12:30 p.m., only on Bloomberg.
Well, BNP Paribas has reported better than expected revenue and profit for the second quarter as its stock traders blew past expectations. Well, earlier we spoke to Lars Machenil, the chief financial officer at BNP Paribas.
We clocked in this quarter at 39 basis points compared to 38 a year ago. But if you look at the cost of risk in our divisions, it is basically stable. So intrinsically, with whatever that has been happening on the divisions, there is no pickup. It is stable. So what is that additional basis point coming from? It's because we took a prudent stand saying there is some geopolitical uncertainty, and that allows us to take a generic provision for that uncertainty. So that is a provision that we took. If at some point in time the geopolitical situation would deteriorate and there would be higher cost of risk, we would use this reserve that we have created this quarter.
And Lars, can I ask you about what's happening with the technology build-out, the frenzy around AI and data center rollout, and how we see that evidenced in the business that BNP Paribas does? We heard from somebody at Barclays yesterday who was talking about a golden age for technology right now. So many trends happening at the same time, and so many companies wanting to tap markets as a result. Is this something that you think is happening outside of European banking, or is European banking intrinsic to these developments?
You see demands a bit all over the world. If you go into Asia, the US, it is rather than the AI super cycle. If you go in Europe, there are also structural demands, infrastructure, energy. So there are a lot of investments that are happening. And so we see that pickup. And again, we, with what we have, both in the global markets, but also in the financing activities, and given our capital position, we are there to support. The one thing is, you know us, we are a bank, we are prudent, so we have to be, we see a lot of demand, but we have to be careful and to avoid that we would underwrite things that would make us think of what we saw back in 2002.
Well, that was Lars Machenil, the BNP Paribas CFO. Now, UniCredit has reported higher than expected profit and raised its guidance as Chief Executive Officer. Andrea Orcel moves closer to a takeover of Commerzbank. Let's bring in Bloomberg's EU finance reporter, Stephen Ahrens. Steve, thank you for joining us. Let's start with earnings. How good are this morning's UniCredit numbers?
They're pretty good. They beat on profit. They lifted the outlook. They announced new dividends. So, you know, from a market perspective, investment perspective in UniCredit, it's been pretty good, even though the shares are down a bit after a strong rally in the stock, and the industry as a whole is not doing very well today. But the earnings themselves are pretty good.
So, Steve, what more did we learn in this morning's announcements about the Commerzbank deal?
So that's actually the more interesting part today. As you probably know, the takeover bid for Commerzbank by UniCredit ended earlier this month, and they managed to get almost 50% in Commerzbank. So it's very likely they will assume control, and that's what they're saying in the release today. They're saying we're expecting to take control of Commerzbank once we get regulatory approvals, which may happen at the end of this year. And then they will set out, Orcel, the CEO, will then implement his vision for Commerzbank, which will entail a very deep restructuring of that German bank.
Steve, I mean, did you see a difference also in the tone from the German side? Are they more open to negotiating? Like, what can we actually expect in terms of timeline?
So it seems they are. We had this nice scoop recently where we say the German government is opening up. It's softening its rhetoric toward UniCredit. It used to be extremely opposed to the deal, but they're realizing the takeover is pretty much inevitable now, given the shares that UniCredit will own in Commerzbank. And so they're saying, okay, rather than just trying to stop the deal, we're going to try to influence the deal and sit down perhaps with UniCredit to debate what exactly we want for Commerzbank in the future once UniCredit controls it.
Stephen, thank you so much. As ever, Stephen Ahrens with the very latest on this banking news. Now, a court ruling allowing the far-right leader Marine Le Pen to run in next year's presidential election has raised alarm bells for bankers in Paris who relocated from London after the Brexit vote. Now, the expiration of the generous French tax breaks is also a concern for these bankers, with some now discussing relocating to cities like Dubai or Milan. Well, Bloomberg's Claudia Cohen has more on this story. Claudia, it's a great story, deeply researched. So let's start with these tax breaks. How important have they been in bringing bankers to Paris?
Hi, Francine. Thank you so much for having me. Well, the tax break was extremely important for Paris to appear attractive in the eyes of the US management. Let's recall that after Brexit, of course, all the international banks, the US banks, were looking for a new European headquarter. And Paris at that time, wasn't on top of the list because, as you know, the labor cost in France is quite expensive. But these tax breaks, which basically allow workers who are coming to Paris. So it's either foreign workers or either French workers who were living outside France for at least 5 years. They are getting a big tax break. It can be between 30% and 50% of the total revenue that is not taken into account when you do the tax-based calculus. So the tax break was extremely important. And as you mentioned, all the bankers, they knew from the beginning that this was this deadline because the tax break is for a maximum of 8 years. For the first bankers who came to Paris after the Brexit vote, so for example, Bank of America had the first transferees coming to Paris around 2018, 2019 for this first wave of bankers. The question is now, what do I do?
So, and how much of a factor then, Claudia, could France's presidential elections actually play in whether bank staff stay in Paris or France or leave?
It's a very important factor because, first of all, obviously, you have the personal thinking. If you have kids in school in Paris and you really love the city, you have all your professional network. Like, those are natural questions that we all knew those bankers will ask themselves. And now politics is in the mix more than ever because, as you probably saw, we realized those past few weeks that it will be Marine Le Pen will be the candidate for the far-right party in France. And Marine Le Pen is seen by the market, but by those bankers also, and broadly in the business community, as less business friendly, as her protege Jordan Bardella was. So the bankers are a bit worried, and also, and we pointed out in the story, the far left is having a big momentum also. So for the bankers, there is a bit of a scary story if the far right and the far left have chances to win the election, because it could be, a way less business-friendly environment, but also even more taxes coming for the wealthy.
So interesting, Claudia. Thank you so much. It's a really great piece, and I urge everyone to go and see it, and we'll also push it out on social media. Now, Alphabet raised its capital spending forecast to as much as $205 billion this year. So you can see Alphabet, let's see, pre-market trade, if we have that for you. Yep, down some 3.9%. Tesla profit also tumbled despite a strong quarter for its automotive business. So if you look at Tesla, that's also under a little bit of a pressure, and Tesla down 5.4%. So we'll have plenty more, of course, on that throughout the day. If you look at U.S. futures, the focus is definitely on AI and the AI spending. Some of the fears around that are growing. We're also looking at the continued rise in oil prices, casting a spell actually over markets after the Red Sea seems to now be becoming another flashpoint of disruptions to shipments from the Middle East. So we'll have plenty more on that shortly. We also got the view from Rachel Ellahus from the Royal United Services Institute. So that's coming up shortly. Stocks falling again because of all of this unease, with S&P futures down and NASDAQ also down as well. This is Bloomberg.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. Alphabet raises its capital spending forecast to as much as $205 billion this year, reigniting concerns about the cost of AI. John Healey, the new UK Chancellor, vows to meet fiscal rules with a buffer as he makes a pro-business pitch to the City of London. And the Houthi militant group in Yemen say they have targeted 2 oil tankers in the Red Sea, threatening to open another front in the Iran war. Now, staying with the developments in the Middle East, and the U.S. has completed 12 straight nights of attacks on Iran, with President Trump warning that the U.S. could target bridges and also power plants. Let's bring in Onur Ant, Bloomberg's managing editor for the Middle East and North Africa. So, Onur, thank you for being here. Is the conflict now bigger, and are peace negotiations further away?
Yeah, the conflict is definitely bigger. The Houthi attack that you just mentioned, Francine, opened a completely new front in this war that began in February. This is the first time that Houthis have struck or claimed strikes on oil tankers in the Red Sea in months, basically, and definitely the first time since the conflict began. And it risks the possibility that more oil flows will be removed from the markets, because Red Sea is where Saudi Arabia especially relied on to get its crude out after the effective closure of Hormuz after the Israeli and American bombings of Iran in February. As for peace talks, President Trump has repeated that Iran wants to have a deal with the U.S., and so did Marco Rubio, the U.S. Secretary of State, just minutes ago. But that's not the narrative coming out of Tehran. Iran insists that it is not in a rush, or it doesn't even want to talk to the U.S. For a possible deal until the U.S. stops violating the Memorandum of Understanding signed last month between the two countries.
Onur, the U.S. and Saudi Arabia have finalized their nuclear technology sharing deal. Will that exacerbate tensions across the region?
Possibly, maybe not in a very direct manner, but yes, because this deal, which has long been in the making, could allow Saudi Arabia to enrich uranium on its soil, and that contrasts with the stated objective of the U.S. War on Iran that's been going on for 5 months, which is to prevent Iran from acquiring nuclear weapons. So yes, it's not the same thing, but it raises the fears that once you allow a country in the Middle East to have nuclear enrichment on its soil, it could spur a race for similar deals by other countries in the region. We know that Egypt and Turkey Turkey have similar ambitions, and eventually it could spur a race for nuclear arms. U.S. officials, including the Secretary of Energy, has stated that there are very strong safeguards to prevent such an eventuality, but still lawmakers in the U.S., including members of the Congress, do argue that this is a real risk down the road should the U.S. go ahead and allow Saudi Arabia to enrich uranium on its soil.
Honor, thanks so much. Honor Anther, Bloomberg's managing editor for the Middle East and North Africa. Now, for more analysis, let's bring in Rachel Ella, who's a Director General at the Royal United Services Institute. Rachel, always great to speak to you, especially on a week where we're trying to figure out what happens next, because there does seem to be, I guess, wars or certainly skirmishes on more fronts. Does that mean that there's a clear escalation, that the situation is much more dangerous?
It certainly feels like it, and from my view, I think a definitive resolution to this conflict is unlikely, and what we're likely to see is probably periods of escalation followed by periods of de-escalation, so just persistent instability in the region. That MOU and the ceasefire that we saw, that was just a pause. That wasn't a complete resolution, and a lot of the details that would have made it such were left on the table so that both sides could read into it what they wanted. The Houthis could see, the Iranians could see an opening by which they might get sanctions relief or seen some of the assets unfrozen, and the United States could assure shipping companies and firms that they could get through the strait.
But having now the Houthis involved, like what does that mean going forward?
Yes, we have the Houthis involved. They're putting pressure on the Red Sea, directly confronting Saudi Arabia. The other thing that I'm noticing is ships had been trying to pass close to the territorial waters of Oman, and there are strikes there as well. And so I think what the Iranians are saying to the region is that we've got partners in the region as well, and we can continue to exert pressure not just on Bahrain and Kuwait and Jordan, but also open that to Oman and Saudi Arabia, who at one point had been slightly more sympathetic to the Iranian cause.
But so this could last years with a kind of like a stop and start, because what is also surprising is that on either side you don't really see, or maybe I'm reading it wrong, but you don't see a wanting of clear de-escalation.
I don't think either side wants all-out war. I mean, let's think about that. The Iranians really do need cash. They do need that sanctions relief that we just talked about. Yeah. And on the U.S. side, I think Secretary of War Pete Hegseth said this war has cost over $35 billion to the United States so far, and then we still have all the problems with rebuilding readiness in the U.S. forces, replenishing those capabilities, rebuilding bases that have been struck, rebuilding bases that have been struck. The U.S. is also under tremendous pressure. But what brings them to the table? I think that we're probably going to have to accept some change in the status quo. Yeah. The Iranians have been pushing for monetary payment for safe passage through the strait. Nobody wants that, but I fail to see that strikes alone can bring this to conclusion.
Does the U.S., I mean, there's two things that could bring, I guess, President Trump to change tack. Does he need to ask Congress for the money now?
Well, he does, and that's what Hegseth was up making the case for a few days ago. And certainly every time the administration goes and asks for money for a war, which they see as a war of choice, that's taking away from other domestic priorities, as well as international priorities, like focusing more on the Indo-Pacific and the long-term challenge from China. So this war is not popular. So far, he's been able to keep the Republicans on side and get through that increased budgetary support. But U.S. national debt skyrocketing. This comes at a price somewhere.
I mean, do we assume that in the lead up to the midterms, it de-escalates?
I would hope so. I think that we've probably got a couple more weeks of strikes ahead of us to degrade those Iranian capabilities and maybe even some of the Houthi capabilities. But we are likely to see, again, a period of de-escalation just before the midterms to try to claim victory, at least at a surface level, and stabilize things. But again, no guarantee that this resolves the problem.
Rachel, how strong actually is the Iranian regime right now?
I think they're quite split. I think we see two camps. We see one side that's open to engagement and wants a resolution to this conflict. We see another side, the hardliners led by the IRGC, that really say the time is over for negotiation and we can't trust the United States. And so with that limited space for engagement. What I'm worried about is it shuts down, and what we get is a victory for the hardliners who don't want dialogue and don't want a solution, and then we get a more isolated and dangerous Iran.
But if you're the UAE, if you're Kuwait, if you're in Saudi Arabia, you can't really stay in the spot. So what are they? How are they going to organize themselves?
Yes, well, right now I think we see them getting more involved on their own. Oman in particular had painted itself as quite neutral and staying out of the conflict. We've now seen them stepping forward to take some action to defend their assets in the south. I think Saudi Arabia is drawing closer to the United States. You just mentioned the long-term civil nuclear deal. So while they're unhappy with the U.S. behavior in the region and the fact that there's this instability that they didn't invite as a result of the Iran conflict, they still realize that the best path towards resolution and security is keeping the United States engaged in the region.
Is China actually getting more involved or trying to get more involved to try and calm things down?
I think China will have to get more involved because a lot of the oil that was leaving through the Red Sea route was going to Asian markets. And so China is going to see, despite its clever stockpiling and resilience in terms of energy and gas, that will run out at some point. So I think it needs to at least show that it is also very concerned about what's going on.
I mean, we'll, of course, have the war in Ukraine, and then there's a lot of question marks about what China will do with Taiwan. I mean, the more the Middle East is uncertain, does that make it more likely of other things blowing up in other parts of the world?
Well, it does. I mean, you know, I think just from a military perspective, it's difficult to sustain support for Ukraine and to support them economically when the United States and other allies and partners are squeezed elsewhere. We heard John Healey talking about increasing defense spending, but if the cost of energy is going up and all the components that are going into it become more expensive, it's really hard to deliver on that promise.
We also heard from the new Prime Minister, Andy Burnham, and it's very early days, but actually almost, opening more cooperation with the U.S. by offering them the use of certain bases. Will that change compared to what we've seen from European allies?
Well, I think Prime Minister Burnham's gotten off to a very pragmatic start. It was a good choice to appoint John Healey as Chancellor. Given his history as the Minister of Defense, it sent a very positive signal that this government is serious about what they say on that link between economic security and national security. And so if anybody knows where the bodies are buried and how to deliver on defense spending, it's John Healey, given his past in the Ministry of Defense. But, you know, I think it remains to be seen. There are a lot of pressures. Prime Minister Burnham has also said he's focused on delivering for people in the regions and has really linked defense spending and national security to more domestic priorities like creating jobs and economic growth and investment. So I think we can expect to see a relative focus on the United Kingdom's near abroad, so that NATO first policy that we saw in the Strategic Defense Review, probably see a doubling down on commitments with countries like Norway and Denmark, where there are defense industrial returns on both sides. And we might see a little bit in the Indo-Pacific, but I expect to focus on the regions in and around the UK that have an economic kickback.
Rachel, I mean, we're also hearing, Ukraine has been hitting Putin's economy on retail giants, like kind of the Russian Amazon. Is this a change in tactic, or how are you seeing that develop, especially as Zelensky also bowed to the protesters and had to remove someone that he put in office a short time ago?
Yeah. Well, I think it's continued pressure in the same direction. Ukraine is really upping the game to pressure Russia, not just on the battlefield, but economically, and make the cost of doing business more expensive. I think Russia is under tremendous pressure, both tactically on the battlefield and economically. Tactically, we're seeing that not only are they not gaining new territory, they're failing to hold areas that they once occupied. Yeah. And economically, almost zero growth, increasing inflation, a degradation in the reserves in the sovereign wealth fund. And if the Ukrainians and their allies continue to push on both fronts, both on the battlefield and economically, to target those refineries, to target those warehouses, to create more focused sanctions that limit Russia's ability to get that oil and gas out, that I think will only increase the momentum that Ukraine already has in this conflict.
So do they really have a tactical advantage? I mean, something that was really kind of unthinkable 2 years ago.
It's difficult. I mean, I think every kilometer is fought hard on each side, and ultimately there will have to be a political solution, and this will not be decided on the battlefield. But certainly the Ukrainians are better trained. They've learned from the Russian doctrine and tactics, and they're responding. They have long-term economic support that was signaled at the NATO summit a few weeks ago. I think they're in a strong position.
Thank you so much, as ever, for joining us. Rachel Elohus, there, Director General at the Royal United Services Institute. Now, John Healey, the new UK Chancellor, has vowed to meet fiscal rules with a buffer. He's been making a pro-business pitch here in the City of London this morning as he spoke to senior business leaders at Bloomberg.
First, fiscal discipline. Fiscal credibility is the bedrock of economic stability, just as it is of national security. And the Prime Minister and I have talked together about how we will work in lockstep to ensure that we meet our fiscal rules with a buffer against uncertainty. Second, growth in every postcode. With every government department being a growth department, making the fullest possible use of public investment within our fiscal framework and bringing private and international investment capital to back Britain. Third, backing Britain. Buying British as a government at all levels, not just if possible, but by design, so that every procurement pound in Britain works to support British jobs, British apprenticeships, British skills, and British innovation. In transport, in energy, in AI, in tech, in defence. Fourth, driving wealth creation. I want government decisions to raise the levels of investment, of innovation, of confidence, and of profit in British-based businesses. And I want Britain, just as I argued in defence, to become the best place in the world for those with ideas who want to start and grow a business. And fifth, to make life more affordable, bringing down the cost of living, but also the cost of doing business, helping to give people a greater control over their lives again.
Well, that is, of course, the new UK Chancellor, John Healey, speaking here at Bloomberg just 72 hours after his appointment. Now, Bloomberg has also learned that OpenAI's advanced AI models completed an attack in hours that would normally take a skilled hacker several weeks in the incident which breached the internal systems of AI startup Hugging Face. Now, OpenAI said it notified law enforcement and other authorities and has been transparent about its findings. Bloomberg opinion columnist Parmi Olsen has been researching the next generation of AI models and has described some recent breakthroughs as genuinely scary. Now, she's written about the development of AI in her book, Supremacy AI, ChatGPT, and the race that will change the world. And Parmi is here now. Parmi, thank you for joining us. I mean, I love the book. I also loved, I read all of your columns. And basically, you're talking about the fact that recursive self-improvement is something that you're worried about. So talk to us about some of the models that you've been looking at.
Yeah, so, and this ties in a little bit with the OpenAI Hugging Face hack. But essentially, a lot of AI labs, the top labs from Anthropic, OpenAI, Google, and then a raft of new startups are investing billions of dollars into building AI that builds itself. Right. So you don't even need the researchers necessarily in the loop. You know, and Anthropic has said, look, we've got our AI tool that's writing most of our code now. Humans are actually becoming the bottleneck in the process of building software. And so there's now this new kind of race, a race within the AI race, to build what they call recursive self-improving AI systems that improve themselves. And some say this could be great for scientific discovery. Mm-hmm. And of course, if you're a big AI company, that wants to make a lot of money. You've got an IPO coming up. You want to show you've got this new technology that's really going to keep you on the frontier.
But is it going to generate revenue, or is it just a race to be first?
It's a bit of both. I think the idea is the more powerful and capable your model is, provided it's also safe and can be properly regulated and overseen, then yes, it could bring in revenue depending on who your clients end up being.
Where do you see the latest AI risks, given this news that was shocking to many about the OpenAI hacking Hugging Face?
Well, so absolutely. So on the topic of the self-improving AI, when I spoke to executives who are building this technology, they said not to worry too much, because I was worried. And I was saying, well, what about if it spins out of control? And they said, well, we're building it in a sandboxed environment. And a sandbox is a very jargony tech term that refers to a kind of a digital boundaries put around software. It's just more software to keep other software from kind of leaking out onto the internet. Now, what we found out yesterday and the day before was that OpenAI was testing the cyber capabilities of its latest model, and that model did break out of its sandbox. Because, again, these are essentially lock pickers. These models are becoming so sophisticated, and sandboxes, these digital walls, have bugs. They have vulnerabilities. So they managed to get out. They took a step-by-step approach to find more vulnerabilities, and they did get onto the internet. Now, the key here is this wasn't the AI going rogue because it wanted to wreak havoc. It literally just wanted to fulfill the objective it was given, to carry out a test and get a good grade. And the way it did that is going to go to the website that had all the answers, broke in and got them, but in the process completely freaked out its engineers.
So, I mean, with the freaking out, so I guess a good thing is that actually they were very transparent about it. I mean, they said
yes and no. Okay. They were transparent about it. Yes, that's encouraging that OpenAI fessed up. And I say fessed up because actually last week was when we first heard about it from Hugging Face. Hugging Face was the French company, the AI model repository that said, we've been breached. We know it's a frontier model, but we don't know who. And then OpenAI a few days later finally said, okay, it was us. We're collaborating with Hugging Face. The thing OpenAI hasn't said is, did they actually tell the AI models, do not hack to try and get your answer and to fulfill the objective? And that would be really interesting to know, because if they did say that, then that is a real kind of unsettling example of misalignment where the AI model has gone directly against what the human creators told it not to do.
But pardon me, and we've had this debate before that not everyone, they're not only good actors in this. So does this show, I mean, if this can happen with supposedly someone that's a good actor, what does it tell us about the bad actors?
Well, first of all, how do we even define good actors and bad actors? But to your point, Anthropic actually really focuses on that. They had a blog post earlier this month on AI that builds itself. And they kind of acknowledge that this is a potentially risky place to be putting their research. But they said, better that, and I'm kind of summarizing their words, but better that we focus on this. We can't pause it. We can't slow down, because less cautious actors, and they don't name names, but less cautious actors could catch up and could end up pursuing this research in a more dangerous way. So long as these large AI companies see themselves as the good guys, which they do, and they sort of have to financially, I suppose you could say, they will continue to pursue this research and run at it at speed, whether it's cyber AI systems that can hack out of their own sandboxes, AI systems that can self-improve, all this rather unsettling stuff, because they are caught up in these race dynamics, and there's no one telling them to slow down.
Okay, Parmi, thank you so much. I have a million more questions. We'll get you back on with you soon. Bloomberg opinion columnist Parmi Olson. Coming up, EasyJet profit takes a hit as the conflict in the Gulf increases fuel costs and puts people off traveling. We'll have plenty more on that next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Two things happening simultaneously when I started as a CEO. The first was aerospace industry started growing, and at the same time ChatGPT came in and AI started becoming an important conversation. I always felt that we need to simplify. Aerospace has a huge growth potential in front of it. Automation business have a huge growth potential in front of it with AI. And when we did the work, we found that each company can stand on its own feet with these growth vectors, which went toward this decision.
Vimal Kapoor there, the Honeywell chief executive, on why he chose to split the conglomerate into three parts. The company reports earnings later today, and of course you can listen to the full episode wherever you get your podcasts. Now, EasyJet shares surging after reporting third quarter results broadly in line. The rebound comes after the British airline fell the most in 4 years yesterday on a report that the EU may review its airline ownership rules. Let's get more from Sid Phillip, Bloomberg's global aviation correspondent. So, Sid, hey, it's great to have you here. You're here for Farnborough, but how is the outlook actually, going in the next quarter?
So for EasyJet, they're looking at obviously see how they can sort of get their business going. I mean, they're trying to see, in Europe, the airline industry has been harder hit than the US, where airlines having to see later bookings. They're having a sort of, people are sort of balking at paying higher fares, whereas in the US, business seems to be booming, especially for the carriers like Delta and United. So EasyJet's talking about how they're seeing bookings closer in. They're seeing bookings that are closer into the date of travel, but they are also seeing low double-digit bookings growth in their holiday business, and so that's been driving a lot of their profitability and future outlook. At the same time, obviously, the carriers are still at the mercy of customers who are sort of holding off on paying higher prices, and then they have much higher oil prices, so they have to sort of find a way to bridge that gap between much higher costs and yields that may not be as high as they would like them to be.
So there are also reports that the EU may review its airline ownership rules. What does that mean for EasyJet?
So for EasyJet, I mean, which is in the midst of a bidding war between two US private equity firms, Castle Lake and Apollo, EasyJet is caught in the middle of that, and there is concern from investors that the EU might sort of look at it and say, hey, EU ownership rules demand that majority control of an airline is by an EU individual or EU firm, and so they may determine that these US PE firms, which have talked about how they plan to get around the EU rules using some European executives, may not actually be able to get those deals through European approvals, and that might sort of scupper those deals, and then EasyJet's back to where it started from.
So interesting, Sid. Thank you so much. It's nice having you here for the Farnborough Air Show. Sid Phillip with the very latest on EasyJet and some of the airlines here in Europe with renewed interest from the US. Up next, it's Bloomberg Brief, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
In New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. AI spending jitters. Stocks tumble as Alphabet's boost in cap spending targets levels leaves investors unsettled. Those concerns now playing out at Tesla with the firm's first cash burn in 2 years. Intel results up next. And mounting supply risks. Oil extends its rally as Houthis target ships in the Red Sea, and the US and Iran continue exchanging strikes. Let's get a check on markets around the world now. We'll start with Winnie Su in Hong Kong for the latest from Asia. Winnie.
Good morning, Bonnie. It's actually quite interesting to see that divergence when it comes to the reaction towards Alphabet's spending plans, especially between the U.S. and Asia. At least here in our region, there seems to be a bit more excitement towards how the spending plans can potentially be able to trickle down into benefiting the supply chain here in the region. We are seeing SK Hynix here leading gains in Asia, given that more than 7% of its revenue actually comes from Alphabet. And we're also seeing gains when it comes to Japanese equipment makers, given that they also would benefit from this supply chain. Now, flip the board and take a look at the broader Asia market. We are seeing MSCI Asia here extending gains for a third day. It's the longest of such streak in about a month. Leading gains today, we have South Korea's Kospi Index. We are seeing foreign investors stepping in to buy, and that is also helping the Korean won to outperform the broader Asian peers. Now, also supporting the Korean won, we have tailwinds from the better than expected GDP numbers that is boosting bets for a rate hike. When it comes to Japanese yen, on the contrary, we are seeing that continue to weaken past that 163 level against the dollar.
Winnie, thank you so much. Winnie Su there in Hong Kong. Now for a look at Europe, and we'll start again with Brent because we're above $97 a barrel now, continuing to creep ever higher. The Houthis have formally opened a second front in the war. They had stopped disrupting shipping way back in May of last year, and now that has restarted again. So it's definitely putting pressure on crude. European gas futures too, holding at the 62 euros per megawatt hour level. Storage had been depleted and is restocking very, very slowly at the moment. moment. We're only just about 50% on storage. At this time of the year, you would normally be at about 70%. And the two-year yield up about 4 basis points. They're up across the board, across Europe. In the UK, though, we are getting some policies from the new leadership. So we had the new Chancellor, John Healey, speaking at Bloomberg World Headquarters in London, in fact, and talking about fiscal responsibility. He wants to bring fiscal credibility back to these markets and to the UK picture, but also cutting taxes. So, for example, 20% tax cut for many hospitality businesses. You see the stocks Europe 600 lower today. This is, of course, a follow-on from the chip story, but also earnings just generally in Europe, putting a little bit of a downspin on markets across the region. Waiting on the ECB, of course, the euro holding water around 114.13 and gold coming off just a little bit. Let's take a look at the US picture because we're down, but not as much as we were. In fact, we've come back quite substantially since an hour or two ago. Nasdaq futures are pointed lower. We'll see how the tech trade changes that today. And then if we flip up the boards and look at yields, we're still elevated. We had a 20-year auction yesterday that had the highest yield, the second highest yield since its reopening in 2020, and you can see that fear magnified really across yields today. The two-year yield is at 4.31, really pricing in the potential for a rate hike and two by early next year, and that 30-year yield is at 5.16 and change at this point. Now it's been above 5% for 27 days this year. Let's get to some individual market movers now. For that, we'll go back over to London and Chloe Melly.
Good morning, Bonnie. We've got Alphabet shares in the red this morning in pre-market trading as higher AI spending is overshadowing what was otherwise a pretty strong print. And so we have got this CapEx outlook coming in ahead of expectations and really fueling those investor fears around just how much those hyperscalers are spending on AI and whether those huge investments are still justified. We've got a very similar story actually for Tesla, which is also in the red this morning in pre-market trading. We are down more than 5% as this higher spending on physical AI is eating into profits and could take a while to actually translate into a meaningful revenue and earnings, according to some analysts. So we're seeing some weakness there as well. And finally, the casino operator Las Vegas Sands is also down this morning after missing analyst estimates. Now we're back up, but it was down earlier after missing analyst estimates and blaming the World Cup and the interest in the World Cup for those fewer visits at casinos. And so we were down, now we're slightly up this morning for the casino operator.
All right, ripple effects that you wouldn't even think of. Chloe, thank you so much. Chloe Melly there in London. She'll be back later in the hour. And also coming up this hour, we'll speak with Stephanie Roth of Wolf Research on the Fed's rate path and, of course, this morning's ECB announcements. Shares of Alphabet lower after it increased its spending forecast to as much as $205 billion this year, renewing investor concerns about the cost of AI. Joining us now is Matt Bloxham of Bloomberg Intelligence. We were anticipating this, Matt. Would the market have been disappointed either way if it hadn't, or indeed, as we saw, it did?
Yeah, probably. The market does seem pretty fickle right now, particularly on the AI story. Yeah, and I think as much as this was anticipated, I think the disappointment to some degree is that there wasn't a more robust beat on the revenue side to kind of go with it. And so I think you're kind of getting a growing disconnect or anxiety about the visibility of the return on that investment. And the company talked in kind of broad terms around this, but I think it kind of left people with a lot of unanswered questions. I think obviously the revenue growth was good, particularly in the cloud business. The ad sales business was a bit soft. I think perhaps where some of the disappointment may have been was in the growth in the order book, the pipeline of incremental demand they've got coming through, which grew quarter on quarter, but not spectacularly so. And I think so that kind of leaves this bigger disconnect between how quickly they can generate a return on that incremental capital spending, and will it be a big enough return?
And then, of course, we have IBM and ST Micro both cutting their outlook, Matt.
That's right. So I think the IBM cut was largely anticipated, and this reflects lower demand for their mainframe computers in the second quarter, with the company saying that clients are basically temporarily shifting their budgets to other technology. So I think the market remains unsure about how quickly, if at all, that demand is going to come back. STM, I think, spooked people quite a bit more. the Q3 revenue guide was below market expectations, but I think more than that, the profitability they announced for Q2 was much softer than expected. So I think that combination was really what's kind of taken the heat out of those shares.
Yeah, it's a very strange earnings season so far. I guess we'll see what the other hyperscalers say and also the software makers. Matt, can I ask you also about these open AI models that are spending hours on hacking something that usually takes weeks? Is this something that, we should be not surprised by because that's what AI does, or is it troubling?
Yeah, I don't think we should be surprised because, as you said, that is the whole point of AI. But I think it is troubling because it does take the whole cybersecurity domain into a completely new level and is going to make demands of companies that they're perhaps not prepared or capable of matching right now. I think what was also interesting was some of the comments we heard today from Hugging Face about the extent they had to go to defend against this attack. They tried their traditional AI models, but the guardrails that are in place to prevent those from getting involved in cybersecurity limited their effectiveness. So they had to divert to a Chinese model to kind of help them manage the attack. And I think that's going to be concerning to the US administration.
All right, Matt, thank you so much. Matt Bloxham there of Bloomberg Intelligence. Supply risks rising as geopolitical tensions mount and oil continues its rally. The Houthis say they targeted 2 Saudi Arabian-flagged oil tankers in the Red Sea, opening a whole new front in the war. U.S. Secretary of State Marco Rubio telling reporters this morning that he hopes the Houthis will stop. Rubio also saying that Iran is, quote, begging the U.S. to make a deal as the sides exchange a 12th day of strikes. Bloomberg's Owner Ant joins us from Dubai. Well, I think we can hope that the Houthis stop, Owner, but why should they? What's in it for them to stop at this point? They've restarted something that was dormant for more than a year.
That's true. Yes, that's what Secretary of State Marco Rubio said, but there's no reason to believe why they would suddenly stop just because the U.S. would like them to do so. Their attack on Saudi tankers earlier today were the first that they carried out since at least May of last year, which is when they brought their broader attacks on shipping in Red Sea to an end after starting them more than a year before that, after the Israeli campaign on Gaza. This is especially important because it practically puts at risk exports from an alternative route out of the region that we saw emerged after the Strait of Hormuz came to a standstill following the U.S. and Israeli attacks on Iran in February 2026. And it especially puts at risk Saudi crude exports from the region because Red Sea ports, especially Yanbu, is where Saudi Arabia was diverting most of its crude oil exports, which reached about 4.5 million barrels a day on average in June, which was the highest on record. After what happened overnight into Thursday, it remains to be seen whether Saudi Arabia will continue or will be able to continue to export via the Red Sea, but it looks increasingly difficult given what the Houthis have done.
And then, of course, there's this nuclear deal that the US and Saudi are coming to terms with. Is there a concern that Saudi will enrich uranium?
Yes, there is indeed, and that's the gist of, or that's at the heart of the criticism that this deal is facing, especially in the US on Capitol Hill. According to the Wall Street Journal earlier this week, this deal could allow Saudi Arabia to enrich uranium domestically. That's problematic for a couple of reasons as far as US lawmakers are concerned. One, obviously, the primary objective of the war in Iran was to prevent the Islamic Republic from developing a nuclear weapon. Now, allowing another country in the Middle East to have domestic nuclear enrichment, that kind of becomes or risks becoming an inconsistent policy step. And secondly, at least according to US lawmakers, is that if the US goes down this road and allows a country in the Middle East to enrich uranium domestically, then it will or it could spur a race for similar deals by other countries in the region and eventually a race for nuclear proliferation, which is what is causing concern among US senators.
All right, Owner, thank you so much. That is Bloomberg's Owner Ant in Dubai. In Washington, D.C., Bloomberg learning that the Trump administration and its allies are discussing whether a review of the failure of Silicon Valley Bank in 2023 could provide a legal basis to remove Fed Governor Michael Barr from the central bank's board. Let's get more with Bloomberg's Alistair Bull. So a new front in the Fed war as well, it would appear, Alistair. I mean, Michael Barr stepped down from his role as Vice Chair for Supervision precisely because he didn't want to butt heads with the administration, but it seems that wasn't enough.
No, well, I think we'd been warned in advance that the Trump administration was looking at other ways of getting governors off the board. Now, the Supreme Court ruling a few weeks ago seemed to raise the threshold for removing somebody for cause. And it looks like from our reporting that they're now examining the Barr situation around SVB to see if that provides sufficient runway for them to take a go at having him removed. Now, there's two things going on here. There's can they win in court, or can they just through attrition make his life so miserable that he'll consider resigning? Vonnie.
He has serious concerns, Alistair, about the rollback of some of banking oversight, for example. Are they warranted, those concerns?
It depends where you sit. I mean, from the position of the Biden administration and the Democrats, those concerns are definitely warranted because they're rolling back the Dodd-Frank regulations put in place following the collapse and the catastrophe of the 2008 financial crisis, which hurt an awful lot of people, including on Main Street. But the Trump administration has taken a more laissez-faire approach to these things, and backed by their friends in the banking industry, they're very keen to do that. And Mickey Bowman, who's now in the role of Vice Chair for Supervision, has been pushing forward. So we don't quite know where new Chair Kevin Warsh comes down on this, but I mean he's really focusing on monetary policy at the moment. But I think we sort of anticipate he's going to fall closer to the Trump administration and Mickey Bowman's vision of a slightly lighter touch around regulation. Vonnie.
Alistair, thank you so much for all that context. That is Bloomberg's Alistair Bull. Now to other top stories trending on the terminal this morning. SK Hynix has capped the amount of its South Korea-listed shares that can be turned into ADRs at 2.5%. The limit is said to be fully used up already. This means investors can't turn Seoul-listed shares into ADRs unless existing ADR holders convert their U.S.-traded receipts back into Korean shares. SK Hynix did not respond to a request for comment. BNP Paribas' second quarter results blew past analyst estimates. Its equities revenue rose 43% from a year ago to $1.6 billion. The CFO spoke to Bloomberg.
All engines are firing. The demand, probably related to the super cycle that we see, has been stronger, both in the US and in Asia, but it has been strong overall. And as we are present in all of those domains, and we have the capital, the liquidity, the leverage to do so, we are there to accompany that demand.
And UniCredit CEO Andrea Orcel provided more details on how he plans to reshape Commerzbank as he prepares to take control of the bank. This includes cutting back its international network and focusing on its home market and also Poland. Regulatory approvals for the takeover bid could come as early as the fourth quarter. Coming up, Tesla posts its first cash burn in 2 years. That's next. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Key key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ola, Saudi Arabia, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We should be spending on CapEx as fast as we can spend, as fast as we can, without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much so capital efficiency versus time.
Tesla taking a hit in pre-market trading as a $5.8 billion spending in the second quarter resulted in the firm's first cash burn in 2 years. For more, Bloomberg's Eric Foner joins us now. It seems that efficient capital expenditure is the theme for earnings season, but investors didn't seem to care about that when it came to Tesla before. Why do they suddenly now, Eric?
Yeah, well, as usual with Tesla, there's a whole lot going on here in their report. I think that with the capital spending, I think the big question here is still how much of a result will it bring? He's talked a lot about, manufacturing the humanoid robots, the expansion of the cybercab business, robo-taxis, all these things, but they aren't yielding that much revenue yet. So, there's a massive amount of capital spending going on, but not necessarily delivering results that people can see. And meanwhile, there's questions about, the traditional business, the car making business, even though it had a pretty strong quarter.
So is Elon Musk concerned, and will he do something about it, or is he just not concerned about something like that?
Well, in the short term, he's spending a lot of money. They're going to have to ramp it up even more to get to the goals he's talked about, $25 billion for the year. Obviously moving toward more of an AI framework. So that means a lot more spending. He was also, he was asked about the speculation about a merger with SpaceX to, maybe fulfill some of those ambitions. Kind of danced around that a little bit. No firm comments. He said, an earnings call isn't the time to talk about that, but clearly something that he's dancing around.
Moving to Europe, Daimler has raised its outlook on an improving U.S. business climate for its truck business. What's going on here, Eric? Is the U.S. just growing much better than we expected?
Yeah, this is really all about tariffs, right? And the Trump tariffs, which hit them hard, along with a lot of the other European manufacturers of cars and trucks. The 25% tariffs there were hitting them really hard. But Daimler says they've got a favorable ruling from the U.S. on their local content rules, content inclusion in their trucks, because they do a lot of manufacturing in North America. And so that's caused them to raise a lot of the guidance on a whole series of metrics. So it's really all about that, improving their sales outlook, for the Freightliner trucks that they make.
All right, Eric, thank you so much. That is Bloomberg's Eric Foner. Coming up, your front page news. This is Bloomberg.
my old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football. And you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, the New York Times reporting House Republicans won narrow approval of their $95 billion budget plan for the Iran war. The plan faces an uphill battle in the Senate, with a number of Republican senators questioning the plan's viability. Next up, the Washington Post is reporting the Trump administration is weighing military options in Mali to target an al-Qaeda-affiliated group. The group is the most well-armed militant group in West Africa. The Post says if military action is approved, it would add an 8th nation to the list of countries where President Donald Trump has ordered strikes since the start of his second term. And the Financial Times reporting that Japan's participation in a $40 billion nuclear power plant in the United States has hit a roadblock. The FT says Japan is concerned it might have to assume liability in the event of any meltdown or accident on American soil. The project was agreed on as part of Tokyo's commitment to invest $550 billion in the United States. Let's take a look at markets as we head into the Thursday session and after Alphabet earnings. Also, as the Houthis up the front in the war to a second territory now. Nasdaq 100 futures are lower, much off their lows of the day. The dollar index unchanged, and that 30-year yield slightly concerning. 27 days now, it's been above 5% this year, and a 20-year auction was just a little weak yesterday. Coming up, Stephanie Roth of Wolf Research on the Fed's path ahead.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City and 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. AI spending jitters. Futures pointed a little lower now as Alphabet's boost in capital spending target leaves investors unsettled. Those concerns now playing out at Tesla with the firm's first cash burn in 2 years. Intel results up next. Mounting supply risks. Oil extending rally as Houthis targets ships in the Red Sea and the US and Iran continue exchanging strikes. All right, let's take a look at these markets then. We're well off our lows. Nasdaq 100 futures down about 1/3%, but that was much further in the red a little bit earlier on. This even as Brent crude continues to rise. We're almost at $99 a barrel now, and WTI has cracked that $90 a barrel mark. The Houthis targeting 2 ships in the Red Sea. They'd been dormant on that front since May of 2025 after they stopped basically those attacks, which were in that case targeting Israel and its actions on Gaza. In this case, it's very clearly about something different, and they have now made the shipping situation so much worse. Let's move on to our second board because we have yields as well also creeping ever higher. The 2-year yield is now at 431.50. That's quite the extension from yesterday. The 30-year yield very close to 517, and an auction of 20-year notes yesterday which really proved there was weak demand. I also wanted to point to the yen, which continues to be firmly above 163. Let's get to some individual movers now. Here's Chloe Melly.
Good morning, Vonnie. We are seeing Alphabet shares down almost 4% this morning after the company boosted its spending target once again. And so this is, of course, fueling those investor fears, those existing fears around this AI expenditure, this potential lack of fiscal discipline from those hyperscalers when it comes to those massive AI investments. So we're seeing definitely some weakness there. We are seeing a very similar story playing out for Tesla, which is also down this morning, also in the red after missing analyst estimates, and in particular there was higher spending on physical AI, which is actually eating into profits, and analysts are saying that it might take a little while for this higher spending to actually translate into meaningful revenue and profit acceleration for the company. And finally, let's go over to one last tech stock, and that is STMicro over here in Europe. The chip maker has provided an earnings outlook for the third quarter, which was seen as a little bit disappointing. This is more due to persistent weakness in end markets like the automotive end market and the consumer electronics end market, rather than the data center business, which is actually doing very well. But we are seeing that really drag down those shares this morning. We're down more than 12% for STMicro.
All right. Chloe, thank you so much. Let's get now to our guest, Stephanie Roth of Wolfe Research, on the Fed's path ahead and inflation concerns. So, Stephanie, we had thought that supply risks, particularly in the oil market, were going away, right? But now they're very firmly coming back with oil prices these high.
Yeah, I mean, so it's a challenge, especially being that we have seen some relief from the oil price. And the thing is, the inflation trajectory in the next couple of months We'll likely have some seasonal effects that bring it back down. The tariffs are starting to roll off. So our expectation is that even though you're seeing energy prices certainly spike, in terms of the actual feed through to core, the main thing is going to be from airfares. Otherwise, we still see some disinflationary pressures coming ahead.
So what does that mean for the Fed? Because the markets are increasingly signaling that perhaps July is not just live, but maybe advisable at this point.
I think July is still off the table. We got the really good inflation prints. There's going to be, of course, a couple of members that are likely going to be pushing for a hike. We certainly heard from Beth Hammack, Lori Logan last week. They are a lot more hawkish, but they are among the more hawkish members of the committee. So our expectation is they will set up the debate in the July meeting, and then it will depend on the path of the data through September. And it's really going to be the next two core PCE prints. Are they running somewhere below 0.25%? And then that'll allow the Fed to be even more patient beyond that. If you end up with some surprises and we're wrong on our inflation trajectory, it comes in above 0.25, then we're talking about a different scenario in September.
Well, we're looking at oil like $10 higher than it was just a few days ago. Now, that likely, well, will it have an impact on the next PCE data, or will we have to wait for a couple of months before we see that? And again, oil is something the Fed tends to typically look through, but it can't here, can it?
You know, it depends what everything else is doing. If you're seeing disinflation from some of the other components, and by the way, airfares is really one of the few things that will show it in the near term. And when you're thinking about core PC, of course, energy prices are going to show it, rather somewhat immediately. But airfares is really the component that feeds through into core PCE most, clearly. That has had an impact. Of course, it went up, and then it has recently, the gains have moderated a bit. That's really the only piece that will really be feeding into inflation. The fact that inflation is elevated today is not really related to the war. It's more related to tariffs that have had a notable impact. Our expectation is about 70 basis points on core PCE. And then on top of that, you've had AI feeding through in terms of chips. That's added about another 30 basis points. So inflation is really nearly about 100 basis points, driven by higher than what it should otherwise be, driven by factors that are not really related to the war or sort of anything tied to sort of this narrative. Therefore, those things should moderate, at least on the tariff side. So the reason that inflation is high today is much less related to the war and much more related to sort of other factors that have other nuances and may fade a bit in the future.
But you're pretty sanguine that a hike doesn't have to come in the near term, even an insurance hike. It could wait. Would it be September? Would it be beyond that?
I think it's either they go in September or they end up being able to be much more patient and don't have to go at all. September, in my mind, is the critical point in which they're going to find out if the Fed is ultimately going to have to hike or not. Because either we're in a scenario where the inflation data start to cool down a little bit, and by the way, seasonal factors tend to push down inflation in the second half versus the first half. So if we get through the September meeting and they don't have to hike, they probably don't ultimately have to hike in December either. And then by then we're probably sort of past this somewhat elevated inflation episode.
Can I talk to you about these elevated yields? Because what is the market then saying? I mean, if, everything you say turns out to be true, then maybe yields don't need to be this high. And yet we've got such an amount of issuance out there. We have treasuries competing with corporate issuance and so on, that you have the 30-year yield at, above 5% for 27 days this year.
Yeah, I think buyers are just not really interested right now because risks at the moment are to the upside. That said, if rates continue to climb in the near term by probably about 10 basis points or so, I would be pounding on the table that rates are probably headed lower rather than higher. Because at some point you're going to be at a level where, one, the administration is going to be very uncomfortable with how markets are trading, and two, it becomes very asymmetric. At some point, rates are going to rise so much that it's going to create a big risk off in broad assets, and you're going to see rates come back down. So we're approaching the level where rates can't really move that much higher before there's sort of mitigating factors.
Would a broad risk-off move send rates lower? Because things haven't been that closely correlated for some time.
Yeah, they haven't. And there were times earlier at the start of the war where you had stocks selling off and rates moving higher at the same time, which is obviously not a great environment for sort of any risk manager. But at some point it becomes a problem, and rates rise too high such that it creates problems. So after we move through the big earnings week next week, the market focuses a little bit less on earnings and how solid that backdrop is. Focus may again return to rates are high.
Yeah.
And that could really slow down growth and cause some other problems. So I think maybe in the next week or so, we might see the stock bond correlation kind of be somewhat less correlated than normal. But I think that might return where you might be in an environment where bonds, again, protect you, but perhaps not in the next couple of days.
How concerned are we that Fed independence is once again at risk with this whole SEBI investigation and the potential for, an attack on Michael Barr?
Yeah, I mean, certainly it's not a good thing. The markets certainly don't like when the Fed independence gets questioned. I think what we'll probably see is, however this plays out, really the decision around independence is going to come down to the path that War sets out. And he's proven to be a lot more independent than I think many expected. He's come across as much more hawkish. The market doesn't know at the moment, is he hawkish because he wants to sort of set expectations and come across as credible, or does he genuinely want to hike rates? I think he probably would prefer not to hike rates, but if he has to, he will. And I think that's going to be realistically what matters for when we're thinking and markets are thinking about, broad-based Fed independence. And, some of the stuff that happens under the surface, of course, is not great for markets and risk assets broadly. But we have seen this story before. And, courts to some extent have been sort of supportive of the Fed independence idea. So am I worried about it? Not in a big way, especially since the chair at least has set a tone that is fairly independent.
Yes. Stephanie, we know now that there is going to be a news conference. At least there was a question mark over whether he might even come out at all, Kevin Warsh, but he will come out. What will he tell us this time around? I mean, is it going to be like updates on the task forces, or are we actually going to get some guidance?
I think it's going to be updates on the task forces. I think it's going to be a lot of circularity. I don't expect to learn a whole lot about the reaction function or, what the path is going forward. I think we're going to ultimately have to rely on conversations or speeches from governors like Waller, who is, much more transparent about sharing his views about the reaction function and how the Fed is looking at the backdrop. So from Warsh, we're going to hear probably more of what we heard from last week in terms of, they're watching the data. The most recent data print doesn't make a trend necessarily unless we have more of that. Of course, there's going to be a lot of questions that are asked to him that try to poke holes at his, lack of forward guidance. But he's proven to be very good at not answering the questions he doesn't want to answer.
Yes, absolutely. Although he can't say there's a task force for that anymore. At least if he does, we know who the task force is and when they should be expected to report. Stephanie, thank you so much. Very enjoyable conversation with Stephanie Roth there of Wolf Research. Now to other stories trending on the terminal this morning. Tesla's profit fell in the second quarter despite the strong performance of its auto business. Spending on ambitious projects such as robo-taxis and Optimus surged to $5.8 billion, resulting in Tesla's first cash burn in 2 years.
We should be spending on CapEx as fast as we can spend, as fast as we can, without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time.
Uber cutting 10% of jobs in its customer service operations as it pushes to simplify the business and expand its use of AI. Employees who'd been working remotely were also asked to relocate to a hub office. The move is consistent with the company's return to office mandate. SK Hynix capped the amount of its South Korea listed shares that can be turned into ADRs at 2.5%, and the limit is said to be fully used up. It means investors cannot turn Seoul listed shares into ADRs unless existing ADR holders convert their US traded receipts back into Korean shares. SK Hynix didn't respond to a request for comment. Coming up, the Houthis attack, escalating tensions around the Iran war. More on that next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Iran is begging us, okay, both directly and indirectly. Let's do a deal. Let's talk. Iran is begging every day. The problem with Iran is every time they make a deal, the people that are in charge there, they either break it or they want to change it. So it looks like they're not ready to make a deal. So they're going to continue to pay a price. And every night the price gets higher and higher and higher.
Secretary of State Marco Rubio speaking to reporters there in Manila as the U.S. and Iran exchange strikes for a 12th consecutive day. And this all, of course, as the Houthis attack 2 ships in the Red Sea, jeopardizing another key shipping route. Bloomberg Government's Mika Solner joins us from Washington. The cost of the Iran war is growing and growing exponentially at this point. Mika, is there any sign that the Trump administration is concerned about that?
I mean, yes, definitely. I mean, I think that we saw the president yesterday attend the dignified transfer of 4 U.S. soldiers that were killed as a result of Iranian strikes in this war. And I think that this is really escalating these tensions now between Tehran and Washington. And it doesn't seem like there's going to be any more negotiations happening soon. I mean, we saw the president's earlier warnings this week that he said that he's prepared to potentially hit civilian sites such as bridges, including ones near the capital city of Tehran. Now, of course, the president has made these warnings before, but it just shows the escalation in rhetoric and the approach that the Trump administration is making here.
What about this Silicon Valley Bank investigation? Is the Trump administration targeting Fed Governor Michael Barr? Does the administration want him removed from the board?
Yeah, I think this is one of those cases, I think, where, the administration tends to escalate its looks into these kind of things. I mean, this is something that they've done before in terms of trying to kind of set those warnings for people and against the Fed in general. So we're going to have to see what comes out of this.
What about congressional stock purchases? Mika, that's another story emanating out of Washington. Objections from Democrats, obviously, to an unrelated provision in the legislation. But will it end up passing?
Well, I think it's really difficult to say right now. Right now, I think it's very unlikely just because of the voting provision that was attached to this congressional stock ban. I mean, I spoke with lead Democrat Seth Magaziner, for example, of Rhode Island, who said that, this is not a serious approach to an issue which has, over 90% of support publicly, very high levels of support, and a broad support across Congress. So this is a very popular bipartisan issue, a rare one in Congress. The president has signed
signed on. The House Minority Leader Hakeem Jeffries, of course, is supportive of some kind of ban. And Speaker Mike Johnson in the past has expressed support for it too. So this has support in Congress. I think it's whether or not, those provisions that are added and how lawmakers really want to get this through.
All right, Mika, thank you so much. All the roundup from Washington, D.C. That's Mika Zollner from Bloomberg Government. Back to earnings now. Alphabet lower in the pre-market after reigniting investor concerns over outsized AI spending. The firm forecasting as much as $205 billion of it this year. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, we were expecting that they would increase their forecast, but they didn't increase it by so much, and yet the market did seem to sell off. What's the market saying?
Well, they didn't give us any numbers for 2027, so this is just for 2026. The capex numbers went up by about 4 to 5%. But look, overall, I think what they are suggesting is next year probably is going to be another 50% type of growth in capex. So that will take them to somewhere around 300 billion. Even though they didn't guide to it, I think the fact that they are talking about high, growth in the cloud segment, driven by the TPU system sales, which is a new segment within their cloud, and they want to invest in that. And I think they have the balance sheet to do it. So it's the knee-jerk reaction is obviously, more capex means negative free cash flow. But at the end of the day, they have the balance sheet to do it at a lot bigger scale than a lot of other players. And I think that's what they're going ahead with.
Mandeep, they're all in. Is there any inkling of doubt there, or were there any answers to analysts' questions that may have given us some kind of light on why they think that this is worth spending that much money on and continuing to increase spending?
I mean, just look at the cloud business. This business used to grow at 25, 30%. This quarter, cloud segment grew 82% with margins almost doubling to about 36%. Now, there were some comments that margins will go down in the near term for the cloud because of the third-party compute rentals and the fact that they're investing in these TPU systems. But overall, it is a margin expansion story on the cloud side, which was a much smaller business. And you're seeing that type of growth, for a $100 billion segment growing at 80%. That's phenomenal. And I think that's where, yes, we can focus on the free cash flow going negative and the capex numbers going up, but they are showing that in the top line growth. And that's where, if you parse through the numbers, it's pretty obvious that a bulk of the growth going forward is going to be driven by cloud. It's not going to be any other segments within Alphabet.
Mandeep, what is Intel supposed to say to us later that will satisfy the investing community?
I mean, what we heard from Alphabet is everyone right now is investing in agentic infrastructure. So Intel should get a piece of that, given, CPUs are a lot more important for agent workloads where, in the training phase, we just needed GPUs. Now we need a lot more CPUs, and Intel still has a sizable share in that market. So from that perspective, I do see a path to double-digit growth for a company like Intel, which really was beaten up for a very long time. But it seems like the trends are aligning for them. And the other thing is the foundry business. They are looking to land up more external customers. So there'll be more to come on that front as well.
The stock just this year alone up an incredible 180%. And that's not even figuring the year-over-year number. Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. And do tune into our interview with the Intel CEO. That's going to take place at 11:30 a.m. Eastern. Coming up, we'll get you set up for your trading day. More earnings and the ECB decision, of course, on deck. This is Bloomberg.
Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. First up, your ECB rate decision. That's coming at 8:15 Eastern, and that followed by President Lagarde's news conference at 8:45. Not expecting a move, but at the same time, there will be interesting comments from Christine Lagarde on her tenure as well. Then we get more earnings from Lockheed Martin and American Airlines before the opening bell. Of course, the big one, Intel, after the market close. And Bloomberg's UN Secretary General candidate town hall takes place. That'll be live from the UN headquarters at 5 p.m. Eastern. Let's take a look at some movers pre-market this morning. We have to check out Alphabet. It said it was going to increase its spending this year to $205 billion, up about $10 billion from a previous forecast. Now, as Mandeep Singh just told us, they didn't give us the 2027 forecast. Alphabet shares are lower in the pre-market. Tesla down almost 6%. Efficiency in terms of capex spending is what investors are concerned about here. Profits sliding as well as spending climbs. And then ServiceNow, well, it was a better story for ServiceNow. Strong subscription growth overall, a really good number from ServiceNow. And perhaps that wasn't anticipated by the market, and so the market is rewarding that company. Let's take a look at your macro picture going into another huge day of trading. We have Brent crude just above $98 a barrel, continuing to escalate, and that is not helping with the tone, but also we have NASDAQ futures lower just generally because of the tech tone, and 30-year yields above 516 right now. The alarming auction yesterday.
Very famous dogs. You have they look like balloon kind of figures.
300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, you know, Jeff, I can't do it for 300,000. It's going to be 650,000. But eventually, then they raised the price again, and they finally brought it up to 1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production costs.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What we have seen is a much higher baseline level of volatility for technology stocks.
Some of these moves have been absolutely parabolic.
It's becoming a little bit more consensus, at least, to lean a little bit more into the hyperscalers.
You got the hyperscalers. They're spending like drunken sailors.
Can the build of AI get done as fast as the market expects?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, weighing on sentiment, crude approaching triple digits, the Houthis attacking shipping in the Red Sea. Increased tension sending bonds lower, pushing yields to new highs as solid quarterly earnings from Alphabet is failing to insulate stocks, overshadowed by higher spending.
All the pillars of this market, of this economy, are being threatened right now. You have concerns in the Middle East that are jacking up oil prices, suddenly making next week's Fed meeting look a little more potentially live. The ECB with 2 rate hikes now priced in for the remainder of the year. All of a sudden, Alphabet, yes, they had a good quarter, but they had their first negative cash flow quarter going back to at least 2016 as they continue to ramp up spending far beyond. All of these things creating anxiety that everyone has their hand out and no one's paying the bill.
Check out the stock in the pre-market this morning. We're down 4% on Alphabet. Yes, the CapEx story is making the headlines, but check out the earnings. Cloud revenue, almost $25 billion, $2 billion plus more than estimates. The backlog is building. My takeaway this morning, I think slightly more significant than just the CapEx numbers, which is dominating the story, is the fact that they put up good results and this market's not rewarding them. That stock is down 4%.
If I could give a call to Max Kettner right now, Max, if you're listening, does this make you rethink the bull case? Because ultimately, exactly what you just laid out was everything that he was looking for to understand whether potentially this bull market could be coming to an end. Not only did they talk about incredible bookings, incredible cloud revenue, far beyond what people were expecting, but in terms of the backlog, and this is something we heard about, it was far in excess of what people had been expecting in terms of business. So on those fronts, all systems a go. It still wasn't enough to get people excited.
That should justify the spend, should it not? We'll have that conversation later this morning. That's the tech story. Let's get to crude. Check it out. Brent and WTI so far this morning. We're higher on the month by about $25 now. Brent crude is threatening to break into triple digits, $98 a barrel, up 4%. WTI is in the 90s. Only 3 weeks ago, WTI was in the 60s.
It was a threat, and now it's a reality when it comes to the Houthis getting involved in this war. They opened up this new front basically by going after these 2 Saudi Arabian vessels, and the Red Sea has become so critical to global energy because Saudi Arabia has been using that to get all of their product out because they haven't been able to use the Strait of Hormuz. Now you have 2 choke points. This is a massive problem. What the Houthis had to say overnight was that they will continue their naval operations against Saudi Arabia and will persist in enforcing, quote, a siege for a siege.
It's too high to ignore. We've ignored it now for weeks. It's too high to ignore. It's not in the 60s anymore. We're in the 90s. And you see this playing out in the bond market too. Check it out. 2s, 10s and 30s so far this morning. 2s in the 430s. 10s approaching 470. We are at or near the highs of the year across the curve. 2s at the 30s.
Yeah, this really raises a serious problem for central bankers because this isn't necessarily entirely coming on inflation expectations. It's a 2-front issue. On one hand, you've got oil prices that are pressuring places like the ECB and the Bank of Japan, forcing their hands, potentially infecting bond markets here in the United States. And you have all of the competition when it comes to CapEx from the likes of Google. So these two forces coming together and propping up yields at a time when central bankers want to look through this oil price shock but can't because of these other factors.
Lisa mentioned the ECB decision later on this morning. Check out Germany. Two-year yields have had a 30 basis point move so far this month. So crude is up by more than 30% so far this month. Two-year yields in Germany are up by more than 30 basis points so far this month. The two-year at 287. That ECB decision a few hours away. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock on why he's trimming tech, John Lieber of Eurasia Group as the conflict with Iran widens, and Gil Luria of D.A. Davidson with CapEx concerns weighing on Alphabet. We begin this hour with stocks lower as investors digest higher spending plans from mega-cap tech. Russ Kostrick of BlackRock writing, long-term, we think fundamentals still favour the mega-cap tech names, including the hyperscalers and the semis. In the near term, however, we have trimmed our overweight in the space. Russ joins us now for more. Russ, welcome to the programme. What signal should we take from the fact that this market is not rewarding those earnings from Alphabet?
Good morning, Jonathan. I think the signal is that we had a huge run-up, not necessarily in the hyperscalers, but in many of what we'd call the pick and shovel plays, the semis, the semi-cap equipment that benefited from this huge CapEx spend. And the market got extended. We've seen numerous examples of a lot of leverage in the system, and it's taking some time to digest. And it's not helping that we also have, as you pointed out a moment ago, a background where oil is higher, rates are higher. So look, the earnings have been spectacular. There are legitimate questions about cash flow, but this is not a question about the fundamentals. This is more of a question about positioning. And I would say in the background, some growing concerns about oil and rates.
So, Russ, how would you describe trim and tech? A tactical call this morning, something to work with through the summer?
I think it's something that you probably do start to think about in terms of the next 2 to 3 months. It's also worth pointing out, we've seen really since the June peak in tech, it's also become a little bit of a seasonal trend that we had not only this year, but in 25 and 24. And it was this broadening out rotation, everything out of tech into other areas of the market that would benefit, and that tended to lag year to date. The challenge is in an environment where oil is up and rates are up, it's not clear that some of those other trades like small caps make as much sense. So I think what we're considering right now is you run with a smaller overweight to stocks, you bring that equity exposure in a bit, and you look for opportunities. And again, I think the one thing to point out long term is that given that particularly the hyperscalers were struggling a bit even before this started, there are some good valuations in tech that, quite frankly, we've not seen in years.
At this point, Russ, what would make you more concerned, given where positioning is, given where rates are, and given what's happening in oil? If this persists past a certain time, would you start preparing for somewhat of a more protracted route?
I think the main issue is, are we starting to see some evidence of softening in the economy? And so far, we really have not seen that. Manufacturing's been very solid. The labor market, despite some concerns in late 25 earlier this year, has actually been on solid footing. So right now, the underpinnings of the economy are still strong. We've got an environment where nominal growth is probably around 5.5%. That's one of the reasons that earnings have been so solid. If that starts to slip, if some of the near-term indicators in the economy, initial jobless claims, for example, some of the PMIs begin to pull back, then you've got to start to question whether or not that assumption about a solid economy powering earnings is going to persist in the back half of the year. Right now, I think for the time being, we're still okay on the fundamentals.
I find it interesting that you said what you probably should do is pare back some of the stock overweight and wait for opportunities. You didn't say pare back some of your stock exposure and go into bonds because bond yields are so high. So it might be a good time to exploit that and get some income. Why not? Why is that not the obvious playbook right now?
That's a great question. I think the simple answer is because bonds are not working as a hedge. If you look at the relationship between stocks and bonds right now, in other words, the correlation, it's the most positive it's been in years. By some measures, it's the most positive it's been since before the tech bubble burst. So this is one of the challenges in a multi-asset portfolio. It's very hard to find the hedge right now. Bonds are not working. They're selling off at the same time as stocks. Gold has been a tough play this year. The dollar's steady, but not really offering much convexity. Honestly, the only thing that I have a lot of conviction in right now is a hedge against equity risk is the most obvious, which is to own energy stocks. Because if the proximate risk to the market, the risk to rates is higher oil, the one thing that is working in that environment is to own energy and have a bit of an overweight in that sector.
What would make you want to go into bonds again, Russ? I mean, I ask this, we'll get to energy in just one second, but I ask this ahead of a bunch of central bank decisions that could potentially change the backdrop.
I think if the question is when you say bonds, because we do have a significant position in bonds and credit that we're very comfortable with, but if you're thinking about what would make you want to go out and buy the 10-year is a hedge against equity risk, I think it goes back to what I was talking about a moment ago. Are you starting to see signs that the economy is really softening in some of the near-term data? That's not there yet in the economic data. When we talk to companies, when we talk to retailers, we're not seeing evidence of the consumer softening. That is what would have to occur to have more conviction that yields are going to go down and that bonds would actually provide some hedge against equity risk.
Would we potentially get there if oil continues to rise, breaching $100 a barrel?
I don't know if $100 a barrel is going to do it. We were at $100 a barrel earlier this year. The economy was just fine. The consumer was just fine. The reality is the economy is much less geared to oil than it was at the time of the first Gulf War 36 years ago. It's a smaller percentage of wallet share. We're now the largest oil producer. It's beneficial to the terms of trade. So in terms of the magnitude of the rise you need to see to create a real oil shock that would bring the economy down, I think it's a lot higher than $100 a barrel.
With the Houthis now, though, involved in this conflict, RBC's Halima Croft has a note out this morning saying Gulf infrastructure increasingly coming under threat and data centers now have a growing target on their back. What if instead of desalination plants, we start to see missiles drop on data centers in Saudi Arabia or the UAE?
Well, look, there is a definite geopolitical risk premium here. And I think one of the mysteries that I was a bit confused about a month ago was that oil got as low as it did. We knew that there were questions about whether or not the ceasefire was going to remain stable. We knew that the Houthis were potentially going to be in play at some point. So oil down in 60s and the low 70s with that much of a risk premium seemed a bit odd. But I think this also illustrates another problem. Other things go through the Straits of Hormuz and out of the Middle East other than oil. Fertilizer, the knock-on effects to food. So I think one of the concerns you have to have right now is what is the impact going to be, not just on oil prices, not just on headline inflation, but are we going to see an impact on core inflation as well through some of these knock-on effects and other products besides oil that are ultimately coming from the Middle East?
Russ, how do you think Kevin Walsh handles that next week?
I don't have a strong opinion. Obviously, this is changing in real time. Our baseline was not a hike next week, but obviously if we start to see that there's greater pressure, again, not just on oil, but on other commodities, and that's feeding through to the broader economy, that is going to put pressure on the Fed. If not now, then certainly in the fall.
Hey, Russ, good to see you. Thank you, buddy. Russ Kostrick there of BlackRock. Check it out. Let's start with crude, and then I want to look at the bond. The story, the yield curve, so to speak. Let's start with crude. WTI and Brent so far this morning. Brent at 98, WTI around 90. Now check out yields, 2s, 10s and 30s. Look at the very long end of the curve. Lisa asked an important question. Why is the money not coming into the bond market? Why is this sell-off not becoming self-limiting? Typically, yields push higher. They create about a risk aversion. The money goes back into bonds. 30s this morning at 516. The team here at Bloomberg breaking down the data in the last 24 hours. The longest period, the longest run above 5% we've seen on a 30-year yield going back to 2007. We're hitting these levels and staying there for longer. That's the story so far this year.
It's not enough to draw in investors. And not just that, but back in 2007, when you had a similar streak, the benchmark rate was a lot higher. The Fed funds rate was a lot higher. So what you're talking about is real yields on the 30-year bond. When you strip out the inflation adjusted aspect of this, are the highest going back to 2008. Again, a real question. Is this bond vigilantes? Is this just a strong economy? Is this competition from hyperscalers? Or is this something else that makes people like Russ Kostrich not want to buy bonds?
516 on 30 so far this morning. Let's give an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Alphabet shares falling in the pre-market. The company raising its capital spending forecast for this year to as much as $205 billion, reigniting concerns about a lack of fiscal discipline in the race to dominate AI. Tesla shares also trading lower this morning. The EV maker reporting second quarter results that fell short of estimates. Spending surging to $5.8 billion, resulting in Tesla's first cash burn in 2 years. The White House accusing China's moonshot of improperly using U.S. AI models and NVIDIA chips to create the Kimi K3 system. The U.S. is considering sanctions against Chinese firms, which could affect Moonshot's plans to raise capital and move towards an IPO. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. What was the first thing we said the morning that news dropped? Is it export compliant? We need to figure out whether it is export compliant or not. And it sounds like on that reporting, it might not be.
Doesn't sound like it. And there's definitely concern coming from the Treasury Department, also coming from the White House, that this was not export compliant. And how many more of these potentially are we going to see?
More on that story a little bit later this morning. Up next on the program, expanding strikes on Iran.
We don't need the Hormuz Strait, but we do it because we have to do it, because we cannot let Iran have a nuclear weapon. They're getting hit so hard, and they want to make a deal. But I say they're not ready to make a deal. They'll be ready very soon.
No deal this morning. John Lieber of Eurasia Group joins us next. Live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot. Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Yesterday struggled to build on Tuesday's gains. This morning negative by 0.4 on the S&P, down by 0.5 on the Nasdaq. In fact, chips haven't been the problem. Semis advancing for 3 consecutive days, and yet here we are, a down market. The Nasdaq down by 0.5. Alphabet struggling. We'll spend some time on that single name a little bit later. The earnings were good. CapEx a bit higher than expected. We blaming CapEx, or maybe this market is just too richly priced? We'll talk about that later too. Let's turn to the bond market. 2s, 10s and 30s. 2s, new levels, new highs for the year. 431.50 and up by 2 basis points. A little less than a week away from catching up with Kevin Walsh and the team over at the Federal Reserve. Have we reintroduced some hawkish risk to this meeting? With that pricing so comfortably above the policy rate, the Federal Reserve, and with this move in crude. Crude right now, WTI and Brent. Brent crude at 98, threatening to break into triple digits. Not so long ago, and when I say not so long, I mean 2 to 3 weeks ago, we were talking about breaking back into the 60s on Brent. We were there on WTI, in the 60s. We're back in the 90s, just like that, up 4 percentage points so far this morning. Under surveillance this morning, expanding strikes on Iran.
We don't need the Hormuz Strait, but we do it because we have to do it, because we cannot let Iran have a nuclear weapon. They're getting hit so hard, and they want to make a deal. But I say they're not ready to make a deal, because every time they make a deal, they want to change it and everything. They're not ready. They'll be ready very soon.
So here's the latest this morning. Houthi militants opening up a new front in the war. The Iranian-backed group targeting 2 oil tankers in the Red Sea. US forces expanding targets in Iran in a bid to protect commercial vessels through the Strait of Hormuz.
So we had another night, 12th consecutive evening, where the U.S. went after a lot of Iranian targets. And at the same time, we now have a new front that's opened up. This idea that now we have 2 choke points that potentially are at risk in the Middle East is why you were seeing oil prices jump this morning. The Houthis, we have heard it for days. They were saying they were going to get involved, and yesterday was the day they decided to do that, targeting 2 Saudi Arabian vessels. Saudi Arabia is so key right now. They've been using this east-west pipeline to move product out of Yanbu and some of their other terminals along the Red Sea because they've been cut off from using the Strait of Hormuz. So now, potentially, we are going to have a moment where you can't have product getting out either way. And as you've continuously been saying on this program, we are living on inventories now, and they are very low.
This was a worry over the last 5 months, and here we are. It was a release valve for this situation, and now it's a stress point this morning.
Suddenly, the Saudi Arabia payouts to the Houthis aren't working anymore. And actually, you've seen some real conflict ongoing between Saudi Arabia and the Houthis. A question here about whether we are reaching the break point and whether there is going to be some response by central banks. And we keep talking about that because that really does affect the yield picture. And we do get that ECB rate meeting. And frankly, suddenly it's a lot more live.
Let's get to the take with John Lieber of Eurasia Group. He writes the following: the continued threat of Iranian attacks on infrastructure and Houthi disruptions in the Red Sea suggests the risk to supply will endure and evolve rather than disappear. John joins us now for more. John, welcome. I remember the conversation we had with you several months ago, and we asked about this situation. Why has it gone so quiet in Yemen with the Houthi militants? And here we are this morning. What happened? What's led to this breakdown in the situation between the Saudis and the Houthis?
Yeah, our view has always been that the Houthis were going to stay out of this fight because they were looking to get paid by the Saudis. And that has worked for a while. But I think the Iranians are now effectively putting pressure on the Houthis to get back in. And, I think the Houthis' motivation remains the same here, which is that they're trying to give the Saudis a chance to, effectively pay them off so it stops. But the Iranian offer, the Iranian appeal to attack is looking better. So the Iranian strategy here is to put as much pressure as they can on President Trump and on the West by increasing oil prices. And the Red Sea is the next best vessel for doing that. And, over time, we think that obviously you're going to see a lot of displacement of energy shipping and other shipping out of the Strait of Hormuz. That's going to evolve over the next 5 years or so. And the Red Sea is going to become an increasingly important choke point in the global oil trade. And this week, what we're seeing is what that means is that choke point is not a safe choke point. It's one that the Houthis or other geopolitical risks could potentially affect as well.
John, when it comes to the Houthis and the U.S. response, the president threatened that he would have a response if they were to get involved. Are you expecting that, or that just potentially an empty threat at this moment?
I mean, I think the U.S. and the Saudis have to do something here. I don't think that they can tolerate the upward pressure on oil prices for too long. It gives the Iranians yet another leverage point over the Americans in this fight. So it would surprise me if the U.S. didn't get involved in some way in deterring these Houthi threats. Now, that's been hard to do. The Saudis fought a multi-year war against them, and they never quite eliminated those threats. And the U.S. is concentrating a lot of its firepower right now inside Iran. But I do expect this battlefield is going to expand in the coming days if the Houthis keep up their pressure.
We also have reporting overnight that the U.S. is surging forces to the region, medics, also weaponry, because of the fact that the conflict is now taking on a new escalatory process. What is going to be the response to this? Because when you look at polls, Americans aren't overwhelmingly in support of this war.
Yeah, I mean, the U.S. just doesn't have a lot of good options. The Iranians know it. The president could try to escalate further in Iran. Iran has been shockingly resilient so far, and there's no reason to think that resilience wouldn't continue. Their ability to continue to fire missiles at the U.S., the resilience of their missile cities, the fact that they can strike embassies now across the region, and the fact that they're starting to figure out ways around American air defenses that's going to put American lives at risk. I think are all extreme headwinds for the U.S.'s ability to keep pushing this war. Trump is showing no signs of backing off right now, and I think that if you read the body language coming out of the White House, it looks like he thinks further escalation will deter the Iranians, but the Iranians look increasingly dug in. So I think that they are playing the stronger hand right now. They don't have to worry about public opinion. Trump does. And as those oil price inventories get drawn down and as the disruption continues, those prices increase in the middle of the summer for the U.S., putting a lot more pressure on Trump to end this. So I don't see how this is sustainable for more than a few weeks. But again, the White House is showing no indication that that's part of their calculus right now.
We're trying to get a sense, John, everyone is, of exactly what the exit strategy could potentially be. At the same time, yesterday, the Trump administration released a deal, an agreement with Saudi Arabia, a multi-billion-dollar civilian nuclear cooperation agreement. Is this completely separate? Is this related in any capacity? In some ways, there are aspects of this which are exactly what the United States has said that they don't want Iran to have.
Right. I mean, I think that the U.S. has got to do a lot to make up with some of its friends in the region. I think that this war has been prosecuted in a way that's at least going to hurt the short-term economic outlook in Saudi, in the UAE, and I would expect more concessions like this coming from the U.S. Now, of course, we don't know exactly what the terms of this deal were. In the past, the nuclear program for the Saudis was always contingent on some kind of normalization with Israel. It seems as though those conditions have been dropped, and more details are going to come out here.
John, do you think the Saudis get drawn into this war?
I think the involvement of the Houthis makes it very difficult for them to stay out. And I think the fact that now you're disrupting, two large Saudi tankers getting out of the Red Sea, the fact the Saudis are kind of armed and ready to respond, I think it's very difficult for them to stay out of this.
John Lieber of your Asia Group, a sobering comment at the end there, the prospect of this war expanding and not shutting down anytime soon.
And potentially the groundwork was laid for that when Saudi Arabia was involved or accused by the Houthis of bombing an airport in the capital there. And that possibly was the reason why they were more amenable to the idea of retaliatory attacks in the Red Sea. There are so many different aspects here, but you do wonder how the U.S. preserves relationships in the region at the same time that this starts to expand into a regional war. A very difficult situation.
I'm not going to say that these Saudis were comfortable, but they certainly had a solution to the problem at hand with the East-West pipeline that you described. And the release valve was clearly the Red Sea. And that's been the release valve now for several months. The fact that we've seen this escalation, to John's point, can we honestly sit here and say this morning with any real confidence that the Saudis stay out of this if this situation continues?
I think they're almost already into it. I mean, they're already getting targeted, not just even at sea. There have been issues as well with the Iranians targeting and potentially threats of going after some of their energy facilities on the land.
Closing in on 99 on Brent, $90 on WTI. Up next, we'll catch up with Gil Luria of D.A. Davidson as CapEx concerns weigh on Alphabet. Plus, Jahaira has your morning movers. Check out Micron. Micron up by 2.9%.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
It's pretty impressive. We're still within 2% of all-time highs on the S&P 500. Don't forget that when we talk about all these issues, the violence beneath the index level, the risks happening elsewhere in bonds, in commodities, that we're still within 2% of record highs on the S&P. This morning, we're falling back by a third of 1%. I think that speaks to why we're finding it so difficult still to engineer a rally, even with quite good earnings coming from some of the biggest names on the planet. The Nasdaq down by 0.4. We'll talk about Alphabet and Tesla in just a moment. Turn to the bond market, new levels, 2s, 10s and 30s. We're in the 430s now on 2s, close to the 470s on 10s, a single basis point away from a new high for the year on a 10-year maturity intraday high for the year. On a 30-year, 516 and up another basis point or two this morning. Thank you, crude. Here's the crude move. Check it out. WTI and Brent. Brent crude closing in on triple digits, up 5% this morning. We've been talking about this now for the last several weeks. You don't want to look at it. You don't want to see it. You don't want to internalize a number that's closer to triple digits. In your head, oil's still trading in the high 60s, low 70s, and everything's okay because I don't want to discuss the situation in the Middle East. Guess what? This morning, you have to discuss the situation in the Middle East.
We've crossed the Rubicon for markets, given the fact that oil prices, Brent crude is up 30% since July 10th, when the latest round of reignition of conflict in the Middle East began. You start to think about how much this affects the backdrop for central banks, how much this affects the backdrop for consumers that already have seen prices being rising around the globe. And you start to get a little bit more concerned. Then, of course, on the tech side, there is this question of how long the capital markets will continue to finance all of their hopes and dreams. And the oil market not necessarily yet impeding that, but clearly causing a little bit more anxiety.
ECB rate decision just a few hours away. Look out for that on this program as we count you down to the opening bell. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Those bigger CapEx plans from Alphabet not sitting well with investors. Shares are down 4% in the pre-market after the company said it now expects to spend as much as $205 billion this year. And that's notable because Alphabet had been viewed as one of the clearest examples of AI investments translating into growth, and it's been doing well when it comes to AI execution. Instead, the reaction suggests investors are beginning to question these spending plans getting bigger, even after the company posted 82% in cloud, its Google Cloud revenue, and easily beat expectations. Now, turning over to Tesla, where the debate around AI spending is a little different. Investors have actually been waiting on the company to spend more because so much of its future depends on these futuristic, pricier products like robo-taxis. And while it did reaffirm that it plans to spend more than $25 billion this year, you didn't see the payoff. It posted a big earnings miss. So even in this situation, you can see that investors have a high bar when it comes to those spending plans translating into a beat. So shares are falling 6%. And who benefits from all this CapEx spending? Well, it's the memory players and the chip stocks. We are seeing Micron up 3% in the pre-market as these earnings show us that the hyperscalers are likely to raise their CapEx plans. Plus, Elon Musk said on the call that Tesla recently secured a significant allocation of Micron's memory chips, reinforcing just how scarce and valuable memory is these days. John?
The wealth transfer is alive and well. Yahira, thank you. More from Yahira in the next hour. On our radar this morning, Houthi militants claiming responsibility for attacks on 2 tankers in the Red Sea. The Iran-backed group opening up a new front in the war after threatening to blockade Saudi ports earlier this week. Elsewhere, Alphabet, Tesla, shares falling in the pre-market. The tech giants announcing massive spending plans. Tesla seeing its first cash burn in over 2 years, expecting to spend over $25 billion this year, while Alphabet forecasts up to $200 billion plus in capex. And finally, the Trump administration accusing Chinese AI startup Moonshot of using prohibited U.S. tech to create its latest model. A White House official saying the company accessed NVIDIA chips in Thailand in a violation of U.S. export controls.
Yeah, the concern here is all the loopholes potentially that are out there that Chinese companies can continue to exploit at a time where it seems like they're catching up much more quickly to some of the more frontier models in the United States. Regardless, question, can you put this genie back in the bottle? And I think increasingly a lot of tech players, the executives, are saying probably not. So the question is, how do you arrange yourself to remain on the front foot, to have enough of a forward lead and enough of a market advantage, even if China is quickly catching up?
And Jensen Huang this morning, speaking to Axios, had this to say. The fact that this is going to be the end of humanity, it's complete nonsense. The fact that this is going to destroy half of the American jobs is complete nonsense. Of course, grain of salt. He just got a window to start selling those H200s finally into China. He wants to continue selling chips to anyone, including China. So I would say he's not the one potentially to look at when it comes to pushback. I would look at what the White House is saying, and even the Treasury Secretary, open source is not open season on American IP.
He's got some skin in the game, so
Absolutely.
to speak. Alphabet and Tesla setting the stage for a busy stretch of tech earnings. The mega-cap companies raising spending plans, stoking investor fears over returns on AI investments. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, I want to focus on Alphabet. Let's just sit on that name right there. Were those names reporting good numbers or what? When I look at Alphabet and I look at the individual divisions, they put up some decent results.
They did. And, you know, for a company of Alphabet size to grow 24% top line is just phenomenal. And, you know, cloud segment had margins almost double compared to last year. So you can't make the case that, you know, there is no ROIC on this CapEx when that cloud business, which was growing 25 to 30% before, is now growing 80% plus, and your margins have doubled. So from that perspective, I think they have earned the right to spend more. And they talked about how they have to rent compute capacity from the likes of SpaceX and NeoClouds in the near term, which may drag the margins down a little bit. But this is a full vertical stack company. And, you know, the cloud business was non-existent a few years back. And now that's what's driving the growth. And 24% is just phenomenal.
Mandeep, that's my struggle this morning. I understand the concerns about CapEx, where the money's coming from, but the numbers themselves justify the spending. So when I see the stock down in the pre-market, I'm just trying to work out, is that all about positioning? Is that just about price? Or is it actually something fundamental about whatever the company reported overnight?
I mean, the fundamental, I guess, take which is driving the stock down is their Gemini 3.5 Pro model has been delayed. They were asked about why you haven't caught up in the coding agents compared to where the frontier labs like Anthropic and OpenAI are at. And look, Anthropic is one of their biggest customers on the cloud. Out of that $514 billion in backlog, 200 plus comes from Anthropic. But Anthropic is also a competitor for them when it comes to the large language model race. So there is that dynamic where Alphabet, if it falls behind in the large language model race, will have an impact on their search business. And so from that perspective, there are things that you can be concerned about. But overall, I think some of the CapEx increases tied to memory price increases. So that's transitory. And so from that perspective, you know, there's not much to make out of, you know, the fact that they have to pay up along with everyone else when it comes to memory prices.
We banned the T word years ago. Mandeep, thank you. Mandeep Singh of Bloomberg Intelligence. Appreciate it. Thank you very much. Gil Luria of D.A. Davidson maintaining a neutral rating, 375 price target on Alphabet, writing growth at these rates is remarkable for a business about to cross $100 billion of revenue. CapEx guidance was vague enough that it leaves room for interpretation. Gil joins us now for more. In the studio, Gil, in the flesh. It's good to see you, sir.
Good to see you.
Let's get to your reaction to these numbers. What stood out for you?
That sometimes it's not the number, it's not the content, it's how you say it. When CFO Anat Ashkenazi talked about 2027 CapEx, she said it's going to be significantly higher. And she put some mustard behind the significantly. And I could watch my Bloomberg terminal and see the price after market go down by 3% as she said that. If she just put a little bit less zing on it, maybe the market wouldn't be reacting that way.
You think it was a communication failure and just that?
I don't think it was a failure. I think she will increase CapEx significantly next year.
Well, okay, but the larger question here is, does that create a problem for a company that is growing at a really rapid pace? I mean, to John's point earlier, don't some of these numbers justify increased spending if they do have a backlog that's increasing to $514 billion from a $416 billion just a quarter ago?
They do. These numbers justify the investment. I can back into about $20 billion of excess returns Google is getting from investing in AI. That's double-digit returns. When we talk about ROI and concerns about ROI, the numbers are already there for returns. Now, for a company like Google, one of the best businesses ever created, you would typically expect more than 20% returns. So it's not their best return, but it's also strategic. They have to stay in the game. They have to be competitive with Amazon and Microsoft in deploying compute, and they have to be competitive with Anthropic and OpenAI on the frontier models. They are getting returns. That's why they're continuing to invest.
At the same time, I do understand the nervousness around the cash burn. Suddenly, the cash cows of the universe are becoming the cash burners, and that is very uncomfortable for people. We saw the first quarterly cash burn for Alphabet in its history going back to 2016. Does that give you pause, saying even if this is a very good company, we need to re-rate the valuation?
It has to. It has to. Again, one of the best businesses ever created, and we're now in negative cash flow. And that's probably going to happen to Meta, and it may even happen to Microsoft and Amazon. And so we do have to stop and say, are we sure this is working? And I talked a little bit about Google's returns, but there's also the bigger picture return. We're now at more than $100 billion run rate of overall spend on AI. If you look at Anthropic's run rate, at OpenAI's run rate, they're talking about 70 and 50 billion respectively. That doesn't even include any other AI players. That's real consumers and real businesses spending on AI. And guess what? The models aren't even that good yet. OpenAI and Anthropic in their labs are sitting on models that are far better than they're giving us access to. So by the time we all figure out how to use AI better, we're going to be spending a lot more than that. So we are getting good returns, but clearly having negative cash flow for all these phenomenal businesses is something that should give us pause.
So Alphabet's the biggest spender so far this year. Amazon's latest guidance was $200 billion. Do you think they're going to have to up their CapEx when they report next week?
It's likely, if for no other reason that component costs are higher. CPUs are more expensive. Memory is a lot more expensive. Hiring technicians to install HVAC is a lot more expensive. Energy is a lot more expensive. So they're all going to have to increase their guidance for this year. What's going to be even more interesting is to see what Microsoft says about next year, because Microsoft's going to be at the beginning of their fiscal year, so they're going to give us a hard number for fiscal 27. That's the next 12 months. And we're going to know a lot about how much more CapEx is going to get deployed when they let us know about that. Now, if they guide something like 20, 30% more CapEx, I think everybody will take a sigh of relief. But if they guide for more than, let's say, 40% growth, which is how fast Azure's growing, maybe they'll be a little bit more concerned.
The chip companies are getting paid. We saw that this morning. Yahara was talking about Micron. I've asked this question earlier this week. I want to ask it of you as well. I want your reaction. Can you think of a world where these names, the hyperscalers, Alphabet and others, do well, and chips do well too? Because right now, in the stock market at least, that's a struggle.
That's right. If we continue to use AI more, we're all using AI so much more. Again, companies are spending so much more on AI. As long as that trend continues, as long as the diffusion into our lives continues, they will all do very well. They will all do very well. In spite, the ones I actually worry about more, Anthropic and OpenAI, because there will be American open source companies. We can talk about Chinese open source for now. That's not a real thing. We're never going to build systems on Chinese IP. When there's American open source, a lot of the value is going to go there, but then there'll be more value to flow through hyperscalers into chip companies and into the companies that make the chip-making equipment.
Oh, so when you think about who's going to make the money, which layer, infrastructure, the frontier models, you've already got conclusions on that?
Yes. The hyperscalers will make the most consistent revenue and cash flow, and the semis companies will continue to grow. It's going to be more lumpy. There will still be cycles, but we're going to be in much bigger size than we've ever been.
How was the World Cup?
It was phenomenal.
Yeah, I know.
Spain is masterful.
You enjoyed the game?
Absolutely.
Nice being in the stadium?
Yes.
Yeah. I like to think they're here to see us, but they're just here to watch the World Cup final and then make an appearance a few days later.
I'm okay with that.
Right.
It's wonderful to see him in person.
Gil, thank you, buddy. Thanks for dropping by. Thank you. Gil Luria there of D.A. Davidson on the World Cup and on chips and hyperscalers. Let's give an update on news elsewhere this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. U.S. House Republicans approving a budget framework for a $95 billion package. It's part of a two-step process that would let Republicans fast-track $73 billion for the war without Democratic votes and allow for billions more in aid to farmers hit by tariff retaliation and war-related price increases. Paramount's $110 billion deal for Warner Brothers getting conditional approval from the European Union. The green light coming after both companies agreed to address concerns over competition. The merger is still facing a U.S. lawsuit over concerns it could harm competition. Comcast earnings beating analyst estimates. The company's media division boosting revenue by 25% thanks to a series of must-see events, including, of course, the NBA playoffs and the World Cup. And it's Peacock's streaming platform reporting its first ever quarterly profit off the back of all that. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, bracing for higher inflation.
The Iran war is fully back on. You're looking at the impact of higher oil prices kind of feeding through to all of the other economies in the world.
Crude up, bonds down, yields at levels we have not seen so far this year. Veronica Clark of Citi joins us next.
Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The top 2 stock stories so far this morning in the pre-market, both of them not doing so well. Alphabet down by 4%, Tesla down by close to 6%. Alphabet putting up decent numbers for the quarter, overshadowed by a big capex figure and some strong guidance for more. That's weighing on the stock. We're down by close to 4% in the pre-market. Weighing on stocks more broadly, equity futures down across the board. On the S&P, negative 0.2%. On the Nasdaq, by about 0.25%. It's not too dramatic, is it? Because the chip stocks are rallying, going to spend more. They receive and they like it. Those stocks have been doing better over the previous 3 days. They do better again this morning as well. We're still within 2% of all-time highs on the S&P 500, and the chopping and the changes between the hyperscalers and the chips, that story is volatile. It continues. In the bond market, yields up across the curve, particularly at the front end of the curve. 2s in focus, new high for the year. 431, up a single basis point off the back of this move in crude. WTI and Brent. Brent this morning closing in on triple digits, up 5%, 90 yen. On Brent crude. Under surveillance this morning, bracing for higher inflation.
The Iran war is fully back on. You're looking at the impact of higher oil prices kind of feeding through to all of the other economies in the world. Inflation expectations in the U.S. have been somewhat contained, but the market is fully pricing in a hike by the end of the year. So at some point, the market's going to dictate to the Fed what the Fed should do.
So here's the latest this morning. Oil rising for a 5th consecutive day, fueling expectations, possibly, for tighter monetary policy. Veronica Clark of Citi writing, front-end yields have moved higher with energy, but we think markets are underappreciating the extent to which softer CPI will raise the bar for Fed hikes. Veronica joins us now for more. Veronica, good morning.
Good morning.
I'm smiling because I know how difficult this is. Last week, soft CPI, soft PPI, and I think I said to you, it's okay, you know, like the argument's easier for you now.
Yeah.
Is the argument harder again?
Yeah, a bit. I mean, markets are pricing something like a third of a chance of a rate hike next week. I still think, you know, it will come down to the data. We did have that very soft CPI. It was technically negative on the month. That's really rare, and it was very broad-based weakness. And we're finally seeing core PCE inflation that's annualizing close to 2% on a monthly basis. So I do think Fed officials will at least want to see more months of data. And I think what they're going to see in those more months of data is core CPI actually dropping pretty quickly. We'll have that, I think, at 2.3, 2.2% within a couple months. Monthly readings for core PCE, I think that will also look more favorable. And then you get to late September and you get those revisions to core PCE, and I think those will be lower, and it should at least make you question the signal that you're taking from core
You say
PCE.
Fed officials will be maybe waiting for more data. Some people make the argument they've already got what they need. We've got the problem in energy. We've been above target for a long, long time. The problem in energy persists, and we've just heard from a bunch of tech companies that are willing to spend forever a whole lot more. Of course, I'm stretching the truth, but you know what I'm going to get. Neil Dutta published yesterday. He reckons there's a good reason to go as soon as next week.
I don't think there is. I mean, I think, you know, if you're obviously worried about inflation expectations, and yeah, we're watching the impact of energy prices and how that feeds into core inflation, but that has not happened yet, right? We haven't seen it yet. There has been evidence in some other data this year, you know, details of like the University of Michigan survey. People are saying it's a bad time to buy because, you know, times are bad and affordability is, you know, is an issue. And I think that's going to prevent a big increase in core inflation from higher energy prices. People are not acting like they expect higher inflation.
Okay, it's one thing to say that they're not going to hike rates next week. It's another thing to say that they're going to cut 2 or 3 times later this year. How can this be a Federal Reserve that is poised to cut when you have Beth Hammack, Lori Logan, Neil Kashkari, pick your Fed official other than the one who isn't speaking, all seeming to want to raise rates in some capacity or at least remain on hold?
Yeah, something's got to change in the data, right? I think the inflation data the next couple months can get us to price out those hikes. To actually get to cuts, you have to see something in the labor market data. And I think we will. We've had this big decline in labor force participation that's kind of capped the unemployment rate. The trend the last couple years is that you see that reverse late summer, early fall. You do start to see some softer jobs data then, and you start to see the unemployment rate rising. So our forecast, I think we will see an unemployment rate that's closer to 4.6, 4.7. And then, of course, CPI is at 2.2, 2.3, and unemployment rate is rising, then those balance of risks have shifted a lot.
I remember when Mohamed El-Arian used to say, listen to what the companies had to say. You can get a really good read on where the consumer is. And what we've heard from the likes of Capital One, outperforming because charge-offs came in so far below what they had expected. Charge-offs broadly in the financial industry came in far below, and the provisions for credit losses. You're seeing pretty much every metric of the consumer, putting Pepsi aside, do pretty well. I mean, doesn't that give you a sense that things aren't so bad?
Yeah, it's not that the consumer is breaking. We did have some pretty soft real consumption in Q1, though. We do have real income growth that is pretty much flat on on an annual basis. Obviously we have higher tax. They have some larger tax refunds. Maybe that's helped to support the consumer for a little bit. But I do worry that now that gas prices are higher again, that does kind of act as a tax on other consumption. And yeah, you do see people saying that they're not spending.
Veronica, it's not just oil prices. To John's point, this Neil Dutta note that came out, he also said Trump doing Trump things again with tariffs. Can you look through everything? Higher oil prices, higher inputs when it comes to potentially tariffs.
Yeah. I mean, this is where it's important to look at that final consumer's, inflation data, right? That's where, we're looking for the signs of the pass-through. I mentioned how, consumers are maybe not spending this year. In that same University of Michigan survey, we actually did see consumers say that now is a good time to buy because we're expecting prices to go higher. You don't see that this year. So I am, cautious that you might not see that pass-through.
Veronica, it's good to see you.
Thank you.
Keep fighting the good fight. Veronica Clark of Citi, looking for cuts later this year. Still 2 or 3? Where are we at?
2 this year, 1 next year.
OK, all right. It's pushed out a little bit. All right, Veronica, thank you. This is the Neil Dutta note from Renmac. If you are a hawk, you simply say that we have a lot of visibility on what the next few months might look like. Google just announced a boatload of capex. AI demand is perking up. Mideast tensions are worsening, and that's pushing up gas prices into August. The president is now doing what he calls Trump things, again with tariffs. Goes on to say, you don't need any of this, it's been 5 years nonsense. You just talk about the next 5 months.
Suddenly, there's a 36% chance that the Fed is going to hike rates next week. And that had been close to zero after the CPI and PPI came out. So increasingly, people think that there is a greater chance that Neil Dutta is not wrong, that the likes of Lori Logan and Beth Hammack and Neil Kashkari and whoever else come out and say, all right, if we want to hike rates, why not do it now, especially when we don't have to give forward guidance anymore?
At the very least, I'd be surprised if there wasn't any dissent next week. Next Wednesday, you'd have to think one of them makes the move, sticks their hand up and says, let's go.
Maybe that's why there's going to be a press conference. Maybe because he could explain why there was a dissent. I mean, it's sort of interesting. He only speaks when he has something to say. So he has something to say next week because evidently, as we learned yesterday, there is going to be a press conference.
I've heard him say that. And then I saw him on the panel in Sintra and just thought, OK, maybe he does speak when he's got nothing to say.
Who among us doesn't?
Feel the same way sometimes. Coming up next, Jim Caron of Morgan Stanley, Republican Congressman French Hill, Ben Callow of Baird, and Dara Mayer of HSBC. The second hour of Bloomberg surveillance just around the corner.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
You're not where you need to be on inflation.
Interest rates may just be too low for the level of inflation that we have.
The economy is still fundamentally in a good place.
There's not an urgency for the Fed to hike.
Inflation is not hot enough to really see the Fed doing that.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equities declining by 1/3 on the S&P, on the Nasdaq. No drama here, still within 2% of all-time highs. Some violence beneath the surface. Strong word, I know. We'll talk about Alphabet and Tesla in just a moment. In the bond market, some trouble. 2s, 10s and 30s, new highs for the year. The 2-year this morning through 430, up a single basis point. The 10-year approaching 470, and the 30-year comfortably above 5% for quite a while now. If you turn to the commodity market, the Y looks like this. Brent and WTI pushing higher. Check it out. If you took a few weeks off for the summer, welcome back. We're no longer in the 60s. We're in the 90s on WTI, 98 on Brent, and threatening to break into triple digits.
I think nobody really took the summer off, and I think that what you're going to hear is that people have been trying to ignore this story as they look at all of the capital markets booms that have been going on. And the question here is how many pillars of the market are being challenged. On one hand, you have this question, big tech continuing to outperform, but continuing to need to raise tons of cash. At the same time, the oil prices really pushing everything higher. And ultimately, there is no solution here. When you talk to experts, what's the exit strategy in Iran that can actually cause some of the oil flows and other commodities through the Strait of Hormuz and, frankly, the Red Sea?
Well, this administration clearly thinks that they could try to get the Iranians to the negotiating table by having them capitulate, by continually having these attacks, which we saw last night, a 12th straight night of attacks. So the Iranians are saying, well, actually, we're going to have our proxy now get involved. It was a threat. Now it's a reality, and the individuals I'm talking to this morning are saying none of this is a surprise. If you have been paying attention to this conflict and how these people operate for decades, none of this is a surprise. The question is, what's the plan going forward?
Crude is in the driving seat. Look at what it means for rates and the outlook for interest rates as well. 2s at 430, again, even within the last week, softer CPI, softer PPI. Check out 10s pushing 470. 10-year yields are basically at the height of the year. And it's not triggering a response where we see a risk aversion story build in equities and money goes back into bonds. What's interesting about this moment, Bramo, and you touched on it an hour ago, is that people aren't willing to step in to buy these yields in quite the same way as they might have done in the past, that we're holding on to these levels for longer than I think many people thought we would.
Yeah, you put into the study that Bloomberg did about how we're seeing the longest streak above 5% in the 30-year going back to 2007. Part of this is just because the economy isn't crashing. And this is what Russ Kostridge said. If the economy is not crashing, it can't act as a counterweight, as a hedge to equities. Also, there's so much competition. This bleeds into the tech story as well, because if hyperscalers are selling $20 billion bond sales as if they're selling lemonade, suddenly you got a problem if you're also trying to sell 60, 70, 80, $100 billion a pop of treasuries. So all of these things leading to also a global story, because that dynamic is happening from Japan and from Europe.
It's the crowding out dynamic we've spent a lot of time on this program. Coming up later, 8:15, an ECB rate decision. Look out for that. Look out for this too, some data at 8:30. Jobless claims will come. They will go around 2:15 due to the story. If it changes, that's news. We'll see if it does. 8:45, we'll hear from ECB President Christine Lagarde. I'm thinking back to Isabel Schnabel, an executive board member over the ECB just a number of weeks ago, saying you can no longer look through this shock. How strong is the hawkish argument at these central bank meetings today at the ECB and next week at the Federal Reserve?
So they have to respond to markets that are increasingly pricing in almost 2 rate hikes by the ECB after pricing in just 1 before this conflict reignited a couple of weeks ago. So ultimately, do you hear the hawks come out and out-hawk any doves left? But I don't think that there are any doves left right now.
Futures down by a third on the S&P. Coming up, we'll catch up with Jim Caron of Morgan Stanley as Alphabet earnings failed to spark a rally. The Republican Congressman French Hill as the House backs Trump's $1 trillion defense budget, and Ben Callow of Baird with Elon Musk's spending plans weighing down Tesla's stock. We begin this hour with stocks adding to losses following an underwhelming start to tech earnings. Jim Caron of Morgan Stanley Investment Management joins us now for more. Jim, welcome. The numbers from Alphabet, the numbers from Tesla, do we have a capex problem, a spending issue, or a positioning and price problem in this market?
I think it's a readjustment in prices, honestly. I mean, look, there's been a lot of expectations. For many of these companies, the earnings have been decent. It's just that they're not beating expectations in the way that maybe, people want them to going forward. And look, the earnings run so far for the first half of this year have been very strong. Of course, the markets are forward looking. They're looking into the next 6 months, into the next 12 months. And what they're saying is that the pace of earnings is just not going to be what it was, because effectively this run rate of very accelerated earnings is really unsustainable. But that's okay, because these companies in this sector has actually been performing not so well this year. It's actually, the value sectors, the broadening of the market, that's done better this year so far. So I think markets are being very efficient in terms of taking down some of these, more technology company prices and the growth sector prices in anticipation of slowing earnings going forward. So this isn't, to me, an alarm bell. It's just a natural progression of the earnings cycle.
So, Jim, just to build on that, peak earnings growth is a sufficient enough reason alone to stay away from these names?
I wouldn't say that, because it's a question of the valuation. I think that, yes, second quarter earnings will probably mark the peak. I mean, it's going to be hard to beat that going forward, but that doesn't mean that the cash flow and that the run rate of cash going forward is going to all of a sudden dry up. Look, what we're hearing from the broader economy is that they have a lot of demand for technology, for compute, and for all of these things that many of these hyperscalers provide. So the demand, I think, is going to be there, and it's only going to grow. It's just that the earnings growth rate may not be as fast as it was, like in the first half of this year, just going forward. And I think that's why these, many of these companies are adjusting in price, and that's actually a very good, healthy sign. And meanwhile, John, as all of this is happening, the equity markets are holding up, and they're holding up because the market's broadened out. So to me, this is, this is okay.
How unusual is it, Jim, to see the stock market holding up and the broadening out continue with yields continuing to climb?
If we were having this conversation 6 months ago, 9 months ago, we would have said that if many of these hyperscaler stocks go down and bond yields go up, that would absolutely spell a disaster for equity prices broadly. But that's not happening right now. And I think that's a really important signal for us to take away. So is it unusual? Yes, it's unusual. Is it a shock right now? No, because what we're seeing is the other sectors of the markets, the other broadening. If you look at the healthcare sector, if you look at the consumer, if you look at financials, if you look at industrials, if you look at materials, all of these other sectors are holding up, and they're making up for some of the losses that we're seeing in the technology sector that people were, quite frankly, worried about.
Let's say next week, Kevin Warsh comes out and announces that the Fed had just hiked rates by 25 basis points, is prepared to take further action to limit inflation, and frankly, gives what the market already has priced in. Would that affect things in a negative way or in a positive way?
Yeah, that's a really good question. I'm going to say that it's actually going to impact things in a negative way. And the reason I'm going to say that is, number one, I don't think that the Fed is going to hike rates, this year. But the other issue here is that this is a supply side shock. The Fed's tools, monetary policy, is there when the economy is overheating because of demand side issues, that are taking place. Higher wages, rampant hiring, a lot of spending, things like that. When you have a supply shock, when you have an oil or an energy, shock that's coming through, a rate hike is basically just saying we're going to hike into something that's going to slow the market in the future. Higher oil prices is a headwind to the market. Why would you hike into a headwind into the market? It doesn't, to me, that doesn't make a lot of sense. So that's why I think the markets would take it negatively.
When it comes to what they should do, though, higher oil prices potentially can become entrenched in this economy, especially when you're dealing with an economy that is farm to road to table when it comes to things like groceries. At some point, is the Fed going to have to move, given the fact that last year they said the cuts were insurance cuts?
Yeah, so if it does become a pervasive, higher level of inflation that's seeping into the core, and it's becoming very, very permanent, then, absolutely, the Fed would have to hike interest rates. I don't think that we're there yet, though. I don't think that we're seeing really, the material signs of that would be running through their large-scale macroeconomic models, what they call the FRB-US models. So I still think, look, there might be a dissent. I mean, and I think that Warsh needs to explain that. But I think that, a lot of what Warsh is really looking at is his task force and trying to decipher the data and have new data points come in that can help him, disseminate this information. But and it's a great question, but I just don't think that we're at the point where we're seeing widespread inflation to the point where the Fed would feel the need to hike interest rates, at least not at this moment.
Jim, this is new territory. And given the average age on a trading floor right now, it might be territory that they've never experienced before. We're going into a meeting next week and we don't really know what's going to happen. And that might be a feature, not a bug, of new leadership. You've written about this, Jim. Do you think they are strategically reintroducing volatility into the front end of the curve? Can we just start there?
Yeah, I do, John. I mean, look, so the way that I think that Warsh is approaching this is that he wants to have more contemporaneous, more real-time policy reaction, meaning, Fed interest rates hikes and cuts and, depending on the cycle. Think of the front end of the market as the shock absorber to inflation and inflation expectations. If you get the shock absorber right, you get a smooth ride for the back end of the curve. And the back end of the curve could get more normal, stabilized interest rates. And that's where most people borrow. That's where corporates borrow. That's where people borrow for mortgages, for cars, autos, and everything else. So I think the uncharted territory that we're moving into here is that Warsh will likely be more volatile in terms of his short-term views on inflation and interest rate policy, but that's there to smooth out the long end. And I think this is a very, very different Fed right now that's going to introduce more supply-side indicators, not just rely solely on demand-side indicators to help make their policy decisions going forward.
We'll see if it works. We'll see if it caps long end yields. Jim, thank you, sir. Certainly not this morning. Jim Caron of Morgan Stanley. The post-GFC hand-holding might be ending. this Federal Reserve, and that's an adjustment process that everyone needs to go through.
If the goal was to reintroduce more volatility to control the long end, as you point out, it's not working in terms of controlling the long end. If it's intervention when it comes to the balance sheet that could potentially offset this, or Treasury issuance on the front end, maybe then you start to see more of an influence. At a certain point, though, verbal intervention is only going so far.
It's a process. We're working through it. I think it's notable that we go into next week without really knowing what's going to happen.
Totally agree. I think it's fascinating.
And that might be a feature, not a bug, for a new Fed chair.
No forward guidance.
Right? It's a whole new world. It's the old world. Let's get you an update on news elsewhere this morning. Manus used to sing that daily, right?
As she said it, I literally thought I'm having flashbacks to anchoring with Manus Granny.
Manus used to sing that every single morning. Let's get you Bloomberg brief. Fonnie has more. Hey, Fonnie.
Hey, John. The ECB expected to leave interest rates unchanged as policymakers assess the impact of escalating tensions in the Middle East. The decision coming at 8:15 Eastern and President Lagarde's news conference 30 minutes later. Investors will be listening for clues on whether a September hike is likely. Mobileye reporting second quarter earnings that beat estimates. The company also announcing its founder and CEO, Amnon Shashua, is stepping down. Tune in to BTech at 11:15 Eastern for Ed Ludlow's interview with Shashua. An external review of the 2023 failure of Silicon Valley Bank could lead to a shakeup at the Federal Reserve. Sources telling us here at Bloomberg it could provide a legal basis for removing Fed Governor Michael Barr, who had been responsible for banking oversight when SVB collapsed. And that is your Bloomberg brief. John.
Bonnie, thank you. Thanks for the update. Up next on the programme, doubling down on the war.
We don't need the Hormuz Strait, but we do it because we have to do it, because we cannot let Iran have a nuclear weapon. They're getting hit so hard, and they want to make a deal. But I say they're not ready to make a deal. They'll be ready very soon.
Up next, Republican Congressman French Hill, live from New York City this morning. Good morning.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Alphabet in the pre-market down by 4%. In early trading, pulling back following pretty decent results. In terms of earnings, revenue growth, tremendous. $25 billion, around that for cloud revenue. $2 billion plus more than estimates. Backlog is building, all of that's good stuff. CapEx seems to be grabbing the headlines. CapEx is building, free cash flow, negative free cash flow, Bramo, that's in focus.
Yeah, the idea that suddenly they had their first quarter of negative free cash flow in their history since 2016. Also notable that they're increasing their planned expenditures potentially as a result of just higher component costs and, frankly, not giving any guidance as to when it's not going to increase anymore. And you can imagine that the others, the Microsofts, the Amazons, as well as the Metas, are all going to do the same thing, which means that $725 billion of CapEx this year is probably a whole lot higher.
Futures this morning pulling back, but only by a third of 1%. We'll pick out some of the chip names. Tesla spending more, Alphabet spending more. Chip names are doing OK for that reason. They have been gaining over the last 3 days. We've actually got some stability after they entered bear market territory just last week, which followed a run-up of like 90% in Q2. So that's the wild ride for chips. The Nasdaq this morning down about 0.4. Bonds, new levels. Let's get to it. Yields, 2s, 10s, 30s, 430 something on 2s, closing in on 470 on 10s, closing in on 520 on 30s. And more importantly, getting to these levels, the upper end of the range for the year and holding them. And that's what we've been doing over the last several weeks. The last several weeks added some weight to this rally in crude as well. We've added around $25 to $30 to the price of crude just this month alone. Brent crude 98, WTI around $90 this morning. Under surveillance this morning, doubling down on the war.
We don't need the Hormuz Strait, but we do it because we have to do it, because we cannot let Iran have a nuclear weapon. They're getting hit so hard, and they want to make a deal. But I say they're not ready to make a deal, because every time they make a deal, they want to change it and everything. They're not ready. They'll be ready very soon.
So here's the latest this morning. House Speaker Mike Johnson delivering a win for President Donald Trump's effort to fund the Pentagon. The House narrowly passing a record $1.15 trillion defense bill, setting up billions more in spending for the war with Iran.
So when it comes to this, the president really wanted Congress to act. The House did. The issue is we're probably not going to see the Senate take this up very quickly. This is part of reconciliation. They approved $95 billion. Part of that, as you mentioned, $73 billion in funding for the Iran war, $12 billion in farm aid, and $10 billion aimed at incentivizing states to adopt elements of the Save America Act. So all these are the president's priorities. The issue is only the House was able to push it forward, and it potentially might be a very hard vote ahead of the midterm elections for some individuals to take that vote, and I don't see Senate Majority Leader Thune acting on this very quickly.
Well, let's talk about the view from the House. The Republican Congressman French Hill voting to pass the budget, saying that bill, this bill, ensures our military has what it needs to deter our adversaries and defend American interests around the globe. Congressman Hill joins us now for more. Congressman, welcome back to the program. It's been too long, my friend. Let's get into some of these issues. You understand well the asymmetric nature of this conflict we have at the moment. The American workforce, the American military is spending an absolute fortune right now to fight and defend American interests and global interests, for that matter, in that strait. The Iranians are able to use very cheap one-way attack drones. Do we really want to get drawn in to an enduring billion-dollar skeet shooting over in Iran for as long as the eye can see?
Well, first, thanks for having me back. It's always good to be with Team Bloomberg early in the morning. The spending bill for budget reconciliation was important to make sure we keep our stocks high. And I think it's important for the American people to understand that after decades of trying to pay the Iranians, offer the Iranians diplomatic capability, the long-standing Obama negotiation, the risks to Iran having a nuclear weapon were rising, and Iran's provocative nature threatening its Gulf neighbors, using terror with the Houthis to close the Red Sea, to attack Gaza, to continue to disrupt in Syria and Lebanon. I think the president just took the decision we have got to prevent them from having a nuclear weapon, which she initiated this spring. So I agree that Iran shouldn't have a nuclear weapon, and we also need global open seas in the Persian Gulf. I would hope that we would have more support from around the world for those international waters, and I think that's something that I've been a little disappointed in our strategy, is not the maintenance of those sea lanes.
Well, we do have the Senate Majority Leader, though, when it comes to the funding, saying earlier this week that he's not going to move on the House budget blueprint until the Senate solves the September 30th funding fight. So when do you actually think we're going to be able to get that money that you think is critical to our troops and military actually out the door?
Well, I would hope we could get that done before September 30th is the answer to your question. I think Senator Thune recognizes that the House has now passed also, you didn't mention it, but a continuing resolution fully funding the government until December 4th. That's also a tool that John Thune has that he can bring to the Senate floor, because he's fearful that Democrats in the Senate, once again, to try to get an election advantage if somebody considers it one, will try to shut the government down. Chuck Schumer's done that twice over the last, during this Congress, for the longest shutdown in American history. And what I think John Thune has now in his arsenal of suggestions is, one, we have a CR to fund government with no additions through December 4th so that we don't have a government shutdown. And secondly, he could use the Budget Reconciliation Act in the Senate potentially to fund government for the rest of the fiscal year. So he's got some choices, and I'm sure he'll work with his new Budget Committee Chair, Senator Johnson, replacing Lindsey Graham, on what those options are.
Was this a hard vote to take? The majority of Americans oppose this war, and now gasoline prices are north of $4 a gallon across the United States.
Well, I don't think anyone wants high gas prices. There's no question about that. And it's unfortunate that the Iranians don't recognize that they have a once-in-a-lifetime opportunity to return their country to an open society that lives in peace with its neighbor, not the largest exporter of terror, or threatening Europe and Asia with ballistic missiles and a nuclear weapon. And so I think that balance is pretty clear to me. It's been 50 years, my entire working career. We've faced assault from Iran, killing Americans, killing our allies, threatening our interests, trying to assassinate our officials on our own soil here in the United States. And so I think that balance is just something we have to cope with. But no one wants high gas prices. What we want is the Iranians to come to the negotiating table and stick with a deal. And that's what we need to continue to have our allies, including the Pakistanis and others, help forcefully make that case.
Congressman, can we afford a protracted fight right now with our yields climbing, with our deficits climbing, with the bill already significantly higher than some people were prepared to pay for?
Look, it's not whether we can afford. There are a lot of challenges that we have in the world that we have to be prepared for. China infiltrating our telecommunication networks and threatening our infrastructure here requires a major investment. Countering that is a significant investment. Countering terror around the world that threatens our interest and our allies' interest. Countering Putin's advances in Europe and his unwillingness to quit his invasion of Ukraine. All these things cost money, and America is in a leading position, both in intelligence and in military affairs.
Congressman, I guess I'm watching the bond yield space, not to surprise you, here in my seat, but I'm watching how yields have reached the highest levels going back to earlier of last year, looking at the fact that a rate hike is almost evenly priced in next week for Fed Chair Kevin Warsh. Do you think it's appropriate to potentially hike rates a bit to bring down the long end of the yield curve as the U.S. is facing all these bills that are getting more expensive to pay?
Well, that's a decision the Federal Reserve will have to make. I think what we have to do in Congress is make sure we meet the needs of the national defense to counter the threats that we have, that are threats that we've inherited for decades and coped with for decades. These are not new threats, not new forces that we face, whether it's Ukraine, the Middle East generally, the Gulf, or Iran's threatening in the region. So I just think we have to be prepared. Preparing for a common defense and funding that is one of our most important obligations here in Congress. We, of course, want the Iranians to come to the table. You've seen the volatility since February in global oil prices based on what's happening there. And the minute they come to the table, bring peace and work with their neighbors to reopen the Gulf, I think you see, obviously, gas prices and crude oil prices drop precipitously, as we've already witnessed at least twice in the last few months.
Congressman, appreciate your time, sir, and good to see you finally get some testimony from a Fed chair based in the Middle East. Up next, Ben Callow of Baird on Elon Musk's big spending plans.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Every trading day, only on Bloomberg.
So we're lower, softer, negative. We're down by 0.5 on the S&P. We're down by 0.6 on the Nasdaq 100. Beneath the surface, some single-name stories. Yohara will get to Alphabet in just a moment. That's the index-level stuff. Still within 2% of all-time highs on the S&P. 10 to the bond market, new highs for the year. 2s, 10s and 30s. Bonds down, yields up by 2 basis points at the front end of the curve, up 3 at the longer end of the curve. We are just about taking out the highs of the year on a 10-year, 468, getting closer to 470, on 30s getting closer to 520. And this move in crude's not helping. We've said that repeatedly. WTI and Brent. Brent crude closing in on 99. WTI now into the 90s. Only a few weeks ago, it was in the 60s. And if you turn to the bond market again and just sit on yields, this market, cross-asset, there is a lot of paper competing for capital right now, and that includes the Treasury as well. Typically, these sell-offs are self-limiting. Money comes in, things settle down, and if it causes a better risk aversion in risk assets, the money goes back into bonds. You haven't seen that in a big way.
In part because the economy is still chugging along and you are seeing incredible amounts of issuance. So if you are a bond investor, suddenly you have leverage to determine where you want to put your money and potentially what kind of yields you can demand to have the privilege of lending it out. And this is the reason why it's been the longest streak above 5% for the 30-year Treasury going back, as Bloomberg calculated, to 2007. Does this raise a problem, or is this a feature of the moment, given the fact that this is a strong economy that can sustain itself even with yields at this level?
It's a slow bleed, and we just hold on to those levels across the curve, 2s out to 30s and 2s comfortably above the policy rate of this Federal Reserve, going into that meeting a week away. As we count you down to that meeting and the opening bell as well, let's get you some morning movers, some single names. Yohara has more. Hey, Yohara.
Hi, John. We start with our latest earnings out this morning, and we are seeing American Airlines down 2.5% in the pre-market after the carrier warned it could swing to a full-year loss as fuel costs continue to eat into profits. And that stands in contrast to its rivals, the likes of Delta and United, which earlier this reporting season did reaffirm or raise their outlooks. Meanwhile, we are seeing Alphabet shares falling in the pre-market, down nearly 5% now, as it raised its capex plans yet again to as much as $205 billion this year. And that's notable because Alphabet had been viewed as one of the companies where you saw AI translating into growth. Instead, the reaction suggests that investors, they are starting to question whether the spending is getting too big, even after Google Cloud revenue surged 82% from last year. And as Mandeep mentioned earlier in the program, margins came in much better than expected. And we turn to Tesla. Those shares now down 6.5%. And the debate around AI spending there looks a little bit different because investors had been wanting the company to ramp up spending because its future hinges on these futuristic products like robo-taxis, which are pricey. And while it did reaffirm its spending plans, which is more than $25 billion this year, the company posted a big earnings miss, just showing you how investors still want to see that payoff from all those investments. John.
Yohara, thank you. More from Yohara in the next hour. On our radar this morning, Iran-backed Houthi militants attacking 2 oil tankers in the Red Sea is their first attack on commercial ships since the war broke out and threatens the closure of another another key choke point in the Middle East. Elsewhere, a review of the collapse of Silicon Valley Bank is sparking a political battle. Sources telling us here at Bloomberg that some officials are weighing removing Fed Governor Michael Barr from the board. Barr was vice chair in 23 when the bank collapsed. And finally, Uber cutting 10% of its customer service roles as it pivots more towards AI. The company highlighting they've already made strides in using the technology, saying the move will help further streamline operations.
And this follows another round of cuts at Uber earlier in June in its so-called people division. A significant part of that, although they don't break out exactly how much that is, of the overall staff. There have been a number of companies that have come out and made announcements like this. Block, Oracle, others that have said this is an AI-related round of layoffs. They've been treated differently. Sometimes it's treated as just they overhired. Sometimes it's treated as actual efficiencies. But what we're hearing from companies is it's not this obvious. You can cut staff in one place, but you're going to have to put the money in other places as well. It's not as clear of an efficiency. In some ways, are stock markets looking for that type of efficiency and just not getting it? I'm not sure what the full read-through is, but when you talk to people like AT&T, they're saying anything that we save, we pass to our bottom line. It's not going to ultimately help us. So this is a reason why you're seeing sort of an ambiguous reaction in markets.
And you make a great point. The fact that they already did layoffs, and this is the first time they're tying it to AI. So you have to think, is AI just the latest flavor? Is this the scapegoat to actually shrink their workforce? It comes at the same time that Jensen Huang is saying the fact that this is going to destroy half of the American jobs is complete nonsense, talking about AI. I'm hyper-focused on what companies do when it comes to blaming job losses and letting go of employees because of AI, because this is going to be a massive midterm election issue, and this will be the issue for 2028.
I totally agree with you on the politics. For now in the market, I'm focused on the ROI. Uber's an interesting example because earlier this year, they were the example of a company that was rationing spending internally on AI. And this is a suggestion this morning that they've optimized that spend and found a good use case for it, at least with regards to customer service. And if you are bullish on these themes right now, you might point to that and say, a lot of people are pointing to Uber as part of the bear case. This morning, I'm not sure you can do that.
Well, ultimately, this is return on investment that they want to be able to see and they want to be able to disclose. What's interesting is how few companies have actually done so. Uber is talking about it in customer service capacities, and we've heard that from other places. I mean, we did hear the same thing from AT&T. What you do with those savings, though, is another question. I mean, I'm sure there have been layoffs in a lot of places, but they haven't announced them. Maybe Uber's trying to prove the ROI in some capacity. What you are hearing, though, is that they're putting that money elsewhere, which is causing jobs to be created, et cetera, or potentially just give them a better competitive landscape. It's unclear to me why companies would keep spending the same level of what they have been on AI, given the fact that they cannot articulate an ROI to investors. It's just going to make them better, more competitive, broaden their footprint. It's an interesting moment that's not so clear-cut.
I don't like the chatbot service operators anyway. Do you? Not a big fan.
I don't love them, but I will say one thing about Uber. And Lyft, by the way, if you say this is why you canceled your car and they think it's an acceptable reason, they immediately refund you.
Okay.
And you don't have to go talk to anyone anymore. That is all automated now.
Okay.
I love that.
Sometimes. Because sometimes they don't. Because I've had that fight as well more recently.
Oh, really?
With the likes of Uber, yeah.
And you have to get on the phone with a human?
No. I just haven't dealt with it and I've waited. I don't want to go into too much detail because, okay, I will. Because we're here now. So we're doing it. If you schedule the car, right?
This has now acted very professionally and smart. And that is your Bloomberg Brief, John.
Bonnie, thank you. Thanks for this morning. Up next, an ECB news conference with Christine Lagarde. That just moments away. Live from New York City, you're watching Bloomberg TV.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Markets are being very efficient in terms of taking down some of these more technology company prices. This isn't, to me, an alarm bell. It's just a natural progression of the earnings cycle. All of these other sectors are holding up, and they're making up for some of the losses that we're seeing in the technology sector.
Jim Caron and Morgan Stanley Investment Management on the tech earnings so far this morning. Tech very much in focus, but this is where your morning begins and ends so far. Crude, the energy market. We are approaching $100 a barrel. Just a few tenths away of 1% from $100 and triple digits on Brent. 99.60. With that move in crude, this move in bonds, yields higher across the curve. 2s, 10s and 30s. 2s, we've gone through 420. We've gone through 430, and now we're having a little look at 440 of 6 basis points on a session at the front end of the curve. We just broke 470 in the last hour on 10s, and 30s having a look at 520. With yields breaking out, equities are breaking down. Equity futures on the S&P on the Nasdaq this morning. We're down by almost 1% on the S&P. On the Nasdaq, Bramo down by 1.3.
Yeah, we're starting to see the point at which yields are really biting into risk appetite. Interesting to see that technology is taking the hit most significantly after earnings that came in better than expected, at least on a lot of the headline numbers for Alphabet. But ultimately, what we're looking at is a supply-side shock hitting an economy that can withstand it. So this is a reason why people are saying that ultimately these yields can persist. They're not getting the bid into them that they might have previously gotten at these levels.
Heading into this news conference with Christine Lagarde with the euro at session lows at 113.78, the euro negative by 1/3%. Bond yields in Germany in focus, the 2-year at the start of the month. The 2-year in Germany was around 250, and now right now it's around 290. We have had a move of more than 30 basis points at the front end of the German curve coming into this ECB meeting. Now, they haven't hiked interest rates today like they did last time, but the conversation's not going away. And the hawkish risk has been reintroduced off the back of this move in the oil market.
Yeah, and Mark Wall from Deutsche Bank really nailing it. The question is, are they going to raise 2 more times this year, or are they just going to raise rates once? Initially, before the renewed tensions in the Middle East, you saw 1 rate hike being priced into the ECB. Now you're solidly with 2, with September very much a live meeting.
I'm reminded by a viewer to remember what Jeff Curry told all of us months ago. Buckle up and get long. And it feels like we're at that moment now, especially since, and he said recently, we're no longer living with oil glut. We are living on inventories right now and the reserves. And at the same time, we have 2 choke points now having massive issues in the Middle East.
It's different this time around. A few months ago, we had a big cushion and only 1 choke point. Now, to your point, we've got 2 and a much smaller cushion. And for this ECB and for central bankers alike, and I think for this ECB specifically, this is the concern for them, second round effects. Can they make the argument there are severe concerns around second round effects? Is that labour market strong enough? Is that economy strong enough in Europe to make that claim this morning?
We've heard mixed things. On one hand, you've seen earnings actually surprising to the upside in Europe at a significant pace, and you're seeing enough strength for it to avoid recession. On the flip side, could that be torpedoed by rate hikes in addition to natural gas prices at such elevated levels? Look, it's naturally a tax on the consumer when you have natural gas prices at the highest in Europe going back to 2022. Nonetheless, this is a single mandate central bank, and this market is expecting them to move.
No forward guidance from this ECB. I wouldn't expect any forward guidance in this meeting, but you need an assessment of where we are for us all to try and work out where we're going and how they'd respond to incoming information to articulate the so-called reaction function. We're a week away from a Fed meeting and have absolutely no idea what this Fed's going to do. That's interesting. That's new territory. Typically, since GFC, they've been holding our hands, telling us exactly what they would do before they even do it, telling us what they won't do before they even don't do it. And this time around, you've got to take a guess. And the same applies to the ECB. The ECB news conference just underway with the ECB President Christine Lagarde. Let's take a listen.
To keep the 3 key ECB interest rates unchanged. The outlook for energy prices, while highly volatile, currently stand close to the baseline of the June Eurosystem staff projections and well above the levels recorded prior to the conflict in the Middle East. Uncertainty remains high, and the full inflationary impact of the energy shock has yet to play out. We are therefore closely monitoring the intensity and duration of the shock, as well as its indirect and second-round effects. We are committed to setting monetary policy to ensure that inflation stabilizes at our 2% target in the medium term. With today's decision, we remain well positioned to navigate the uncertainty caused by the conflict. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, recent inflation points to some improvement in economic activity in the second quarter, even though the conflict in the Middle East remained a headwind. Surveys suggest that activity in the services sector has partly recovered after weakening markedly in the immediate aftermath of the energy shock. Digital services have been robust, in part owing to the increasing contribution from AI-related activity. Manufacturing has continued to hold up, supported by firms building up stocks to guard against supply chain risks, as well as by higher defense spending. Unemployment stood at 6.2% in May. At the same time, job postings have continued to decline, and both firms and households expect the labour market to remain weaker than before the conflict. Forward-looking indicators suggest that economic growth will remain modest in the near term, weighed down by the energy shock and related uncertainties. Yet the fundamental drivers of medium-term growth remain intact. Private consumption, investment in new digital technologies, government spending on defense and infrastructure, and some recovery in exports should all contribute to overall growth momentum. The Governing Council reiterates its call for urgent action to strengthen the euro area economy while maintaining sound public finances. Simplifying and harmonizing rules across the EU's single market, accelerating the energy transition and completing the savings and investments union are key building blocks. Fiscal responses to the energy shock should be temporary, targeted and tailored. The positive vote in the European Parliament earlier this month was a significant milestone on the path to establishing the digital euro. We welcome the shared objective of the Parliament, the European Union Council and the Commission of reaching agreement by the end of this year on the single currency package. The digital euro will complement physical cash with its digital equivalent, providing a means of payment for any digital transaction throughout the euro area. Let me now turn to inflation. Inflation declined to 2.8% in June from 3.2% in May. Energy price inflation declined to 8.5% after 10.8% in May, while food price inflation fell from 1.9% to 1.5%. Inflation excluding energy and food eased to 2.4% from 2.6% in May, with goods inflation decreasing from 0.9% to 0.7%, and services inflation from 3.5% to 3.2%. The energy shock continues to feed into higher prices. It is becoming more expensive for firms to source inputs, and they therefore expect to put up their selling prices. While developments in underlying inflation have remained contained, the full effect of the energy shock have yet to play out. The ECB's wage tracker and surveys on wage expectations continue to indicate moderate wage growth over the coming quarters. Rising labour productivity has also helped contain growth in unit labour costs. Inflation expectations over shorter horizons remain at elevated levels. Most measures of longer-term inflation expectations stand at around 2%, supporting the stabilization of inflation around target in the medium term. While energy price inflation declined in June, its rise since the start of the conflict and its impact on food, goods and services price inflation is likely to keep inflation well above target into the first half of 2027, Inflation should then decline as energy prices are expected to fall and other prices should rise more slowly. However, the conflict remains a major source of uncertainty. We are therefore closely monitoring the size and persistence of the energy price increase and how it feeds through to price and wage setting, inflation expectations, and the overall economic dynamics. The risks to the growth outlook are to the downside. While the Memorandum of Understanding agreed between the United States and Iran in June constituted a first attempt to resolve the conflict, recent weeks have brought renewed setbacks, and the geopolitical situation remains fragile. Renewed disruption of energy supplies could increase energy prices further and for longer than currently expected. This would weigh on real incomes, spending, and investment. A worsening of global financial market sentiment or a tighter supply of credit could dampen demand. Additional frictions in international trade could also further disrupt supply chains, reduce exports, and weaken consumption and investment. Other geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, growth could turn out to be higher if the economy and energy markets were to adapt more quickly than expected to the disruption caused by the conflict in the Middle East, or if the conflict was resolved sustainably. Moreover, planned defense and infrastructure spending and reforms to enhance productivity and complete the single market, as well as euro area firms adopting new technologies, may drive up growth by more than expected. The risks to the inflation outlook are to the upside. The energy shock could intensify further, and its effects on other prices and wages could be stronger than currently expected. The longer energy prices stay high, the more likely they are to drive up broader inflation through indirect and second-round effects. Ongoing trade tensions could give rise to more fragmented global supply chains, curtail the supply of critical raw materials, and worsen capacity constraints in the euro area economy. Extreme weather events, as illustrated by the ongoing heat waves, and the unfolding climate and nature crisis more broadly, could drive up food prices by more than expected. By contrast, inflation could turn out to be lower if the conflict in the Middle East was resolved sustainably, or if indirect or second-round effects proved less pronounced than anticipated. More volatile and risk-averse financial markets could weigh on demand and thereby lower inflation as well. Overall, financial conditions have become slightly tighter since our previous meeting, consistent with the increase in the key ECB interest rate. Bank lending rates for firms and the cost of issuing market-based debt remained unchanged in May at 3.6% and 4% respectively. The annual growth rate of bank lending to firms increased to 4% from 3.4% in April, but this was partly offset by slower growth in corporate bond issuance, which fell from 4.5% to 3.4%. Credit standards for business loans tightened somewhat in the second quarter, as reported in our latest bank lending survey for the euro area. Demand for loans to firms increased slightly, driven by higher working capital needs, but also by borrowing for fixed investment by large firms. Mortgage rates rose to 3.5% in May, after 3.4% in April, while mortgage lending growth edged up to 3.1%. Credit standards for mortgages tightened in the second quarter as banks became more concerned about the economic risks faced by their customers and less willing to take on risks themselves. Demand for mortgages decreased on the back of deteriorating consumer confidence and higher interest rates. So in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are committed to setting monetary policy to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you.
First question goes to Annette Weisbach of CNBC. Annette, please.
Good afternoon, President Lagarde. My first question goes onto the discussions which you had today. So just to get an understanding of how you have discussed the recent spike in energy prices and what it also means for policy setting going forward. I know you don't want to pre-commit, but still the communique and also what you're saying today, at least in my understanding, reads rather to err on the side of being more vigilant about the price development. My second question would be on, have you discussed the rise in bond yields? Because they are also increasing. And do you factor that into an assessment of how tight monetary policy is actually here in the euro area? Thank you.
Thank you very much for your two questions. So we spent the last 2 days with members of the Governing Council really looking at all the data available and assessing the situation since the last monetary policy decision that we made back in June. And I'm saying back in June because there's a lot of back to the baseline in the situation that we are facing at the moment. So the analysis that we conducted, fed by staff work analysis, really looked into what has happened since June and what policy decision should we make as a result. So since our decision in June, we have had some relatively benign development. You look at inflation, which came out much lower than anticipated, 2.8 versus 3.2, difference relative to our anticipation. You look at economic activity, taking out Ireland, it's a relatively good progression, 0.3. And then, of course, the Memorandum of Understanding, which preceded a ceasefire, which led to significant decrease in at least crude oil prices, probably faster than we had anticipated. But that was the first part of that period of time. Then came the second part, where this Memorandum of Understanding was short-lived, ceasefire was broken several times and led to the current situation where we have clearly a flaring up of the conflict and serious development taking place on the commodity markets. So that's what we considered throughout the last 2 days. And we really applied the method that we have agreed amongst ourselves in such a shock, which is to really try to understand the density, the durability and the propagation effects of the supply shock. That's what led us to take the decision that we took this morning of holding our rates for the moment. You asked me about the euro area bonds. You know, we take at a certain point in time, because there's a cutoff date at which we stop the clock, if you will, but we take all market conditions, including, of course, the euro area bonds, their evolution in that process. So this is part and parcel of, number one, the baseline, and number two, the assessment that we take on the occasion of this meeting. There is one difference that I'm sure you have noticed, which has to do with our risk assessment. When I say we're back to the baseline, we're also back to the risk assessment that we conducted back in June. And if you remember at our conference in Sintra, I did refer to more balanced. I didn't change the direction, but I used the reference to more balanced upside and downside risk, respectively, for inflation and growth. That segment, more balanced, has been removed. And obviously it reflects the succession of the embellie, if you will, that we had for a couple of weeks, and then again the flaring up of the conflict and the impact that it has had on commodity prices, and as a result the expectations that we have in relation to prices.
Francesco Canepa of Reuters. Francesco, please.
Good afternoon. So was the decision today unanimous, or did anyone, even at the discussion phase of the meeting, raise the prospect of increasing interest rates? Second question is about the indirect and second round effects that you mentioned in the press release. Can you tell us if you see any evidence of those materializing?
Well, thank you for your two questions. Yes, it was a unanimous decision. But I'm going to qualify that, because there were some governors who asked themselves whether we should not consider a hike. In other words, raising the 3 interest rates on the occasion of that meeting. And we had really a good, thorough look at the data, at the current development, and we all unanimously decided that we were positioned adequately to wait and be very attentive in the next few weeks to the development of the situation and to the data that we will be receiving in the next few weeks. Consider that before our next September meeting, we will be receiving 2 monthly indicators for inflation. We will be receiving the GDP for the second quarter. We will be receiving 2 consumer expectations indices. We will be receiving 1 CPE, compensation per employee number. We'll be receiving 2 PMI numbers. I'm going through the long list, sounds like a laundry list, but that's just to give you an indication of the volume of data that we will have and the scope of indications that we want to absorb in order to apply reaction function. So we will be receiving all that. We will be looking very carefully at all these data. We will be applying our normal reaction function, inflation outlook, the risk associated with it, the underlying inflation, transmission, and we will be again measuring, the intensity, the duration, and the propagation of the shock throughout the economy. And that takes care of your second question. We will be particularly attentive to any risk of second-round effects. I think it's clear to all of you, all of us, that there are direct effects. It goes without saying. That there are indirect effects when you look at the price of, say, transportation, for instance, pretty obvious. Second-round effects, we are not seeing it. So, believe me, we are really scrutinizing the emergence of second-round effects, but we are not seeing it. So, one of the most up-to-date, informative element that we have is the corporate telephone survey, where we ask large and smaller corporates, what are your plans in relation to wages? And we are not seeing a second-round effect. There might be compensations on a one-off basis, for instance, but a change from what is naturally incorporated in our baseline, no, we don't see that. And on top of it, what we had anticipated, which was this gradual decline of wages, we are seeing it. I mean, compensation per employee is one indicator, went from 3.8 to 3.5, but we also have the wage tracker. We have we have the negotiated wages, which is also informative about what is to come. And none of those elements, for the moment, are giving us second-round effects indication.
And now Jana Randor of Bloomberg. Jana, please.
Good afternoon.
Good afternoon.
So I heard you say some of your colleagues wondered whether we, or you rather, should already raise interest rates today. You said on another occasion that we decided to hold rates for the moment. Now, I'm just going to go and conclude that this sounds very much like you are preparing and signaling a September hike, and I very much invite you to say if that's not the case. But my real question is, what would need to happen for you not to do that? What would need to happen for you not to consider a September rate increase? And my second question is of a bit of a different nature. You keep feeding speculation that you will leave the ECB early. You've talked about clouds on the horizon. You've talked about captains and ships in crises. I'm really just looking for a yes or no answer today on whether you're willing to commit to serve until the end of your term. Thank you.
I hate to be boxed in any particular circumstances. So on this latter point, number one, it was not discussed at the Governing Council meeting, but I'm going to give you two elements. First of all, you are not going to see the back of me before 2027, okay? And second, what I said, that 2027, my dear, okay? And the second point that I would mention is the same that I did mention once. When there are clouds on the horizon, the captain stays on the ship. And this captain is staying on this ship, as long as there are clouds on the horizon. Now, you can speculate, write anything you want. I don't think it's particularly interesting and important. What matters is that we apply the right monetary policy in order to bring price stability. So that will be my answer in response to this point. More importantly, what we are doing is not giving any forward guidance. I think that, I've made that point clear and loud, and I've been doing that for a long time. On the other hand, we are giving framework guidance. So analysts, you all appreciate how we assess the situation, what elements we take into account. And it's a combination of the three-prong approach, which is underlying inflation. I'll cut it short because you know it inside out as I do. Underlying inflation, transmission. But we also, and I think I've made that very clear in I think it was the ECB Watcher speech, I gave clear indication of how we assess the situation in case of an energy shock of that nature, whether it's short-lived, whether it's longer term, whether it's high and long. And I think that all of that stands. Okay, so we do that. We also, and particularly in light of the most recent variation of and volatility of prices, we also take a view on the duration, the intensity, and the propagation of the shock. And it's really on the basis of all those parameters that we make decisions on a meeting-by-meeting basis. As I've said, we back to the baseline. That stands. We are going to continue to receive all these components and all this data in the weeks to come, and then we will make our decision in September. Thank you.
And the next question goes to Sorry, I have a blank. Olaf Storbeck from the Financial Times. Sorry, Olaf, over to you.
Thanks for taking my questions. My first question is regarding the current today's situation in the Red Sea. Did you discuss that in the Governing Council meeting and what it might mean for the overall assessment if now a second key supply line might be disrupted? And my second question is, actually I only have one question today.
This is a bit of a change. So, we have seen multiple developments. As I said earlier, in the last 6 weeks, we've seen improvement, positive expectations, significant reduction of prices, followed by negative breakthrough, significantly increased prices. And by the way, we look not just at crude oil, we look at all the variations of that, including the what is known as the crack spread, to see where money is actually going in case of price increases. The most recent developments, I'm assuming that you're referring to the Houthi threats against Saudi Arabia vessels and the materialization that took place this morning. My understanding of that is that it was reported at 10 a.m. Now, because it was a decision that harnessed a great sense of consensus around the table, we probably finished the meeting at about 10:15. So I'm not sure that that particular element that took place this morning, which is alarming, which is clearly going to have an impact and is having an impact. We can see that on the price of Brent as it evolves almost by the hour. But that was not in and of itself taken into consideration during the decision that we took this morning. That does not say that we are oblivious to energy shock that last, that possibly amplify, and that certainly have repercussions. And so we are very attentive to that. I can already tell you that we asked staff to conduct some really in-depth analysis for our September meeting on the various oil prices, as I just mentioned, but also gas, because when you look at energy prices, oil has certainly gone up and is going up as we speak, but gas has significantly increased as well. And given the level of inventory that is at rather low levels, this is also a matter that will be under sensitivity review. In addition to the scenario work that we do given the magnitude of changes that are taking place.
Next question goes to Stefan Reckius of Handelsblatt. Stefan, please.
Thank you and good afternoon. I'm trying to poke a bit more on, what's been discussed on potential hikes. Given that there was some sort of push for a back-to-back front-loading type of hiking today.
No, there was no push.
Push is the wrong word. Okay, fair enough.
Wrong word.
Who has the burden of proof going into September? Is it on those arguing for a hike, or is it on those arguing against a hike? And my second question is on the minimum reserve requirement. Did you have any discussion about raising it, and or will it be open for discussion in the next month? Thanks.
So my answers will be rather short. The burden of proof is on data. As simple as that. On the minimum reserve requirement, it was not discussed on the occasion of this Governing Council, which doesn't mean to say that it will not be discussed. It will.
Next question goes to Andres Stumpf of Expansion. Andres, please.
It will, as it has been, by the way. This is not something that is,
Thank you. I would like some clarification on the alternative scenarios. Given that you are willing to give some framework guidance, is there a point at which the mild scenario is no longer a possibility, even if the conflict ends? And could that point be reached in between today and the September meeting? And a second question, if I may. How are you planning to balance the agility of the central bank with avoiding sudden shifts in direction? Because 2 weeks ago, we had like a completely different situation, and that could have like needed a completely different monetary policy decisions, right? Thank you.
Your first question deals with the sustainability of the mild scenario, right? Or the likelihood of materialization. You know, it's not a question to which I can give a reliable answer. Why do I say that? Not because I cannot think, or the staff cannot help us think along those lines. But we have seen so abrupt changes occurring in a matter of days, not just in terms of the level of the conflict, but also the consequences in terms of energy prices. You know, remember how fast energy prices went down after the announcement of the Memorandum of Understanding. Now, once burned, twice shy, it could well be that another announcement of such Memorandum of Understanding will not have the similar impact, because there is rising uncertainty, and it applies across the board. But still, the situation can reverse so fast that it's difficult to, either affirm or challenge the possible materialization of this mild scenario. As we stand now today, it looks quite unlikely, let's face it. But taking a view on the likelihood of materialization is another story, because of the uncertainty that we have. And that's precisely the reason why it is helpful to have the scenarios and to test our recommendations and our stance against all scenarios, and to have a range of assessment. I'm not sure exactly what you meant about our agility, but what I can assure you of is that staff at the ECB is working flat out to absorb all the data almost as they come, and to make sure that while sticking to principles of cut-off dates, of the reaction function that we apply, they are still capable of absorbing all developments. And that's really a factor of the agility that we try to demonstrate. We've done that in the past, and we will continue to do so. Thank you.
Next question goes to Santi Pignol of Market News International. Santi, please.
Good afternoon. My question is, with all these developments that change quickly, I think it's particularly important that markets understand this framework guidance. Do you think that they fully understand the guidance framework and the reaction function? And I'm not asking if they are pricing right, but do they understand what you are saying in a moment where things can change so quickly? And is there a way to improve that understanding? Thank you.
Well, thank you very much, because this is a question that we asked ourselves as well. And our assessment on the basis of the transmission and the almost immediate transmission, the tightening that we have observed on markets, our understanding is that our reaction function is very well understood by markets. The fact that it has been well articulated, that it's concise, its expression, that it can be understood, I hope, by all, but certainly by markets, I think is a factor of stability in this very, very uncertain landscape in which we are trying to navigate. So I really think that it is well understood. And, analysts, markets, you have access to a similar range of data as we do and as they are published. So the integrity of the data is important. The immediate assessment of such data and taking on board of such data is important as well, but the reaction function is something that is very stable.
Next question goes to Elena Satova of the Bulgarian news agency BTA. Elena,
Thank you for having me. Speaking of inflation, one of the countries with high inflation in the recent months is Bulgaria. How do you access this data? And I have a second question that's somehow interconnected. How do you assess the outlooks for Eurozone enlargement, given the signal that are coming from Hungary? Thank you.
Thank you for your two questions. You are correct that Bulgaria is currently experiencing a high price level, high inflation. And that may have to do with the fact that some prices that had been kept on hold for a period of time have found their way into the markets. It's not totally unusual, and we always have divergences between member states. I think what matters is the commitment of Bulgaria to observe, sound public finance and to make sure that inflation returns to more acceptable levels, in particular for the Bulgarian population. So we monitor the overall euro area, but we are attentive to divergences, and this is clearly one of them at the moment. On the issue of enlargement, this is a topic that is not really for us to decide. It's a matter where we give views, particularly in relation to inflation. It's a matter that is essentially under the consideration of the European Council and the Commission. As you know, there is a process. Bulgaria went through that process successfully, and we are, always ready to welcome more members as long as they satisfy the requirements and comply with the criteria, and the convergence conclusions is positive. So we'll see. It always, as you know, it always takes a little bit of time. But ultimately, all members of the European Union, except for one, are expected to join the euro area.
And the last question today goes to Marta Villar of EconoStream. Marta, please.
Very much. Good afternoon. Thank you for taking my questions. Madame Lagarde, would concern about second round effects alone justify another move in September, or would you need to see evidence that they are in fact materializing? And my second question is about the market implied rate path. You often point to the rate path embedded in the staff projections. How important is the market implied path for policy decisions? Thank you.
So if it was just a matter of concern, we would have raised hike, because whenever there is a shock of that nature, we have to be concerned about direct, indirect, and second round effects. So we are concerned, which leads us to be being very attentive, looking and sort of checking any possible emerging sign that second round effects are not only in the making, but in the coming, and more so than what we have in the baseline. We are not at that stage where we are seeing those emergence sign of second round effects. Okay? Additionally, by the way, we have inflation expectations beyond the short-term ones that are broadly anchored at our medium-term target, which is also important. The rate path implied, that is market determined, is something that we factor into our work, because obviously we take certain market conditions at a cutoff date, and that includes, of course, the market rate implied trajectory. Thank you.
Thank you. That concludes our press conference.
Wait. I want to say something.
Okay.
Now, I want to say something because I don't know if we still are on the stream or not, but I just want to take this opportunity to congratulate the Central Bank of Bosnia and Herzegovina, as well as the Central Bank of Montenegro, on their successful launch earlier this week of a platform for the settlement of instant payments, which uses the technology of TIPS, the Eurosystem's fast payment system. We don't often talk about that because it's a monetary policy-focused press conference, but this is important. So I'm looking forward to a similar launch in Albania, Kosovo, and North Macedonia, which are expected to join in November, bringing all countries participating in the initiative onto the platform. And I would like on this occasion to thank Banca d'Italia for the key role that it has played on this initiative on behalf of the whole Eurosystem by developing a clone of tips for the countries of the Western Balkans, which, except for Serbia, are now all going to be included in November within our tips platform. You should expect some further development in relation to linking fast payment systems, but that's for a later date. And I know that some of you are going to stay a little longer, maybe writing the articles and news, because we will soon be disclosing in that very room the set of proposed new banknotes, the new euros that will have a different face, a different back, and that will be in the pockets of European citizens when the project is completed, after hopefully they have participated in the survey. With that, I hope to see you in about half an hour.
That will be at 4:15, and the next press conference will be at our External Governing Council in Berlin on the 10th of September. Thank you very much, and see you shortly.
You have been watching the ECB press conference from ECB President Christine Lagarde speaking in Frankfurt following their decision not to change rates. You're watching Bloomberg Open Interest. I'm Danny Berger along Isabel Lee. So yes, it was an ECB that decided not to change rates, saying that a full impact of inflation, of an energy shock, has yet to play out. They're not seeing any second order effects, but Madame Lagarde there pointing out that she was concerned that we might see some. There was no push for an ECB rate hike, according to Lagarde, but some governors asked themselves if a hike was needed. Worth just quickly saying the background of what's happening in markets, because markets are open. Alphabet getting hit hard in today's session. Isabel Lee, not helped by maybe hawkish expectations for central banks given oil at triple digits.
Not help at all. You see shares falling more than 6%, erasing $265 billion, Danny. We have a lot of tech earnings to digest. I'm pretty excited. We have Tesla, Alphabet, and a whole slew. Even American Airlines. I mean, you and I travel a lot, so
yes,
definitely in our interest.
You are excited, but the market is maybe disappointed. But first, it needs to wrap its head around the macro backdrop. Let's bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, we just heard from Madame Lagarde this idea that we haven't fully seen the second order effect. She's nervous that we will from higher energy prices. We're feeling it today. Triple digit oil, $100 a barrel for the first time since May. At the same time, yields rising after in the U.S. we saw the lowest jobless claim since 1969. Is this a market that should be bracing from rate hikes, both from the ECB and possibly from the Fed next week?
Hi, Danny. Well, look, I mean, just looking at the data, looking at the way that the market is moving, oil prices are moving today, certainly suggests that the ECB is online to have another hike in September, potentially one after that as well. So she's being quite careful and cautious with her comments. But certainly, as she noted, you know, the mild scenario seems very unlikely given the latest developments. So I think we have to put a lot of weight on that. When it comes to the Fed, I think it's a little bit more ambiguous. Certainly, we are expecting at this stage that the rates are going to stay on hold through this year. But the odds of a rate hike are increasing with each additional day that these tensions persist and oil prices stay higher. Because, of course, just like Lagarde said, it's the same thing for the US. Second round effects are the real concern. So that's the key thing that we'll be watching out for. But next week, we don't expect any move.
Seema, what does it mean then for risk assets when you do have two-year yields at the highest since 2025? Sure, we don't expect, or you don't expect a move for next week, but might we be getting to a level even with longer term yields that have been sticking above 5% for the 30-year yield for the longest stretch since 2007? Does that do something to risk assets this morning?
Yeah, look, these are really good points. So far, markets have dealt with this pretty well. And I think one of the things that we've been seeing is, you know, even over the last couple of months, when oil prices were higher before they went back down again, we did see that the economy dealt with it fairly well. The real concern was around how the Fed was going to respond. And I think that's what you're seeing with yields at the moment. Is, of course, they're worried that the Fed is going to be responding within the next month or two with rate hikes. If they did do that, and you were to see this continuation push higher in bond yields, then of course it's going to be a really difficult situation for the equity market. So far, it's really resting on earnings growth. That's what's been propelling it. But once you do get rate hikes, particularly if the market expects it to be the first in a sequence of hikes, that's where the arithmetic gets more challenging. So I'm not surprised by the market being down today. Question is how the Fed responds, and if you do get that rate hike that the market is currently pricing in.
All right, Seema, hang tight for just a moment because let's get a check on where that market is today, because we are 6 minutes into a trading day. We opened up markets in the midst of an ECB conference where the ECB didn't change rates, but still Christine Lagarde expressed concern that we would see second-order effects from higher energy prices, and that's what you're seeing today. We're back under $100 a barrel, but not far there under. That's weighing on yields with your 10-year yield at 4.7. It's not just that. It was also the macro data with jobless claims coming in the lowest since 1969. Not helping things either, Isabel, is what's happening in tech after Alphabet earnings down 1.4%. So what are some of the single name individual stocks doing now?
I think first of all, we have Google. I wanted to say that the tension between what shareholders want and what AI demands is really going to be key. So, I mean, Google raised their capex forecast to as much as $205 billion this year. That's fueling concerns over the sustainability of the really massive spending on AI. You see the stock there down by nearly 6%, Danny.
And you also mentioned we had Tesla reporting after the bell. Disappointing profit despite a strong quarter for its automotive business. That has pressured CEO Elon Musk's plans to refocus the company on AI and its Optimus robot.
And we also have IBM cutting its full-year sales outlook after seeing a dip in demand for its mainstream business. But some analysts are saying that the report was better than feared. You see the stock there also down 2%. It seems to be a red day, Danny. Let's now bring in Bloomberg Tech's Ed Ludlow joining us live from San Francisco. Ed, you must have been up all night digesting all of this, but maybe we should start with Alphabet. We have Google Cloud booming, but free cash flow turned negative. How do you square those two?
Yeah, I mean, the story certainly changed overnight, right? In the initial print, everyone's like, okay, here's evidence that there's a payoff there. Raising capex to $205 billion at the high end for this year tips Alphabet into negative free cash flow in that quarter, and now the outlook's slightly different. And so even though they posted 82% cloud revenue growth, the story has gone from AI spending is starting to pay off to the price is high for that payoff. And certainly the stock being down 6% on track for its biggest drop, I think, since May of 2025. You know, it's a severe reaction, tells you quite a lot.
I wonder if, obviously different businesses, but if there's something similar with Tesla this morning, Ed, where yes, you can show strength in your automotive business, but when you're spending so much in businesses that are yet to be contributing any profit, is this just a market that's lost its patience?
Perfect summary. You know, record vehicle deliveries in the quarter gone, but higher rates, higher R&D costs, higher stock-based compensation were all in the negative column. Capital expenditures will be $25 billion this year. Actually, if you track 1Q and 2Q, they're not even tracking to hit $25 billion. But, you know, the analysts are really focused on this idea that they're going to have to not just spend money, but spend it quickly. And Musk engaged with that. He basically said, you know what, we don't want to go for sort of super capital efficiency at the expense of being slow. They're willing to move fast. It's that the robo-taxi business had very limited updates. The Optimus humanoid program has updates. The manufacturing lines are going in. There's just nothing tangible to say these businesses are real in the near term, just that they're going to have to spend heavily to get there.
Ed, we appreciate it. And as always, looking forward to Bloomberg Tech at 11 a.m. Ed Ludlow, host of Bloomberg Tech. Let's bring back in Seema Shah of Principal Asset Management. Seema, can we just get your first reaction to the Alphabet earnings yesterday, both the earnings themselves and how this market is reacting this morning with a sell-off in Alphabet?
Yeah, I mean, I think the big news from Alphabet was really about the negative cash flow. And that's what the market is overall is really responding to. It is that drifted narrative from, look, we're expecting all these wonderful productivity gains to come once all that capex is spent and allocated. Now the question is really about the monetization. What is the return on investment? And that's where I think the real concerns are growing, not just for the hyperscalers, but for the broader tech complex. And I have to say, we are still positive on tech. But as you're seeing this AI cycle mature, there's still so many questions about which of the companies that are going to be seeing the benefits. What are their economics? What is the free cash flow? How does that persist? So this is a point where you really have to be able to discern who are the winners and the losers. I think that's what the market is now reacting to.
So you did say that you're still in for tech, and tech still leads, but where do you see opportunities, maybe outside of AI?
Yeah, and this is a really good point because there's so many companies out there who, because they haven't been attached to the AI trade, They have almost been punished for not being attached to it, but they're still really, really strong companies. And we do see them across the broad sectors, financial, certainly, banks are looking really good, industrials, healthcare, certainly. There's always going to be really good opportunities, and particularly in this kind of environment where some of them have been punished, there are attractive valuation opportunities. And at the same time, there's also companies in all these sectors who are going to be AI beneficiaries because they're investing and they're going to see the productivity gains. So there's a lot of opportunities out there. The one thing that we do need, though, is for the macro backdrop to stay constructive so that these companies outside of that AI complex can continue to perform well and deliver those earnings.
But Seema, I wonder if even for companies in the AI complex, if that is a problem, because earnings expectations are incredibly high. I mean, this is probably true for basically every company in the S&P 500. So when you get a company that does well, it's not surprising because we expected them to do well. Alphabet's a great example. They do well, but they sell off. Texas Instruments, similar thing last night. Good results, but they sell off. In order for these companies to do really well and actually see more gains, does there need to be an improvement in the macro backdrop? Is that sort of the last thing we can really squeeze out, considering so much of these earnings are already in the price?
Well, so you certainly need the macro backdrop to persist, that constructive backdrop to persist in order for the market to continue almost performing well. I think the vulnerability is higher, though. So, if you don't have the macro backdrop staying strong, then the vulnerability is so high that these companies are going to be punished. And certainly, as you said, the earnings growth forecasts are very, very high. They probably can be met, but the chance of it persisting, so those kind of earnings growth forecasts persisting, is now starting to turn. And that's where the market is also looking for. So what from an AI side you really need, as well as the strong macro, is that monetization. That's where the focus is going to go, and I can't see that changing anytime soon.
How much, Seema, do you think, how much of this bull market is driven by fundamentals versus just all of this AI positivity? Because last week we got that China startup moonshot, really frazzling markets, but everyone seemed to have forgotten about that this week. And I'm really keen to hear in the earnings calls what the executives think about that.
I mean, I think the broad market is still being driven by that very strong earnings. We haven't really seen that much multiple expansion. That hasn't been the story. It's still about earnings. That's certainly the case for the broader market. When you're looking specifically at tech, as we said, it's really, again, it's about the monetization, what is happening to the cash flow. The narrative is changing. So it is still really a requirement for fundamentals. And again, that's why actually the Iran tensions become more and more of an important part of the story, because we still need that backdrop to be strong, supply chain pressures to subside so you don't get the price pressures that could impact margins. We need all of that to go away in order for those fundamental drivers to continue to support the market.
Seema, I was struck, and we're going to hear a little bit of the sound later. I was speaking to John Gray of Blackstone, who came out with earnings that beat expectations, and it's largely around an AI bet. And I asked him, because he's made this argument before, Blackstone is a really cheap way, considering its multiples are that of a financial company, to play AI. And he talked about this idea that eventually the market's going to catch up and maybe rate them at higher multiples. I wonder, when you look at these financial companies, you can maybe even extend this to banks whose deals powerhouse has been powered by AI. If these second order effects are really attractive to you, and maybe financials should start to get more love than they usually do at this point in the cycle, just because their fortunes too have become tied to AI.
Yeah, it's interesting. Financials are a really interesting part of the narrative because they continue to do well. I mean, their fundamentals have been very strong. They were kind of unfairly beaten up at the beginning of the year because of concerns around rate hikes, concerns about the macro environment. And actually, they performed really well. They've also been considered as a bit of a diversification to the AI trade because it is on at least some segments driven by other parts. But exactly to your point, they are the beneficiaries of all that IPO activity around the tech space. So I think you can look at it in two ways. Certainly to us, financials, specifically banks, look to be one of the strongest parts of the market going ahead, and certainly an interest for our investors.
Seema, fantastic insights. Seema Shah of Principal Asset Management, thank you so much for joining us on this Thursday. Time now for our top call. Some of the analyst action in focus this morning. First up, JP Morgan slashing its price target on Tesla to $445, pointing to the company's softer than expected gross margins. Next up, we have Goldman Sachs cutting its price target on IBM to $270. You see the stock there falling 2.5%. They're citing weak software growth, a shifting hardware mix, and execution concerns. And finally, we have Wedbush adding Alphabet to its best ideas list. That's an interesting timing. You see the stock there down by more than 6%. It's an outperform rating. They're saying results reinforce its thesis that Alphabet's full stack AI position is translating into cloud share gains.
Well, if you loved Alphabet yesterday, you would love it even more today if it's down 6%. Let's stick with the company raising its CapEx plans after another strong quarter. Jefferies tech sector leader Brent Hill says that Google's cloud business is, quote, bursting at the seams. He joins us now. Brent, it is. I mean, 82% year-over-year growth in cloud, the margins at 34.6%. And yet it is an Alphabet that is on track to have its worst day since May of last year. Is there a disconnect here?
Yeah, I mean, CapEx and software and internet are not friends. I mean, if you think about them raising CapEx by $20 billion, that is an impact to cash flow. And obviously that's going into memory, infrastructure, AI, land, networking gear. So again, this concept that, you know, AI spenders, you want to be out of, and you want to be in the AI spending receiving category. The receivers are obviously out of this AI infrastructure. So again, I think this is why you have semis up 62% year to date. You have software down 16%. You have a mixed bag for many of the hyperscalers, Amazon, Google, across the board, right? They're all the ones that are spending. And remember, there are 5 companies that can build this AI infrastructure, because it's hundreds of billions of dollars investments. It's not a single digit or tens, it's hundreds of billions. And Google, Amazon, Microsoft are all going to spend over $200 billion each. So do you want to own the spenders or the receivers of the capital? And the analogy of this gold rush is, did you sell picks and shovels or open a gold store? You made a lot of money selling picks and shovels. Then you made the money opening the gold store. And so today, it just goes back to the ongoing narrative of in my coverage, we cover all the hyperscalers that are spending the money. And that's having a direct reflection. You see the stock down 6% on this concern of the spend. We are so early in this build out that they can't turn back. This concept, is there an ROI? I think there is an ROI. It's just going to take time. And so for patient investors, we think they're going to be in an incredible position. But, you know, short term, this is going to be hard. Everyone's going to ask for the ROI. There are going to be a lot of questions we can't ask in the short term. But long term, we think that this is the right move. And again, you're going to look back in 3 years and say, wow, Microsoft, Amazon, and Google, maybe Meta, maybe CoreWeave, pulled this off. And there are not going to be that many others that were able to do this. And the Chinese worry about open source models coming to eat OpenAI and Anthropic. We think all these models will be good for AI. It brings more workloads to these clouds. It means more CapEx. And so I think this kind of these fears that come into the market every week and then they change direction. I mean, ultimately, a lot of these concerns are still going to be here a quarter, 2 quarters, 3 quarters, a year from now. And the ROI for AI is really not going to be felt until, you know, 2028, 29 in the enterprise. This is just slow glacial buildup. It's not gonna happen overnight.
Brent, you raised interesting points there. The CapEx numbers are indeed eye-popping, and Google raised its spending outlook again, and you said investors should be more patient. But how patient should they be? What is your time frame if you must put on that? When should markets ask whether these will actually generate returns?
I mean, these are year-long, you know, 5-year investment cycles, 10-year investment cycles. So again, I mean, look at Google stock from a year ago. Everyone thought they had no AI, and the stock had a huge move. All of a sudden, we go into a quarter, and they're going to do everything perfectly, and that's not the case. So I think the expectation going in is, like, you know, the multiple had gone from 11 times EBITDA to 16. It was towards the higher end of its range. Everyone knows how well they're doing. The element of surprise just wasn't there on the core fundamentals. Things were good, but it's being overshadowed by all this expense. So, you know, we go through these moments where, you know, investors are just wondering when the ROI is going to come in. And we've said the ROI is not here till 28, 29, 30. It takes a long time. So if you're a semi and hardware and networking investor, you're seeing these dollars immediately. I mean, Alphabet just raised their capex by $20 billion. Where's that going? It's going into memory.
Well, Brent, if I can just jump in, because what does that mean as to what you recommend then? Do you wait until you start to see some of those ROIs, or is the time to buy now when they settle off because we haven't yet seen it? Or do you just sit with the ones who are receiving the checks, that you stay with the picks and shovels until there is more clarity? You stay with the picks and shovels. And so you stay away from the hyperscalers.
Trade is you stay overweight the receivers of the capital. This is not rocket science. Who is receiving the money? It's all infrastructure. The hyperscalers are the ones that are spending. We have buys on Amazon and Google because the multiples are reasonable, and secondarily, they are going to be in 3 to 5 years the big winners. So again, it depends on your duration, but like, yeah, I mean, look at from a year ago, Google, you made a lot of money in Google, and everyone's like, well, it's down 6%. Now, how do you make money? You were like, you just made a lot of money. What are you talking about? Like, let's zoom out on the bigger picture here. The bigger picture is they massively win. They are going to absolutely crush their competition, in my personal opinion. So they have the most integrated AI factory. They have this AI ranch that no one else has.
Brent, thank you so much for joining us. Unfortunately, we're just out of time. Going to have to leave it there. Brent Hill of Jefferies. And don't miss Bloomberg Tech. We'll be speaking with another tech leader, IBM CEO. That's at about 11:30 a.m. New York time. Coming up on the show, Blackstone's profits jump thanks to a winning AI bet. Part of my conversation with John Gray, the company's president and COO, on the other side of this break. You're watching Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Blackstone joining a growing and increasingly long list of companies placing big bets on AI. It reported a 26% jump in earnings in the second quarter. I asked the company's president and COO, John Gray, how much of that jump was powered by AI.
Well, it definitely was a heck of a quarter, Danny, and 26% up in earnings on top of 25% last quarter. And it was definitely powered by that strategic decision we made to lean into AI and the AI ecosystem. It really started for us back in 2021 when we bought QTS, this big data center business, and it gave us a front row seat in terms of what's happening around AI. And we made a strategic decision, hey, we should lean in here, not just with data centers, but with neo clouds, large language models, electrical equipment, energy. And that decision is paying off, and it's delivering for our clients, which is the most important thing. And what's also very exciting is we're not done here. Just in the second quarter, we announced partnerships with Google and TPUs, with Broadcom and financing chips, with Anthropic and deploying their technology. We continue to see a lot of opportunity in this space to generate favorable returns. We announced a couple of big sales in the last few weeks, one of data centers for $8 billion. We announced yesterday a battery storage company we sold for $7 billion. So AI and that ecosystem and our strategic pivot has really made a difference for the firm and our investors.
And we'll have more from that interview with John Gray coming up in the next hour as shares turn positive post their earnings, currently up 1.2%. Also coming up in the next hour, Ann Berry of Threadneedle Ventures joins us as markets digest those big tech earnings. All that to come. Stay with us. You're watching Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
ABC News, I'm Sherry Preston.
Oil is trading internationally at just below $100 a barrel once again amid continued and new threats from the White House to Iran and its proxies in the Middle East. ABC's Martha Raddatz with more from Amman, Jordan.
Iranian-backed militants in Yemen taking aim at 2 Saudi oil tankers in the Red Sea in an attempt to block international shipping, choking another key waterway that could have ripple effects for the world economy.
Following the attack on those ships, the president said on social media there will be, quote, major military punishment if the rebels continue their targets. Overnight, U.S. forces hit Iran once again, and Iran firing back at U.S. bases in the region, the 12th straight night of fighting. Republicans in the House getting a budget measure through despite some Republican holdouts, says ABC's Karen Hua in Washington.
On Capitol Hill, the House narrowly adopted a $95 billion budget blueprint, $73 billion of it for the war. As the Pentagon warns it's running out of money. The measure now heads to the Senate, where a vote could wait till fall.
Also in Washington, ABC national correspondent Stephen Portnoy has more on a provision in a separate bill that bans stock trading by members of Congress.
The bill that's passed the House would essentially impose fines payable to the respective House of Congress for members who buy corporate stocks. The bill would cover their spouses and dependent children, too. This is a popular idea in Congress, but only 13 House Democrats voted for the measure because GOP leaders also included voter ID provisions in the bill. It now moves to the Senate, where Democrats could block it unless those voter ID provisions are taken out.
Applications for unemployment benefits tumbled last week to the lowest level in more than 5 decades. As oil prices rise on continued fighting in the Middle East, Wall Street has been sinking. The Dow right now is down over 500 points, and the S&P is down 75. You're listening to ABC News. Ebola spreading too fast to contain in the Congo. Healthcare workers like Trish Newport, emergency program manager for Doctors Without Borders, say with 1,000 deaths and 2,400 cases so far, they just cannot keep up.
There we see the number of cases increasing every single day. We see more and more community deaths. We see new cases in new areas. And what the response is today just can't catch up to the size of the spread of the outbreak today.
When it comes to the cyclosporiasis outbreak, much of the blame has been placed on lettuce used at Taco Bell restaurants. Well, now Taco Bell is trying to make lemonade out of those lemons.
If you're Taco Bell, you turn cyclosporiasis into a promotional opportunity. The fast food chain has dropped the price of its enchilada and its nacho fries from $4.29 and $2.89 respectively to $1 apiece today only, and when purchased through the Taco Bell app. The company hasn't said whether the promotion is a direct result of the outbreak, but neither nacho fries nor the enchilada contains lettuce, which has been linked to thousands of cases of cyclosporiasis in 41 states. Jim Ryan, ABC News.
Google's on the hook for $1 billion after the EU fined it that much for breaking antitrust laws on its Google Play Store and its search engine. Today, the Hollywood Walk of Fame class of 2027 will be announced. That will happen later this afternoon as a new group of 32 performers will be unveiled. Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals, and the Bloomberg Business app.
Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're streaming live on YouTube and at Bloomberg.com. Lots of selling on the street. We'll get to that in just a moment. We're going to check in with Mandeep Singh today, Global Head of Tech Research. Get a recap of what happened at Google last night with their earnings, stock trading down pretty significantly as they ramp up their AI spending yet again. Kevin Tynan, Director of Research at the Presidio Group, is going to recap Tesla's numbers. I'm looking at the stock. Tesla's down 12.3%. Right now. Geetha Ranganathan, she's a BI analyst on U.S. media. I'll get her thoughts on Comcast. They reported some numbers. They're going to split the company up. What's the latest there? Maybe even talk about the Paramount deal. Is Paramount going to get its deal for Warner Brothers Discovery done? David Garsfield, Alex Partners, co-CEO, and discuss how companies are rethinking supply chain and absorbing tariff costs. So a lot coming up here with markets on the move. Let's get right to it. John Tucker and the Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash being brought to you by IBKR. Trade, election, climate, and economic outcomes with IBKR prediction markets. Right alongside your stocks and options. Earn interest on your position. Receive $1 per contract if you're right. Learn more at ibkr.com/predictions. Major averages all down just about 1%. Tesla, worst performing stock in the S&P 500. Alphabet isn't too far behind. So Alphabet and Tesla reported soaring revenue, but free cash flow negative for both. That's because they're spending like drunken sailors on shore leave. Alphabet.
That's very technical.
Yeah. Alphabet spending on investments, AI, Tesla, of course, autonomous vehicles, and the robo-taxis. Tesla down 12.5%. Google share, Alphabet shares down 6.7%. Not all bad. United Rentals, best performing stock in the S&P 500. That is up right now 12.3%. URI at a record high after the equipment rental company boosted the full year forecast. Meantime, Russ Kostridge at BlackRock doesn't sound too worried about any near-term market sell-off.
The earnings have been spectacular. There are legitimate questions about cash flow, but this is not a question about the fundamentals. This is more of a question about positioning, and I would say in the background, some growing concerns about oil and rates.
And as we look at Brent crude above $100 a barrel, up close to 7% right now. Yields ahead of the Fed meeting next week, 6 basis points higher for the twos. That's 436. The 10-year yield of 5 basis points. That is at 470 right now. As robo-taxis, well, if they catch on, companies that efficiently own, charge, and clean and maintain self-driving vehicles could become the industry winners. And that's where Hertz comes in. They're trying to position themselves now as the backbone of the robo-taxi business.
I'm a Hertz Gold member, I'll have you know.
Wow,
that's
impressive.
Oh, you are?
Went through my Amex Platinum card.
Oh, there you go.
I went to Enterprise Rental for my vacation last week.
And how'd that work out for you?
You know, the reason I love them, they pick you up. So, and then,
nice.
drop you off. The guys there saying, if anybody's looking for a job, we start at $60,000 a year. After 3 years or so, if you become a manager, they hike you up to something like $200K.
Nice.
At Enterprise?
Enterprise Rental
Are they publicly traded? Privately owned?
I don't think so.
You have this terminal right in front of you.
I know. I'm looking it up right now.
Ask me all these hard questions, Scarlett. Anyway, while you're looking that up,
Private.
we check the markets for you all day long right here on Bloomberg
Thank
Radio.
you, Bloomberg Terminal.
I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As John was reporting, big sell-off in the equity markets. But let's take where some of the stocks are on the move today. We can do that with Bloomberg's Judy LaGrue. Judy, what are you looking at today?
Good morning, Paul. What a complicated day we've got on in the stock market. But one company we're looking very closely at is Thermo Fisher, ticker TMO. Thermo Fisher reported earnings today. The stock is rising as much as 12%, but currently it's maybe up about 10%. It is on track for its largest intraday jump since October 2008. Wow. So nearly 18 years. And this is coming, again, after the company reported second quarter earnings that beat Wall Street estimates. And what the relevance here is, in particular for analysts across Wall Street, is that there is a signal here that lab instruments is really spurring sort of the life science tool rebound and resurgence. So Danaher, ticker DHR, is also moving on this news. It's up 5%. So overall, pretty good day for MedTech.
I tell you, when I was at Salomon Brothers, we hired this MedTech guy. Comes in first day, initiates coverage, table pounder on Thermo Fisher. After his meeting, he comes and sticks his head in my office. He said, "Sweeney, buy this thing." So I did. It worked. So ever since, I've been a big fan of Thermo Fisher. I made some money. It was one of my good stock trades back in the day. All right, what else you got for us?
I've got Albertsons, ticker ACI, the grocer. The stock is plunging in today's trading as much as 20%, although right now it's trading at about under 19%. And it is on track to reach a record low price since the company went public 6 years ago. And this is coming after the grocer cut its annual profit forecast, and it's looking to speed up its investments in response to a sort of weakened consumer demand, as we've talked about here just generally, but specifically looking to compete with Kroger and Walmart as they lower their prices, has really sort of challenged Albertsons absolutely in their earnings. Shares are down 15% this year, so definitely Albertsons we're looking at.
All right, good stuff. And last one on your list today.
Sure.
Also earnings, right?
Yes. So T-Mobile, ticker TMUS. The shares are falling as much as 9%, although they're down right now about a little over, under 6%. And it's on track for its largest intraday drop since April 2025. And again, another company that reported their earnings, but specifically here, the focus that we're looking at is subscriber growth. It is really slowing for T-Mobile. It's down 13% year over year, and it is the weakest growth in nearly 2 years. So this is a really interesting read on telecom and consumer weakness as well.
All right. Judy LeGroux, thank you so much. Judy LeGroux is one of our Bloomberg News reporters. And for more conversations like what you just heard, subscribe to our Stock Movers reports. These are 5-minute audio reports on the biggest winners and losers in the stock market. You can subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. The NASDAQ is now down 1.9%, Paul. The S&P 500 lower by 1%. I think this is a sell-off.
This is a sell-off here. And, you know, it's Tom and I all morning have been following crude oil. That's really been moving here, and you got some numbers that you don't like to see, some levels here, like Brent up $6.50, sitting above $100 a barrel. That's not what you want to see. You've got WTI crude oil up in about 5.5%. So now we're above 90 at $91.50 here. So some big moves there.
And big moves in yields, too.
Yep, absolutely. So yields are pushing higher here, kind of across the board. 2 years up 6 basis points, 435 on 2 years of paper. And I'm pretty sure my government's going to pay me back in 2 years. So that seems like a pretty good deal. The 10-year up 5 basis points, 470. Again, remember the days we thought 4.5 was kind of a ceiling for yields, and on the 10-year blew past that. And then, of course, on the 30-year, up another 4 basis points, 5.18%. So movements across the board.
You also have the 30-year yield, the long bond. It's now above 5% for the longest period since 2007. And we know what happened in 2007. It was the lead up to the financial crisis. And I don't want to alarm anyone, but these are the kinds of superlatives that get your attention.
Yep. And the dollar on the move as well here today. Strong dollar, DXY index, now 101.46. So, and we're seeing some real strength of the dollar across the euro. I'm going to get to my parity by the time I go over to France in October. I think I'm going to get euro.
Wait, is that the cruise?
That's the cruise.
Oh.
Yeah, a few days in Paris, knocking around, and then we're going to do a little cruise, spend some time at Normandy, all that kind of good stuff. So hopefully it'll cool off by then. All right, let's talk technology. Google reported numbers after the close. The kids call it Alphabet. But those of us who were there at the beginning, we're sticking with Google. And the CapEx numbers, first of all, the operating numbers look good to me, but I don't know. But the CapEx raise may be spooking some people. Mandeep Singh, he's part of that whole technology cabal there. He runs it for Bloomberg Intelligence. Mandeep, give us your overview of kind of what you heard, what you saw from Google last night.
Yeah, I mean, the entire call was about Google Cloud and TPUs. Not even one question on the core ad search business, which is surprising, given how the calls used to be. But look, they talked about how supply constraints remain when it comes to AI data center capacity. they're actually renting data center compute from third-party providers, despite all this
Who
capex.
has more compute than a Google, for example?
Yeah, but they want more.
Wow.
Because right now, anybody who was early to invest in power and computing and data center capacity is looking like a genius.
Who are those people?
All of these hyperscalers.
So Google's renting space from
SpaceX, potentially Meta. Again, they didn't specify.
But Meta has data centers to spare? Like, that's what I don't understand.
Yes, they don't have a model which is comparable to an Anthropic or Gemini. And so right now they are following the SpaceX playbook, which is if you rent your 1 gigawatt compute, you can generate up to $20 billion in rental revenue just by renting the compute, nothing else.
By being a landlord.
By being a landlord for your compute, yeah.
At what point is investing in all this too much? I mean, right now investors have been following this guideline of as long as I see a return on this, as long as it's paying off. But at some point, is it just too much and investors will balk?
I think so. We will hit that point. But Google also said they will be significantly raising their compute for 2027. So they raised the full year guide for 26 by about $15 billion at the midpoint. And then they said 2027 would be a significant increase. Now, my interpretation of significant is it's at least 50% because this year was 100%.
Wow.
Their CapEx doubled in 2026.
50% increase equals significant increase.
At least
according
in my
to
book,
Mandeep.
yes. So it's not changing anytime soon to your question. Yeah.
All right, so I'm looking at the FA function on the Bloomberg terminal, folks, which gives you a financial analysis. That's what it stands for. CapEx for this company, Google, in 2022, CapEx was $30 billion. In 2026, expected to be almost, I'll call it $190 billion, going to $280 next year. There ain't no free cash flow left for this company, which was a free cash flow juggernaut.
Yeah, they were negative free cash flow even for this quarter. It was
First time
negative.
ever, right?
First time ever. So, and they just did an equity raise, $85 billion. So, and the justification is we will invest significantly in training our own model, Gemini 4. And, the cloud business really is super strong. So 82% growth when you have a $100 billion business. It's like, show me any other company that's growing 80% at a $100 billion run rate.
So is the negative free cash flow the first time ever this past quarter and expected negative free cash flow? Is that going to be a problem, Paul, do you think, going forward?
I think so. You got to change your investment outlook, that's for sure. That's not what I signed up when I did the IPO for Google. Mandeep Singh, that's what he signed up for. He's global tech research head for Bloomberg Intelligence. He's got to deal with it. Negative free cash flow with Google. I never, ever thought I'd see the day, but there you go. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Yeah, it's a sell-off. The reason, take your pick, oil above $100 a barrel. That's Brent. Hello, inflation ahead of the Fed meeting next week. And then you had this story that President Trump threatening more attacks on Iran after the Houthis joined the war. So this is effectively a two-front war right now. Again, Brent up 6.5%, $100.25. And two-year yields, which are more policy reactive, up close to 6 basis points right now, 4.35%. The 10-year yield up 5 basis points. That is at 4.7%. Dow Jones Industrial Average 511 points lower. That's down 1%. S&P 500 down 73 points. That's down 1%. The Nasdaq Composite Index 473 points lower. That is down right now 1.8%. I mentioned the Fed meeting next week. This headline, this red headline from the Bloomberg about the European Central Bank, ECB officials ready to raise interest rates in September. And of course, back to Alphabet or Google, down 7% right now. They raised the capital spending forecast to as much as $205 billion this year. And of course, the results from Tesla being received not very well, down 12%, profit tumbling despite strong electric vehicle deliveries there. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube and Bloomberg.com. Tesla reported some numbers last night. The profit tumbled despite strong electric vehicle deliveries in the most recent quarter. And that's putting pressure on Elon Musk's plan to refocus the company on artificial intelligence and robots. Kevin China joins us here, Director of Research for the Presidio Group. He's been following the auto industry for decades here. Kevin, I'm not sure Tesla's even an auto company anymore. How are you viewing what you heard last night from Elon and company?
Yeah, look, there was a lot of automotive type results in that release, right? And you talked about it. Volume that you buy is not necessarily demand, right? Like that's spend. And you saw mix deteriorate, right? And so margins compress. So selling more things at lower margin is not necessarily the way, although it is common in the auto industry for manufacturers, over the decades, and that's how that happens. Best thing, though, about that is that you did not see them compress margins and not get the volume. At least they got the volume, but it winds up doing more harm than good to your pricing and your profit dynamics when that happens, though.
Kevin, Tesla has been promising for years a cheap or affordable EV, a lower cost EV. Does that even matter to the company? Is it a priority at this point? I mean, it feels like the company has so de-emphasized its traditional auto business that people don't care about it. And I wonder if the company cares about it.
Well, two things, Scarlett. Like one, I would say is that, look, if you're having problems with margins and mix, the answer is not a more affordable vehicle, right? Because
that's fair.
Material costs, input costs, production costs are all inflating. The answer is not to get to $25,000. That actually compounds the problem. But yeah, as a passenger car company, I obviously the narrative is not that, and it's probably not the way forward for this company going forward. So the idea of maybe more models, they're going in the other direction, right? Model S, Model X production has ceased now. You're talking about 3 nameplates, Y3 and Cybertruck, for what that's worth. So, not acting like an automaker that's putting product in all segments and able to grow volume that way, healthy through more demand. It's really about mix, price reductions, discounting, and exporting cheaper products to other parts of the world.
Kevin, I read a really interesting article over the weekend. I think it was in the New York Times about kind of the U.S. automakers, how they've pivoted back to what actually makes money for them, which are trucks and SUVs, and de-emphasizing their EV businesses And while that's good for near-term, intermediate-term profitability, they run the risk of falling behind the rest of the world in terms of EV technology. How do you think the U.S. auto companies are thinking about that EV strategy longer term?
Yeah, look, and the products are there, the technology is there, but to your point, the profitability isn't. Look, and as a global manufacturer of really anything, you want to share as many platforms, parts as you can, but the demand profile in each country, if not region, is not the same. You know, where money is made here are on big trucks and SUVs, pickups and SUVs. The small products that work in maybe Europe or even in China, India, they don't make sense here and they don't make money. So the idea that falling behind on EV necessarily matters if profit is the driver here, you know, I'm not sure why we need to go toe-to-toe on EV any more than we already are or tried if the profitability isn't there. I get maybe it's technology shaming, you know, by the rest of the world that says you're not keeping up, but it's not what our demand profile in this country looks like. We're not going to out-export China. We're not a low-cost manufacturer. So the idea that we're going to overtake China in EV, in export or domestically, it's just not going to happen. To me, that fight is already over. So I think manufacturers probably for the time being need to be doing what makes money and enables them to innovate from there.
At what point does the American public start to need or want EVs in a meaningful way, Kevin? I mean, we already see it with people in California facing $6 a gallon gas, and now you have the Iran war flaring up again, and oil prices are back up again. At some point, the consumer behavior is going to tip over, isn't it?
Well, the consumer can only buy what the manufacturer is building, right, and selling to the dealerships. And those products tend to be what makes the manufacturer money. This is really a push market on the supply side from the manufacturer. And what you're talking about is the pull side. So ultimately, and the difference between, say, the US and China in terms of EV adoption is subsidizing your manufacturers, which we don't and probably won't do here. So if you have a manufacturer looking at an EV platform that loses, I don't know, 5 figures, $10,000, $15,000 per unit, you just don't have the motivation to build it. Now, the government makes you whole by subsidizing your losses. It's a different story, which is what happens with Chinese manufacturers. But ultimately, the automakers are going to go where the profit is. And EVs, even for Tesla, have proven that they're just not there. We don't own any of the supply chain either. China does. So the idea that this gets more cost effective going forward is also a difficult case to make.
All right, Kevin, thanks so much. Appreciate it. As always, Kevin Tynan, Director of Research for the Presidio Group. And folks, that's been Kevin's call for the last, I'm going to call 7 to 10 years, focusing on the profitability. And that's a function of his understanding of where these automakers have come from over decades, and kind of the economics of EVs. The economics and the demand just aren't here at this time. So the automakers are focusing on where they can make money, and that's trucks and SUVs. And he has been consistent in that argument over time. Let's switch gears towards the media space. Lots of news there. As always, we could talk to Geetha Ranganathan every day if we wanted to, but she's got a day job. She covers the media stocks for Bloomberg Intelligence. Hey, Geetha, let's just start with Comcast. They reported numbers here. Give us like a couple notes on their quarter, but more importantly, what do you think the strategy is of the Comcast company going forward?
Yeah, thanks so much, Paul. For Comcast, really, as you pointed out, it's more about the strategy than the second quarter results. But just a few, high points from the results. So remember, they are the largest broadband provider in the United States. They have about a 25% share of the market, but that share has been rapidly declining. And we continue to see that in the numbers today. So they again lost broadband subscribers. And really, I think what investors are focused on, Paul, is that, this story is not getting any better. So over the past 4 years, we've seen intense competition from the telecoms, both on the fixed wireless side as well as fiber. And then now this year, you have this new competition with Starlink. Just with kind of the expansion in V3 satellites next year, the expansion in broadband capacity, there is so much fear on the street that Starlink is going to become another big competitor for cable And so just the story doesn't get any better. Now, Comcast, what they've done is they have altered their go-to-market strategy by becoming much more competitive in terms of broadband pricing. But that obviously has resulted in EBITDA getting crushed. And so we saw it, again, fall about 6% this quarter. Again, they're pointing to the story getting slightly better in the second half. But again, it's a little bit of a wait and watch. Longer term, I just don't think investors are optimistic about this cable broadband turnaround at all.
Okay, so it's kind of like managing the decline of its business right now, its main business. Is the company offering up any kind of growth story for investors to get excited about?
Yeah, I'm glad you asked that. Actually, they did that just 3 weeks ago, Scarlett. So, they are an interesting company because they're a vertically integrated media company. So, of course, broadband makes up 85% of their EBITDA, but they do have a great media business with NBC. And they announced plans just a few weeks ago to actually separate out that media business, which is, the NBC Universal business, along with Sky, into a separate company, which is supposed to happen sometime next year. Now, the whole story here has been that with the whole Warner Brothers bidding war, media assets have actually they're actually being really played up. And if you look at Comcast, NBC, for instance, just the collection of assets, it's a stellar collection of assets, and it almost resembles a Disney, if you will, because they are one of the few media companies that actually has theme parks very similar to Disney, has studio, has a broadcast network, had some cable networks, and has Peacock, the streaming platform. And so the big argument here was, cable multiples have actually declined. They've halved. So they've gone from 10 times EBITDA just about 3-4 years ago to 5 times. Ooh. And NBC, because it's being clubbed with Comcast, is suffering here. And so if you look at Disney, for instance, Disney trades at about 9-10 times. And so the question was, why are we punishing NBC for, cable's poor performance? So I think investors definitely are happy about that because it now kind of shines NBC in this new light, and it definitely gives them some strategic optionality as well.
And we know that Brian Roberts likes to do deals, so that's one thing. All right, Geetha, thanks so much for joining us there. Geetha Ranganathan, she covers the media space for Bloomberg Intelligence. She's based down there in Princeton. And again, if the Comcast, lots of asset value there, but, in businesses, unfortunately, that are facing some really challenging competitive landscape, particularly in the broadband business, as Geetha was saying. And then even in the cable network business, the NBC Universal, their cord cuttings impacting that business.
Absolutely.
And the question becomes, can streaming growth offset that? And they had their first.
How high is Peacock on anyone's list of streamers that they need to have?
Although we just subscribed to it because Karen from the Jersey Shore has a show she likes. So that's.
Which one is that?
I don't know. It's the one with Jennifer Gardner. That's all I know.
Okay.
Okay. So,
during the Olympics, I can make a case for it.
Yes.
Now that the Olympics are over, I'm kind of like, what do I get for this?
Exactly. So it's subscale, as they say in the industry.
Subscale.
So that's why they're thinking about, when you put out NBC Universal as a separately standing company, maybe it will merge with another content company. Like, I don't know. No, we'll see how it goes out there. S&P off 85 points, 1.1%, plumbing the lows of the day. The Nasdaq's off 480 points. Oof. That's 530 points. That's 2.1%. Ouch. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. So if you look at the major industry groups in the S&P 500, those that are on the move, it kind of tells the whole story. At the bottom of the list, communication services and consumer discretionary. So that's home to Alphabet and Tesla. And among the best performers, energy, because of oil. Now, at Tesla, Elon Musk said in the call last night, this is a massive CapEx year. No kidding. When you spend like that, free cash flow is negative. Alphabet, kind of the same story, boosting its projected capital expenditures for the year. The range there, $195 billion to $205 billion. And again, that's kind of setting the tone for the markets. Fed meeting next week with no forward guidance from Chair Warsh. It's kind of, at this point, anybody's guess with what's going to happen. Ahead of that, with a two-front war for the U.S. now, oil surging again. Brent, $100.18 a barrel. And because of that, American Airlines cutting the 2026 earnings guidance for the second time in 3 months. Persistently high jet fuel prices, and those shares down close to 8%. Still, interestingly enough, Stephanie Roth at Wolf Research isn't too worried about inflation.
Even though you're seeing energy prices certainly spike, in terms of the actual feed through to core, the main thing is going to be from airfares. Otherwise, we still see some disinflationary pressures coming ahead.
S&P 500 down 1%, 79 points lower, 74.18. The Dow, 487 points lower, that's down 1%. And then, of course, the NASDAQ Composite Index, 2% lower, down 526 points right now. Did you know 1/4 of the world's croplands are irrigated? Especially true in the Philippines, Vietnam, Indonesia, Myanmar, Nigeria, and Ethiopia. Nearly all the irrigation pumps are powered by diesel fuel. So with soaring prices for diesel, growing worry of food shortages, maybe even famine. And I complain about, what is it, $4.26 at the Wawa for gasoline. The diesel prices are like out of control.
Tom was quoting this morning a barrel of like distillates.
Oh, I heard him talking about that. You know, the crack spreads or whatever.
It's like $150, $160 a barrel. So I mean, you want to buy the refined stuff. That's where you're really paying.
Yeah. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. Appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. Being a corporate executive, never been easy, but boy, it seems like it's more difficult every year. You know, it's not COVID-19, it's tariffs, it's war, lots of issues out there. And I think during the pandemic, we all became somewhat more, I guess, interested or educated in all things supply chain.
Out of necessity.
Yeah, we say, where does this thing come from? Where does this piece of furniture come from? Where does this disc come from? This chip come from?
The answer was usually China.
Yes, or somewhere over in that part of the world, and that's got companies scrambling to find different supplies. David Garfield joins us. He's co-CEO of a consulting firm, Alex Partners. He is based in Chicago. David, what's the conversation you're having with your clients these days about, you know, just kind of global supply chain? They have to navigate different tariff policy, wars in various parts of the world here. What's the conversation like these days?
CEOs are focused on execution and speed as it relates to their global supply chains. Their companies, they know, can't afford to get stuck in analysis paralysis. They have to make decisions and take actions quickly. And the reason is simple. The business conditions keep changing. As you pointed out, there's geopolitical disruption, economic disruption, technological disruption, workforce disruption. So leading executives are adopting a kind of restructuring mindset, even in top performing companies. When business conditions are nice and stable, you can take your time and re-engineer supply chains. But with today's conditions, a restructuring mindset really helps. And one more thing that CEOs are doing is focusing very heavily on their cash flow, in addition to their traditional P&L and balance sheet metrics, because with all of the disruptions that we're experiencing, there can be sudden and severe strains on cash flow that are very much out of the norm. If we think about, trade disputes, for example, a company can experience a spike in raw materials and a drop in demand simultaneously.
Right.
So CEOs are focused on visibility and control over their cash.
I like what you said about how they have to adopt a restructuring mindset. But once you restructure, you kind of hope that it'll last for a little bit before you have to make changes again. Are they in a constant restructuring mindset, meaning whatever they put in place, they'll have to blow it up and change a month later or 6 months later?
So CEOs are trying to be as agile and as flexible as they possibly can. So not necessarily blowing things up, but shifting and adapting on the fly as business conditions change. A great example of that is what's happening with tariffs. Of course, we had Liberation Day tariffs, then we had rebates. Now we have 301 tariffs being added. The companies that, when tariffs were first put in place, established tariff war rooms so that they could monitor changes in real time and make adjustments, not only to their supply lines, but to their pricing. The companies that have kept those war rooms up and running are now in better shape to deal with the ongoing disruptions in trade and transit. That's a great example of having a restructuring mindset, not necessarily blowing things up, but being able to adapt and to remain agile.
At the same time, they have to adapt to this new thing called artificial intelligence and how it impacts their business, either for good or for bad. How's that conversation go these days?
Companies are deploying AI as fast as they can, but the ROI is often missing. The winners in terms of AI deployment are the companies that are pursuing practical AI solutions. This is applications, specific applications that have very strong business cases. What we see is a lot of companies either struggle with AI because they get stuck in the strategy phase. They build up an inventory of use cases, but don't pull the trigger and execute. Or they try to do AI everywhere all at once. And that, of course, is very slow and can be very costly. So the winners in the space are focused as well as fast. And if you want, a great example, we worked with a telecom company to help them deploy agentic AI to optimize their field operations. So these are the people in the trucks who go out and install and maintain the cell towers. And the agent not only optimizes the route that they drive, but also the approach that they take to do the installation or make repairs. This is a focused solution. It's very practical. It's saving the company millions of dollars a year, and it's up and running.
I thought the way Paul introduced you and kind of introduced the topic made a lot of sense, how supply chain was something that we didn't used to think about. It was kind of invisible. We just took it for granted. And now it's very much top of mind, front of mind as well. Is this an industry that is growing, that is hiring? I mean, is there more need for supply chain experts or people to enter the field than before?
Supply chain has always been kind of a quiet area, but a hot area, meaning where, strong operational and deep analytical skills really pay off because, it's the lifelines of the company, their cash flow and the flow of goods. So I would say that it is a strong area in the labor market, particularly for people who can understand international and multinational trade flows and who can apply leading technology to solve some of the problems that are cropping up in supply chain management.
All right, David, thank you so much. Appreciate that. David Garfield, co-CEO of Alex Partners out there in Chicago, talking about supply chain and just kind of the changing playing field for CEOs and boards that they have to deal with. A, technology, B, trade policy, trade uncertainty, and armed conflict in various parts of the world. Tough to lay down strategy. When
it's a very different playbook than what it was after the WTO, after NAFTA, where it was increasingly about outsourcing, and now it's about reshoring and bringing things home and making it more resilient.
Yep, and that arguably, if you listen to some economists, has some inflation concerns to it. If you're bringing the shorts, all this stuff back home, it's a higher cost here, and that could result in higher prices. So it's one thing that economists are following. Markets are off here today by more than 1%. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Good Thursday morning. Not so good if you were long equities and you're looking at the red on the screen. It's considerable. The NASDAQ Composite Index down 2.4%. The S&P 500 down 1.25%. Alphabet, the catalyst for today's sell-off. And it's kind of rippling across the growth complex here. Of course, oil prices rising are one of the things that are bugging investors right now. Brent is above $100 a barrel. WTI now approaching $92 a barrel. And that means that it's also a concern for investors and executives at airline companies. American Airlines came out with results, lowering its outlook. Southwest, its guidance reflects the higher fuel expenses as well. So let's bring in Benedict Kamal. He is Bloomberg's global aviation editor. He joins us now from Berlin. Benedict, just walk us through the tone that American Airlines and Southwest are setting here when it comes to how they anticipate fuel costs to affect their expenses and their earnings going forward.
Hi from Berlin. I mean, it's a sense of disappointment, really, if you talk to American. The CFO said, look, only 3 weeks ago, things were actually not looking that bad. And if we'd sort of closed the accounts 3 weeks ago, we would have had a very different set of numbers. But since then, things have really gone south for the airline industry in particular, and that's because of the oil price that you've mentioned. This is one of the big expenses, if not the biggest, the fuel price for airlines, and they are really susceptible to swings. And we've seen a lot of swings, and it's all swung up lately. So what we see here with American is a pretty negative outlook into the full year. It's the second time in exactly 3 months that they've had to cut their guidance. They are more pessimistic now than they were even in April, and they now expect a loss for the year. That seems likely. Investors and analysts had hoped for a profit, so that's something you see reflected in the stock, which is off sharply today. It's also an interesting contrast compared to what we heard from Delta and what we heard from United. If you lump those three together, United and Delta are probably more sort of in the area of sort of the premium traveler, whereas American is trying to get more to the premium segment, but they're not quite there yet. So they are more affected by the low cost and the more price susceptible travelers, and that's something that is really showing up in their accounts today.
What are the airlines saying about customer demand? I mean, we know the costs on the fuel side are a challenge here. What are they saying about customer demand?
Well, it's a pretty diverse picture. If you speak to somebody like Ed Bastian, who runs Delta, or Scott Kirby at United, they will tell you, look, we're lucky. We have the well-heeled, high-paying, front-of-the-plane customers who don't, frankly, really care whether their ticket costs a little bit more or less. These are sort of price-immune travelers, by and large, and we can absorb, and they can absorb those kinds of hits that come with higher ticket price and so on. If you sort of go down the food chain, as it were, and you move to the back of the plane, obviously, people are a lot more price susceptible, and that's where your Southwests, your Americans, your Frontiers, those types of airlines that sort of serve the middle and the lower end of the market, that's where they are most hurt. So what we've seen since the start of the year, and most notably since February, since the conflict in Iran started, is this sort of bifurcation of the industry between the haves and the haves not. And by that I mean those who have the well-paying customers and those who aren't quite there, who are still sort of working their way up to that food chain, and that's where you see that split in the industry.
I think about Delta and United too, with its relationship with Chase, Delta with its relationship with American Express. These airlines make a tremendous amount of money selling their reward points to credit card companies. Is that as big of a deal for an American Airlines, a Southwest? I mean, every airline has to have this kind of relationship with a bank, doesn't it?
Yeah, I mean, it's becoming increasingly important across the industry, and sometimes you think you're dealing with, credit card companies that have an airline attached rather than the other way around. Loyalty and brand loyalty have become such big things, and they are, as you said, they are massive money spinners for the industry, but you have to build that brand loyalty, and the way to build that is to have a product that people will come back to that is sticky. Somebody like Scott Kirby will say, we have sort of built the stickiness into our system that people want to come back. They like the product on the plane, they like the product in the lounges. There's a lot of investment going into sort of that part of the operation to create that stickiness. And interestingly, Southwest is trying to move into that field now. They are sort of moving up the scale to achieve exactly that. The question over time is, where's the ceiling? Not everyone can buy those expensive tickets. Not everyone has access to the lounge. Do we come to a point where we've sort of reached peak premium, as it were, and where that market is saturated and you're fighting over an increasingly small cake, and there's just not more slices that you can hand out? We're not at that point yet. But interestingly, over here in Europe, there is a much larger slice of the low-cost market, the EasyJets, the Ryanairs, the Wizz airlines of this world. So that's a far more sort of split market, whereas in the US, everyone's crowding to the high end.
All right, Benedict, thanks so much. Appreciate it. Benedict Kamel, he is Global Aviation Editor for Bloomberg News. He is based there in Berlin. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour, Bloomberg Intelligence, starts in just a moment with stocks selling off. The S&P off 91 points, 1.2%. The NASDAQ even worse, off 600 points. That's 2.3% on the NASDAQ. The VIX out almost 3 full sticks here, 19.4. 10-year Treasury yields higher, 4.70. That's up 5 basis points. And WTI crude oil, it's up $5.10. It's almost 6%. Let's call it $92 a barrel. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Brokers studio in Midtown Manhattan. This is the second hour of Bloomberg Intelligence with Paul Sweeney, Scarlett Fu, and John Tucker. And we have a market that is plumbing the lows of the day, and it's still early. The NASDAQ Composite down 2.4%, S&P 500 losing 1.25%. You could blame it on a number of factors. Oil prices among them, with Brent now above $100 a barrel. Scott Levine, our senior energy services analyst, will be joining us to talk about that. Paul Goldberg, our senior equity analyst, will join us to talk about Blackstone earnings. Blackstone reported results this morning, getting a big boost from exits and winning bets on AI and data centers. James Abate, the managing director and head of fundamental strategies over at Horizon Investments, will join us to wrap it all up and tell us how he sees this affecting his investment process. Arvind Krishna is the IBM CEO, and he will be on Bloomberg speaking with our Ed Ludlow and Romaine Bostic later on this hour. We will be joining that conversation. And of course, moving forward, Madison Muller, our Bloomberg News health reporter, will talk about Eli Lilly's next generation weight loss shot. It has cleared yet another hurdle, so more on a GLP-1 revolution. But first, we're going to bring in John Tucker to give us an update on the markets here and the latest business news headlines.
And we're lower. S&P 500 down 97 points, 1.3%. At 74.03, the Dow Jones Industrial Average right now 509 points lower. That's down 1%. But most of the action, the NASDAQ down 2.4%, a 621-point sell-off there. Now, if you look at the NASDAQ, 832 stocks there are higher, 2,042 lower. In the S&P 500, break that down. That's almost even. 250 advancers and 253 decliners. You know, it was on the conference call that Alphabet executives disclosed their projection that CapEx would increase again. Actually, before that, the stock was actually up in aftermarket trading yesterday after the results. So that kind of overshadowed the earnings results that we got from the Google parent. And then Tesla, Elon Musk said on his conference call that this is the year of CapEx. Those guys are spending and spending. Investors, as a result, they're skittish, and it is weighing on markets right now. As you look at shares of Google, Alphabet down 7.4%, Tesla close to 14% lower in today's trading. And then also weighing on markets, toss in oil in the mix. You get this sell-off. Brent is up close to 7%, above $100, $100.57 a barrel. Still, Tracy McMillian at Wells Fargo sees markets pushing higher.
This morning, we're seeing a bit of a negative tone because of all that spending, but we believe that through the end of the year, we could see the S&P 500 anywhere from 7,800 to 8,000. So there is still some upside.
Long bond, the 30-year, let me do that, up close to 4 basis points, 4.18%. And I think it's the 28th straight day that we've been above 5% on the 30-year. Twos up 6 basis points at 4.35%. Let's put a price tag on the recent heat wave. I mean, it was particularly bad in Europe, so I'll start there. According to a survey by the London School of Economics, the heat wave, the scorched Western and Central Europe in June cost the UK economy $1.5 billion in lost work hours because, everybody stayed home, which was kind of stupid because you don't have air conditioning.
It was worse there. Yeah, it was hot.
I mean, you have air conditioning in the offices there.
But the problem is the tube doesn't have air conditioning.
Yes.
So how do you get to work? There's no window in the tube. No. Or maybe there is, and you don't want to open that window.
No. It was the most severe ever recorded in Europe. About 2,700 excess deaths in Wales and England alone. This according to the new research that was just out. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right. Thank you so much, John Tucker, with our Bloomberg Business Flash. Stocks are on the move. At least the indexes are to the downside. So let's bring in Avalon Purnell. She is our Bloomberg News equities reporter, and she's got some individual stocks that she wants to tell us about. Avalon.
Yes, Tesla, that's ticker TSLA, currently dropping about 14%, most since last June. And that's after the electric car maker reported a second quarter profit miss and also just had a lot of accelerating CapEx, which is something that we saw in a lot of notes. Morgan Stanley noting that while this CapEx is very much high, it is necessary to become a leader in robotics, though they are also noting that these investments are really going to push the focus on tangible robo-taxi and Optimus milestones. Another analyst at Canaccord Genuity writing that the breadcrumbs on the conference call may point to a union with Elon Musk's other company, SpaceX.
That's what I think they're hoping, but SpaceX stock is nothing to write home about as well. All right, what's next?
Alphabet, that's ticker GOOGL, currently falling about 7.5%, most since February. And that's after the parent company of Google's higher capital expenditures fueled fears of the cost of AI development going forward. The increase in CapEx comes as the company's free cash flow, turned negative, amplifying questions about how much does it actually cost to become a hyperscaler. Also worth noting that Alphabet's future spending commitments have now ballooned to $811 billion as of the end of June. That's up nearly $500 billion from just 3 months earlier.
These numbers are bananas.
I know. And it just...
Like, you might as well be saying cajillion dollars.
Right, exactly. One more.
Yes, Quest Diagnostics, ticker DGX, currently jumping about 10% to hit a record high. And that's after a healthcare services firm reported stronger than expected second quarter results. It also boosted its profit and revenue forecast for the full year above expectations. Citi noting that continuing strength in the utilization of Quest services, which include like blood tests and diagnostics, are one reason for the beat. And those results are now making Quest one of the biggest gainers on the S&P 500 and are also pushing broader positive sentiment across the sector for other diagnostic companies like LabCorp.
All right. Avalon, thank you so much for giving us the 3 stocks on your radar. And of course, for more conversations like this, be sure to subscribe to Stock Movers. It's available on Apple Podcasts, Spotify, and anywhere you listen. These are 5-minute audio reports, always available to you at any given time. Let's go back to oil prices because the move here is pretty dramatic. We're now looking at Brent up 7%, Paul, and WTI up 6%. I know it's geopolitics driving this, but it very much feels like the energy market is now looking at a congested Strait of Hormuz, a closed Strait of Hormuz. Let's bring in Scott, Energy Services Analyst. Scott, how do you look at what's happening here?
It's not good. Basically, we've seen, the real incremental development that we've seen since March when the market started freaking out and the conflict began is the Houthi attack in the West. So one of the major moves that the Saudis made in response to the closure of the Strait of Hormuz then was to start exporting more oil off the West Coast out of Yanbu through using the East-West pipeline. And just this month, we've seen the Houthis attack, and only in recent days, attack a couple of ships in the Red Sea, and that's on the west in Saudi Arabia, and that was the primary plan B, if you will, in terms of getting oil out of Saudi, and Saudi is the biggest producer in the region. And so I think that's giving the market concern that we're entering a second, more accelerated phase here in the conflict. Certainly things are not slowing down. All the headlines you're seeing suggest things are not moving towards the truce. If anything, they're moving in the other direction, right? And so if folks were optimistic that some of these plan Bs would work in reducing the impact on oil markets, we're finding out that's not true.
Scott, I think after weeks and weeks and weeks of all of us studying the Strait of Hormuz and all the maps and how that kind of works, we kind of understand that part of the world. Talk to us about the Red Sea and how easy or difficult would it be for the Houthis to effectively shut that down?
Yeah, I mean, you look at a map and it looks very similar in reverse to what you see looking at a map with a very narrow choke point, which is the Bab el Mamden Strait there. That's at the southern end of the Red Sea, and Yemen is alongside that and to the south of Saudi Arabia. And so it's, almost analogous to the positioning of Iran near the Strait of Hormuz alongside the choke point. And so, if folks are willing to risk moving ships out of the region there, they're exposing themselves to hostility inherently in what is viewed essentially as an Iranian, not proxy per se, but viewed that way. And certainly the behavior we've seen out of them suggests they are seeing themselves that way as well. And so, there's another artery to the north through the Suez Canal that is significantly more expensive to transit if you're looking to get oil out of the region there, and is magnitudes, more expensive, and probably is not being considered as remotely plausible in terms of a Plan C, if you will. So, the bottom line is that this really suggests that this is maybe a more troublesome situation, and that other options need to be investigated in order to get oil to market.
Scott, what does this mean for the U.S., the U.S. energy complex? Because we talk about how the U.S. is a net oil exporter. The energy sector has done very well when it comes to earnings and when it comes to their businesses the last couple of months. How does this change that, or does it not?
Yeah, it's interesting. I think it does in the long term, and our energy team published a deep dive suggesting that this, could be a structural change on the back of this conflict, and this conflict catalyzed that. But what's interesting is while we have seen the rig counts and the frac counts move up in the last 3 months, earnings season so far has not suggested that it's moved dramatically, and certainly not as much as investors were anticipating. Halliburton saw a 7% sell-off in their stock in response to earnings on Monday. And today we have Liberty Energy, which is one of the top 4 pressure pumping companies. The stock is down nearly 10%. Even though they met expectations, their outlook for the market was cautious. They haven't seen a lot of price improvement, and suggest to us that shale producers are remaining restrained and hesitant in increasing activity levels. So while this has been good for U.S. shale, and we had seen a decline in rig counts the last 3 years, the move up is gradual.
All right, I'm going down there. I'm telling you, I'm going down to the oil patch, get an oil rig.
Yeah, you're going to be a new wildcatter, right?
Yes, $92 a barrel. Scott Levine, thanks so much. Appreciate it. Scott Levine, Senior Energy Services Analyst for Bloomberg Intelligence. Well, our good friends at Blackstone, they reported a 26% jump in second quarter earnings. It was helped by profits from its artificial intelligence-related investments. Earlier, Blackstone President and COO John Gray spoke with Bloomberg's Danny Berger. He told Danny that the power of AI is being underestimated and that AI is creating new revenue streams.
I think fundamentally what people aren't getting is how powerful this technology is at companies. We're beginning to see real-time examples, certainly in customer service, in coding. It's now starting to move to the revenue generation side, where businesses are creating new lines, new revenue streams using this AI. And I think because this tool is so powerful, there's an underestimation of what's happening.
All right, that was Blackstone President and COO John Gray. Speaking with Bloomberg's Danny Berger, another AI bull that's a crowded room. Paul Goldberg joins us, Bloomberg Intelligence Senior Equity Analyst. He covers Blackstone. So there, Mr. Gray, pretty positive on AI and what it may mean for corporate America and for Blackstone. What was your takeaway from Blackstone's results, Paul?
Thanks, Paul, for having me. I think very strong results generally across the board. You mentioned 26% 26% increase in distributable earnings, but it's not just that, it's the 20+% increase in fee-related earnings and so on. There are three drivers that kind of fluctuate from time to time, from quarter to quarter, that drove those. The performance revenues, the fee-related performance revenues, and transaction fees, they fluctuate from quarter to quarter, where base fees were a little bit softer. But net-net, very strong, broad-based, very strong inflows. They had $68 billion of inflows in the quarter. If you annualize it as a percentage of a gross inflow rate, it's a 21% gross inflow. Obviously, there are some outflows as realizations happen and so on, but there is a very substantial demand from institutional investors in particular for alternative assets, and Blackstone benefits from it.
Alternative assets also includes private credit. What do we know about the private credit funds that Blackstone has out there? And because there had been a lot of redemption requests, not just for Blackstone's funds, but across the industry.
Certainly. To put this in perspective, out of the $68 billion, about half of it came from the private credit business. So it's still very healthy from the institutional side. And the wealth flows, even though they have been softer and might still be a little bit softer in the second half, but the headlines are receding. You don't have as much pressure. And if you look at the biggest, almost $100 billion private credit fund, the private BDC that Blackstone operates, BCRED, it actually had $1 billion of net flows into the fund. So things are not necessarily falling out of the sky, even though you've seen some of those redemptions, and they might continue a little bit in the second half.
Why are Blackstone, KKR, Cargill, the blue chips out there, why are their stocks down 20, 25% this year?
Well, I think there are several issues that came around with it. Number one, early in the year, we had some scare in the software space, right? They were concerned that software is overvalued, that AI is going to take out some of the software businesses, and that worked through the private space because they were heavily invested in software. Blackstone, for example, said today that if you look at it broader, some of the private credit BDCs, they have a heavy 20 to 30% exposure. But if you look at the bigger, large managers in aggregate, Blackstone only mentioned 6% exposure to software, so that's much smaller, but the market reacted to it, trying to figure out. And the other thing were obviously the redemptions from private credit that are sort of tied through the wealth channel to these software concerns.
We have about 30 seconds left, Paul, so just very quickly here. What do Blackstone's results mean for Apollo and Carlyle, which will be reporting in August?
I think they should be very strong. I think there was a lot of inflows. There was a lot of institutional demand. I would also add Goldman, BlackRock, JP Morgan in the mix with their alternative businesses. They were very healthy. Goldman had a record quarter of inflows.
All right, Paul, thanks so much. Appreciate it. As always, Paul Goldberg covering a lot of the financials over there for Bloomberg Intelligence, Blackstone, with some solid results. I would think with the better IPO market, the M&A market, there'd be lots of opportunities for these big private credit and private equity companies to monetize some of their assets and get some exits, which always seems to be the hardest part of the private equity business, exiting at a good way. James Abate, he's going to come up, talk to us about the markets. He's over there at Horizon Investments. That's coming up in just a moment.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom of this Bloomberg Business Flash, brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. A couple of oil jumping, and then of course you have the renewed concerns about all the spending by companies on artificial intelligence. Alphabet sinking 7%. They raised their capital spending forecast. Tesla tumbling right now. It is down 14.3% after they also mentioned capital spending, raising that. And they also had profit that fell after the delivering results after the close of regular trading yesterday. And the rise in oil, what may be a two-front war now for the U.S., also pushing Treasury yields higher ahead of next week's Fed meeting. The two-year yield 6 basis points higher right now at 4.35. Traders actually see a 30% chance that the Fed next week, the Kevin Warsh Fed, is actually going to raise their benchmark interest rate. Let's go to Armonk, International Business Machines, cutting its full-year sales outlook, including for the software unit. They reported a dip in demand for the mainframe business. The CEO is going to come up any moment. IBM shares ahead of this right now, actually up 0.1%. Overall, the S&P 500 down 109 points, down 1.5%, 73.89 on the index. The Dow Jones Industrial Average is down 608 points. The Nasdaq Composite Index 684 points lower. That's down 2.6%. And again, oil above 100. This is Brent, the international benchmark. $188, $100.88 a barrel is what I'm trying to say. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Scarlett.
All right. Thank you so much, John Tucker. Yeah, well above that $100 level. It was kind of flirting there, got there, and then came back, but now we're above that level.
Yeah, that is not bueno.
Not bueno. Okay, let's move on to talk to James Abate. He is a friend of the show, managing director and head of fundamental strategies at Horizon Investments. James, put this all together, what you see today, because we have a risk-off day with stocks, especially growth stocks, deeply in the red. You have yields higher. You have oil elevated. We just talked about 101 a barrel here for Brent. Is this kind of a temporary shock to a confluence of headlines today, or are we at a turning point here?
I think this is, a continuation of the trend that we've seen, and you could take it away from most recent earnings announcements. Let's not forget that if you look at industrials, utilities, other areas of the market, they're actually positive today. So, as we've talked about the last few times on the show, our thesis for the year as active managers was to take advantage of two themes. The first was this generational cash flow transfer from the hyperscalers to the semiconductor and other related downstream recipients was going to continue, as no one, particularly Alphabet, Microsoft, Meta, et cetera, wanted to be the company, despite now going free cash flow negative, would be the one to throttle down their CapEx and didn't make it to the finish line in generative AI, especially as we're seeing more case studies from, pharmaceutical, chemical, and other service-oriented companies talking about their AI investments and implementations, finally crystallizing a return on investment for themselves. So Alphabet's announced CapEx increase last night kind of confirms that.
So, James, how are you guys at Horizon playing AI these days?
So our things is still going to be picks and shovels. Okay. I think the second point in terms of themes for the year with that, most people still underestimated the broad-based industrial investment cycle that's being driven by both cyclical factors like inventory restocking and tax benefits that were in the one big beautiful bill, as well as long-term secular trends. I mean, furthermore, you have to remember the manufacturing recession that lasted between 2020 and 2024, best illustrated by the ISM Manufacturing Index being negative or below 50 for that period of time, forced a lot of those companies in those industries to restructure and right-size themselves. So now, as we have top-line growth picking up, the operating leverage to bottom line profits is the best we've seen really since the early 2000s. And the potential from this coiled operating leverage is going to be the catalyst, I think, for a strong earnings environment for the foreseeable future. And we've seen it with announced results today from industrial companies in the transportation sector, railroads, truckers, broad-based industrial companies, 3M, other infrastructure companies like pipeline companies and so forth. From an investment's point, it matters because it implies some pretty meaningful runway for incremental revenue and further profit margin. And those disciplining efforts that were in place for a 4-year period are starting to pay off in spades for a lot of these companies. So again, for investors, avoid long duration, stable growth stocks that work in a PE expansion-led market and embrace cyclicals and commodity-related companies.
To your point, the S&P 500 equal weighted index is only down 0.5% if you round it up versus the 1.5% drop in the S&P 500 market cap weighted index. James, how are you thinking about the rise in yields? The rates market has been selling off. The 10-year yield now at 4.7%. The 30-year has been holding above 5% for, I believe, 27 days, something like that, the longest stretch since 2007. What does that mean for the equity market at this juncture?
Well, first off, what it means is that don't look for PE expansion to be the wind at your back. In fact, look at it to be the wind in your face, essentially. So in essence, when you think about stocks, what makes them go up? It's earnings growth, and it's a change in the PE multiple or valuation multiple that people are willing to look at for the market from a systemic basis. I still continue to think that we're basically in a systemic derating of equities as equity risk premiums go up, yields stay high. So you need to, again, sit there and embrace cyclicals and commodity-related companies that have exceptional earnings that can offset that systemic derating. Now, in terms of what the Fed does, despite the recent rise in the two-year note yield, I think, that probably not a great indicator like it usually is of Fed action. I think the Fed's going to keep rates on hold for the foreseeable future. And unfortunately, what we're seeing is, that's leading into pressure in terms of some of the regional bank results with bond position losses as well as just net interest margin. And that's been the one disappointing factor that we've kind of gleaned from the results that have been posted by the banks over the last week as well from an earnings perspective.
All right, James, thank you so much. Really appreciate it. James Abate, Managing Director and Head of Fundamental Strategies at Horizon Investments. Coming up, we're going to hear from Arvind Krishna. He is the CEO of IBM. He's going to be speaking with Bloomberg's Ed Ludlow and Romain Bostic. A little bit of a preview for that. We're going to check in with Anurag Rana. He's a senior tech analyst for Bloomberg Intelligence. He covers IBM, has been covering it for decades here. Anurag, what did the company pre-announced week revenue a couple of weeks ago. Stock took that historic decline. Then they released earnings yesterday or today. What did you hear? Because I see taking guidance down maybe yet again.
Yeah, I mean, the guidance was down based on the full year from what happened. But, one of the things they said was the guidance was only down by about 100 basis points. So it's not like that big of a cut for the full year guidance. And I think that's going to be the biggest question to be asked for the CEO that, what makes him so confident that he could achieve an acceleration in the second half.
All right, hang around, Anwar. We're going to go right now to that discussion. We have Mr. Arvind Krishna. He is the CEO of IBM. He's speaking with Bloomberg's Ed Ludlow and Romain Bostic. Let's listen in.
Of the quarter. This was pretty confined to, I'll call it the Fortune 100, the deals that were within a subset of those. Now, 1/3 of what didn't happen has already come back. So that tells us that this was a reprioritization and those deals were very real, as opposed to us being optimistic in our projections. And Romain, I would also add, I think that maintaining our free cash flow tells us that we have levers around productivity and conviction and confidence in the business. And that is also, I think, going to serve our investors well. But the next few months will tell us that.
Well, on that cash flow figure, yes, and that certainly pleased a lot of analysts and investors out there, that $1 billion number of projected free cash flow growth, you maintaining the dividend as well. But you're largely done that so far by cutting costs. So that raises the question that if we are anticipating slower growth on the revenue side, does that mean more cost cuts are in store?
The bulk of our cash flow growth over the last 4 years has actually been on adjusted EBITDA. So that tells you that this is mostly through revenue growth. And our model has always been that we are the last dollar is more productive and more profitable than the first dollar. So we've been growing revenue 4-5%, and we've been growing cash flow up in the 7-9%. So that's kind of our model, and we intend to keep maintaining that. Now, right now, if we drop revenue by 1 point, because we said 4 to 5 instead of 5+, we can absolutely make it through productivity. Cost cuts is an interesting question. Cost cuts doesn't always come down to people reduction in headcount. Our headcount has been more or less flat over the last many years. I think there's a lot of third-party spend where we are going to get a lot more efficient with that third-party spend than we have been always.
Bloomberg Tech is live on Bloomberg Television and Bloomberg Radio, and we're speaking with the IBM CEO, Arvind Krishna. Arvind, good morning. You want to focus on accelerating revenue growth and accelerating profitability. And just really simply, I'd love to hear what you're asking the team to do differently now in response to all of the factors that you outlined.
So, Ed, really, so if I look at our software business, 80% of it is already an annuity consumption OPEX-based business, 20% of it is a CAPEX business. If we think that the CAPEX headwinds are going to continue, but 80% is already growing at about 8%, we want to put a lot more focus. So we're going to direct a lot of the team with forward-deployed engineers, with people who are focused on deploying the software at clients, much more technical help, and make that 80% grow even faster. Products like Red Hat, Confluent, Hashi all fit that model. On the CAPEX side, we have to make sure that while we can continue to do it, don't depend upon outsized growth on that side to go there. Then on the supply chain, can we leverage all of our capability in supply chain to make sure we have enough distributed infrastructure in storage, in Unix systems, that people can fulfill all of the demand? Because we came out of the second quarter with $500 million of backlog in that part of the portfolio. So those give you an idea of the kind of changes that we're making already, not just for the rest of the half.
You summarized the state of the world beautifully. You said that customers shifted spending towards servers, storage, and memory in late June. And when I posted on social media, you're coming on the show, the question from the audience is really simple. Did that trend continue from June into July? And for how long do you expect it to last?
We have not seen it in July, but I would tell you, look, the semiconductor pricing, memory is up, 3 to 4 times over the last 18 months. Networking infrastructure is up 60 to 80%. Fiber is up. Connectors are up. I do think that some of these trends on the underlying components are going to carry on for some more time. That works its way up into those things. So people are going to have those prices. Now the question is that going to maintain a reprioritization of the CAPEX spend? If I take the signal that a third of our deals closed, then that says no, people are going to get more careful about how they spend their CAPEX. If that goes into September, because a lot of CAPEX does get committed at the end of a quarter, not always through, then it means that that carries on for some more time. And that is why we gave a guide of 4 to 5%, depending upon if that carries on, we'll be at the low end of the range. But if some of it comes back, then we'll be at the high end of the range.
So Arvind, I know there's a big focus right now on sort of the clients that sort of did not necessarily materialize in the quarter. With regards to the existing clients that you have, and I'm primarily referring to your mainframe business, I mean, can you share like sort of what percentage of those clients are actually increasing their spending? Is that going up still?
Absolutely. So the current machine is called the Z17. The Z17 has been from the beginning, which was May of 2025 to today, at 130% in terms of the capacity growth compared to the prior machine. That's one very strong signal, and that's an aggregate. Then you can say, hey, is everybody in there or only a few? 85% of the clients are increasing their capacity as opposed to the 15 who are not. That optimization goes on all the time. And I would tell you this is probably the best that we have seen in a long time of what is going on there. Software is going to lag.
Mm-hmm. Yeah, software is going to lag. I mean, look, we know the hardware capacity is there. Software is lag. And I understand why it's lagging in the moment. And I'm going to ask you a question, and forgive me if it's a bit unfair, but I look back to the 1990s and whether there are some parallels to some of the mainframe issues that IBM went through back then under a predecessor 2 or 3 times removed from you, John Akers. And this idea that at that time we were going through this paradigm shift in computing and how companies spent and allocated their money. And there was a lot of talk by the CEO then that the issues were temporary, that they were economic, and that they would right themselves. We know in hindsight that it was much more structural. Why should we now look at this major shift going on with AI and the computation involved in that and think that this time is different?
Well, we have to look at what the clients are doing. I always start there. Our opinion is an opinion. What clients do is what matters. So when I check with my clients, those who do credit card authorizations, are you going to maintain the mainframe? And they go to, well, the resilience, the amount of capacity, the unit cost of it being 5 to 15 times cheaper is important. The big difference from that time, early 1990s to today, Romain, is the cost issue. You could not argue that the mainframe was cheaper on a unit cost basis for the workloads that are moving off than at that time the mid-range computers. I'll call it the whole Unix. It wasn't really client server. It was Unix taking the workloads off in the early 1990s. That issue you have to look at. If there is a cheaper alternate for that workload, I'll sort of look at you and say, that means in 5 to 15 years, it will move off. But that's not the case. Right now, for the workloads that are on, we can show the clients that it's 5 to 15 times cheaper to keep it on the mainframe. They're not, but that's not all workloads. That is workloads that need protection, that need resilience, that need the burst capacity that comes. And so for those kinds of workloads, the mainframe is the architecturally superior platform. That was not the case 30 years ago for the workloads that did go off.
Live on Bloomberg Television and on Bloomberg Radio, this is Bloomberg Tech, speaking with IBM CEO Arvind Krishna. I've been listening to you a lot recently on long-form podcasts, some clips on the social media about your view of the world, what it's like to be a CEO in the domains that IBM operates in. And it's interesting how quickly it comes back to the macroeconomic backdrop. A lot of people looked at the guidance for the balance of this year and would say, and they do say, Arvind, on this show, memory prices are not changing. They continue to push higher. They look at the outlook for growth. Could you just explain the data points you rely on that give you the confidence on the new guidance that you've given and whether it is actually achievable or it will be difficult to meet?
Yeah. So, Ed, I'll come back to, for ourselves, we have to look at our demand pipelines and our yields and how we get things going. But I think for your audience, let's look at it this way. Number one, most important, is what is GDP growth going to be? We think that that's between 2 and 3% for the year if I look at the globe. And it is going to be consistent even in the Middle East, even in Asia, where there is a lot more energy and disruption. We actually see a lot of growth. Tech is going to be, I think, 2 to 3 to 4 points above that. So that puts tech in terms of what the market is somewhere in the 5, 6, 7%. Then that comes back to what parts of our portfolio can play against that demand and what parts cannot. And so I look at the parts of the software portfolio. That's why I talked about the 8% growth in the 80% of it. That can play right into that. Then I look at our distributed infrastructure. That can play right into that. I think consulting will be in that 1, 2, 3%. It is not going to be in the double-digit growers. But we see the demand and we see the signings and we see the clients leaning in to say they want transformational work done. That's how we kind of know, Ed, that beginning with the macro and then coming down. I'll make a prediction for you. I think technology spend is going to become a larger and larger part of every enterprise's budget, Used to be 3% since Romaine raised it 30 years ago. It's probably up at 5-6% on average. I will not be surprised if by 2035 it's 10% of everyone's budget.
Give you a quick micro case study. Bloomberg reported that Starbucks is replacing some IBM tools on the software side with in-house.
Yes.
Talk to that.
So Starbucks is about a little over $2 million a year client for IBM. The portion they're replacing is a product called Tririga that does real estate lease management. The version of it that Starbucks has is almost 10 years old. I'm not surprised that they're replacing it because I've actually been describing publicly software which is largely interaction-based and is based on ease of use as opposed to anything else can be easily replaced by AI and AI agents, and that is what is going on there. However, if I see other parts of Starbucks and maybe the ability for our Hashi portfolio or security portfolio, how about if I phrase it this way? I would not be surprised if Starbucks is a larger client next year than it was last year.
With regard to how this world is evolving, Arvind, I am curious just internally about your plans to hire, particularly when it comes to the technological side. Have you been able to keep pace with some of the other companies out there also trying to do what you do and pay some of the salaries that you have to pay?
Well, we hired 3 times as many college hires this year than we did last year. And I think that given others seem to be backing off college hiring, it gives us an incredible ability to bring in great talent and to then grow them inside our company and to offer them great careers. I think if I looked at it last, we had, I think, 20 million resumes in our applicant database. So that gives us a huge field to go look at. So, I mean, I don't worry about bringing in talent. I actually worry much more about can we give them a great career and a great pathway, because not everybody is cut out to do work that is going to be demanded, because I don't think there's a lack of employment. But the nature of the work, if you can't use AI tools, if you can't use the productivity tools, then it's going to be really hard for you to be competitive with your peers.
We already know sort of the potential impact of what AI means for the economy and for your business. There are a lot of people looking around the corner, including yourself, to quantum. Is that a viable business on the horizon, or is that just a moonshot that you're hoping actually sticks?
Well, when things are 2 years away, I wouldn't call them a moonshot. I think quantum is now in the engineering realm as opposed to the science realm for the next 5 years. And I believe that by 2029, we will deliver a machine that does 100 million computations of large-scale, fault-tolerant quantum computer in the next 2 years. I think that's an incredible opportunity. I'll quantify it, and this is not just our work, a lot of third parties. By the end of 2030s, we think it's about $1 trillion total market opportunity in terms of value that quantum will create. That is why we also doubled down this morning and announced that we bought HRL from GM and Boeing, and that is going to help us bring people with a lot of talent around materials, spintronics, quantum sensing, and other sensor technologies to add to our own effort, so we are even more well-positioned to go win in this market.
Arvind Krishna, IBM CEO, of course, alongside Bloomberg's Romaine Bostick. Thank you both very much. I would note that IBM shares now modestly higher, 0.3%.
All right, that was Arvind Krishna. He is the CEO of IBM. He was speaking with Bloomberg's Ed Ludlow and Romaine Bostick, saying that Mr. Krishna says infrastructure deals already coming back, and he also says didn't see customer spending shift continue in July. So it's a good route. So I was trying to talk maybe some of the business coming back. Rana rejoins us here. He's a senior technology analyst for Bloomberg Intelligence. Anurag, what you hear in that discussion as it relates to maybe IBM and their book of business going forward? Because, again, when they pre-announced several weeks ago, that really shocked the market.
Yeah, so the two big takeaways for us was, one, obviously, was that the July is, turning better and some of the deals are coming back. And that's kind of what we had previewed, because the software that's sold with the mainframe, you just can't discontinue it. You have to buy it. And, that's coming back. But the one thing that I would also say is, the macro space is not good. So we are looking out in the second half, and I actually don't know how we can look at consulting remaining at the same amount as it was. Now, I hope I'm wrong in that case, and all of these companies do better. So that's one area. The second thing is important is what he brought it up on Starbucks. And I think this is an incredibly important point because we're going to hear a lot of news stories around the world about how a company A is replacing an old software. To be honest, that's been going on for years. This is nothing new. When you have an old software, people will replace it with something new. But his comment that it's possible that Starbucks will hit their total cost of spend with IBM may actually go up because of some of the newer products that they have, I think is more critical for the software landscape.
So for IBM, is it, given what we heard from their earnings release plus with their pre-release, is it reasonable to kind of reset the longer-term top-line growth rate for this company lower?
Well, the lower part is, I think, a tough one because, frankly speaking, before we got into any of this stuff, the Iran war and everything, IBM's growth rate on the top all in was somewhere in the range of 5 to 7%. Now, this year, let's say they're going to be between 4 to 5. Next year coming back, they should again be in that 5 to 7% bracket because they have three different businesses: the software business that grows in high single digit, an infrastructure business over a 3-year period that's about 1 to 2% growth, and then the consulting business, which we don't know when it's going to rebound. So we don't see a massive acceleration in IBM anytime soon unless they get the consulting stuff back on. It's going to be very hard to get to above that 6-7% range for IBM on the top end.
So is that consulting weakness that you cited for IBM, is that an industry-wide issue? I am taking out of my consulting budget and putting it into my AI budget?
Absolutely. And you can see Accenture, which is the market leader, they have had this struggle for almost a little over 2 years. Infosys reported today they had the same issue, and that's plaguing the entire consulting landscape. And not only that, it's also bringing in pricing pressure on contract renewals. So what that does is, for the same kind of work, now you're getting paid the year after. So there's a lot of challenging work over there, and that can only be replaced once you get into a much better macro environment that the spending is good on the non-AI side of it. And once that happens, you can expect consulting growth rates to be above 10%.
So let's just, while we've got you, Microsoft here, we're going to report, I believe, next week here. What's the street looking for with Microsoft?
I think the biggest thing I would want to look for is what's their comments about CapEx, because to be very blunt, they don't have their own chips and they are going out and buying all the NVIDIA chips in the world. Now, I get that the backlog is strong, but honestly, on a token economics view, I mean, I do not know how they can justify keep on spending more right now, as now I understand why Google is doing it because they have their own TPUs. I can understand why Amazon is a little more bullish because their own chip has been under, you could say, acceptance from the clients, but that's not the case for Microsoft. So I'm really curious to see what the CEO, how he frames the CapEx spending for this year and next year.
So do we want them spending more? Do we want Microsoft spending more?
There's a very little likelihood that they will reverse that, but I actually don't want them to spend more. I want them to spend more on expanding the software bucket, which is much more high margin. But, I think I'm in the minority that thinks that, down the road, they will spend a lot less money. Because one of the things you have to remember is they have to spend half their CapEx to go out and buy NVIDIA chips. And I think that's a very, very big number in this market when people are turning more and more to, their custom ASICs chip. For both training and inferencing.
What's the latest thinking on Apple here before we let you go?
Well, the Apple part is going to be an extremely strong quarter because they have not raised the prices on the iPhone 17 base case, which is helping them gain market share in China because their competitors have. So I really want to know when will they raise the pricing on iPhone, because if they can find a way to capture margin somewhere else, maybe their services business, then they actually can continue to gain market share into next year as well. I think it's a small likelihood that the rates don't go up by the iPhone 18 family of products, but I think that's the single biggest thing we are looking for when it relates to Apple.
And Apple reports a week from today. Anurag Rana, thank you so much. Appreciate it. Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence, coming to us from Chicago via Zoom. Let's get a reset here of these markets. We'll do a Bloomberg Business Flash with Mr. John Tucker.
All right, again, the major averages, they are selling off. We have yields higher as Brent crude, well, crude is rising today. Tesla and Alphabet, the big laggards in the S&P 500. But you know what? You look under the hood, we're seeing a little more balanced picture between losers and gainers in the S&P 500. After their earnings, United Rentals will do them. Best performing stock in the index right now. United Rentals up close to 12.5% right now. And then Lockheed Martin and RTX, after they open their books to investors, they're also some of the leaders in the S&P 500. Jim Caron at Morgan Stanley says any sell-off in the mega cap tech space, that's just a readjustment in price.
Honestly, I mean, you know, look, there's been a lot of expectations. For many of these companies, the earnings have been decent. It's just that they're not beating expectations in the way that maybe, you know, people want them to.
The S&P 500, 107 points lower. That's down 1.4%, 73.91 on the index. The Dow down 555 points. That's down 1%. The NASDAQ Composite Index, 650 points lower. That is down 2.5%. And Brent crude, again, up close to 7%, $100.40 a barrel right now. And in the yield space, this comes, of course, ahead of the Fed meeting next week with Mr. Warsh. 2-year yields up 5 basis points, 4.35%. The 10-year yield up 4 basis points. That is at 4.69%. You also had this earlier headline from President Trump. This is from Axios, actually. Trump says he's close to a decision on massive Iran attack. And of course, this war has now become something of a two-front war with the rebels from Houthi. Yeah, exactly. So something to keep an eye out for. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Looking at the healthcare space here, Eli Lilly, its next generation weight loss shot has cleared another hurdle. That is just a massive market that continues to show tremendous growth. Madison Muller joins us here. She's a healthcare reporter for Bloomberg News. What's going on Eli Lilly, Madison?
We had an important update from Lilly today about when it plans to file for regulatory approval for its next generation weight loss shot, retatrutide, which is going to be a pretty big product for Lilly if it ends up being approved. Already, there are a lot of people seeking out black market versions of this drug just because they've heard about all of the potentially incredible effects, everything from 30% up to 30% weight loss to liver impacts and all of these other potential health benefits like anti-inflammation and all of these things. So Lilly said that they are going to apply for FDA approval sometime in the first quarter of 2027, which is a little bit later than some analysts had expected, but that's just because the data package and the filing that they have to put together is so big.
So how will this be materially different or better than what's on the market right now? Because people are getting really substantial weight loss, and it seems to be working already. What's this new one going to do?
Yeah, that's exactly right. I mean, Zepbound, which is Lilly's other weight loss shot, and Wegovy, which is a Novo Nordisk product, are really good. And like you said, people are getting a lot of success with those now. Retatrutide, which that's the sort of generic chemical name. It doesn't have a brand name yet because it's not approved. Combines 3 different gut hormones. So it's GLP-1, which we've all heard so much about, plus another one called glucagon and another called GIP. Basically, it just supercharges the drug a little bit. It targets some different receptors and is maybe better for things like removing fat from the liver and other health impacts. And there are a certain percentage of people that don't see success on the currently available GLP-1. So for people that need that higher degree of weight loss, this is something that could be a really good product for them.
Can you explain to me I see the ads all over the place, Serena Williams. How are these? Are they generics? Are they compounds? How are they different from the stuff you have to get a prescription for?
Yeah, well, at one point, a lot of those ads that you were seeing from companies like Roe and Hims and Hers, those were for compounded products. So those are products that are made by compounding pharmacies, and they're not exactly the same as the drugs that the pharmaceutical companies sell. They're not approved or reviewed by the FDA in sort of the same way. But a lot of the telehealth companies have recently moved into selling the brand name medications. They were really pushing the compounded versions when there were supply shortages. Now those supply shortages have ended. They've moved to selling the brand name medications. However, there are still a lot of compounding pharmacies and a lot of smaller telehealth companies that have continued to sell these cheaper compounded ones, even though the FDA has said that that's not allowed anymore.
Interesting. Where are we with the oral dosage? That's in the market now, right?
Yeah, it is, which was a big development this year. Wegovy, there's a Wegovy pill. There's also another pill from Lilly called Foundeo. Both of those are selling really, really well. People are, especially the Wegovy pill has been a huge product for Novo, which is something they really needed. Novo has fallen behind Lilly sort of in the weight loss drug race, even though they were the ones that really created this modern weight loss market with their products Ozempic and Wegovy. Lilly leapfrogged them with some more effective options and also just understanding how to sell products directly to patients and build these sort of telehealth or online infrastructures that were really appealing to patients. So they saw that opportunity and moved into it quickly, helped them sort of surpass Novo. But now Novo's come back with this oral version of Wegovy that's extremely popular. And so that's been helping them as of late. But it sort of remains to be seen in the long run how the pills will end up stacking up to the orals, because we are seeing, to the shots, because we are still seeing a lot of demand for the shots.
So it's almost, who doesn't take a weight loss drug that could, in fact, benefit from a weight loss drug? What are the hurdles still? Is it still cost or availability?
It still is cost in the sense that insurance companies are still not widely covering these, which is pretty different than other chronic conditions. So the insurance landscape is still pretty tough for people, and that can be a barrier if they, the price when you're paying out of pocket is still a couple $100s a month. So that's still unaffordable for a lot of Americans, especially right now. And we've not seen sort of the same insurance pickup that we would see with other chronic health conditions and that we would sort of expect in this market. So that's been a barrier to entry. And the one positive thing with that is that Medicare recently started covering these drugs for people 65 and older with certain health conditions. So that's sort of expected to open access to potentially millions more people. But it's still like, the number or the percent of people that actually take these drugs that could benefit from them is still pretty low.
Yeah, because you see somebody out on the street that you would think could benefit, and you wonder why haven't they?
Yeah.
And I guess it's cost primarily right now is the issue. Do the compounded, are they materially cheaper, the compounds?
At this point, not really. I mean, at one point, yes, because people were paying out of pocket for the list price of the drugs, which was over $1,000 a month. The drug makers have substantially reduced the cash pay costs, so now it's like $200 a month and up, sort of depending on the dose that you're on, which is much, much cheaper. And that's sort of around the same price as these compounded medications, because usually for compounded medications, you're getting them from a telehealth company. So you're paying a subscription fee plus the cost of the drug, ends up being sort of the same.
Gotcha. Madison, thank you so much. Appreciate that. Madison Muller, healthcare reporter for Bloomberg News. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories, global business headlines are coming up in just a moment in a market that is selling off. S&P 500, we are down, let's call it 97 points. That's 1.3%. The NASDAQ's off 500, let's call it 600 points, 2.33%. 10-year Treasury yields, they are higher by about 4 basis points, 4.69%. And oil up between 5 and 6% across the board. This is Bloomberg. Good morning.
From ABC News, I'm Michelle Franzen. The U.S. has carried out nearly 2 weeks of airstrikes against Iran, and the Trump administration vowing to keep up the pressure to get Iran back to the negotiating table. Iran, though, not backing down, with maritime traffic stalled or blocked in the Strait of Hormuz, and Iran-backed Houthis in Yemen targeting ships in the Red Sea. Here's ABC's Martha Radis.
Iranian-backed militants in Yemen taking aim at 2 Saudi oil tankers in the Red Sea in an attempt to block international shipping, choking another key waterway that could have ripple effects for the world economy.
President Trump is clarifying the nuclear deal signed with Saudi Arabia, saying it's contingent on Saudi Arabia joining the Abraham Accords.
But the Saudis have long said joining the Abraham Accords is contingent on a path to a Palestinian state, and there is no response so far from the Saudis confirming the president's social media post. Less than 24 hours ago, the Energy Department announced Secretary Chris Wright and the Saudi Minister of Energy had signed this landmark nuclear agreement, and it was being transmitted to Congress for review. Karen Travers, ABC News, the White House.
After Bertha made landfall as a tropical storm yesterday east of New Orleans, the storm still trolling the coast and triggering flooding along Gulf states. ABC's Victor Okendo has more from New Orleans.
The entire Gulf Coast saw some impacts, that coastal flooding in Florida, Alabama, Mississippi. Louisiana's governor calling it a best-case scenario for the state, but still urging residents to stay prepared as we have a long hurricane season ahead.
In Madison, Wisconsin, protests breaking out following a deadly encounter between police and a black man following reports that the man was trying to open car doors in the street. Police say the suspect was armed with a knife and allegedly injured an officer. Here's ABC's Pierre Thomas.
Video circulating online. Officers appear to be wrestling with the man on the ground before 3 shots are fired. The man, who has not yet been identified, later died at the hospital.
You're listening to ABC News. A former modeling scout who was introducing young women to Jeffrey Epstein has been found dead in his home in Paris. Daniel Siad was named more than 2,000 times in the Epstein files that were released by the Justice Department. ABC's James Hill has been covering the Epstein case for years.
His association with Epstein seemed to have begun after Epstein got out of jail in Florida the first time, back in 2009, 2010. After he had served time for recruiting a minor into prostitution.
Siad was reportedly under investigation in France for alleged trafficking and other sex crimes. A cause of death has not yet been determined. We're getting a new look at the safety of those self-driving robo-taxis from Waymo.
A new study from the Insurance Institute for Highway Safety finds Waymos are involved in nearly 70% fewer crashes compared to human drivers. Researchers noted that Waymos are especially adept at avoiding rear-end crashes, reporting the cars did so at a 91% lower rate than human drivers. The IIHS examined the Google-owned company's operations in San Francisco, Phoenix, Los Angeles, and Austin. Waymo says so far it's served more than 20 million autonomous rides. Mike Dubusky, ABC News.
No winner last night, which means the Mega Millions jackpot keeps getting bigger. Tomorrow night's jackpot will be at least $743 million, the game's 10th largest grand prize. Michelle Franzen, ABC News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Speaker Johnson pulls another rabbit out of his hat. But now the real magic will be required. Welcome to the Thursday edition of Balance of Power as the House passes 3 big bills, a defense policy package, government funding, and a stock trading ban, and they're all heading to the Senate now, where the grind is just starting. We'll get the latest from Bloomberg's Eric Wasson. He's live on Capitol Hill, where they also just passed a War Powers Act. It's being called a defining moment for AI, the hacking of Hugging Face by OpenAI. We're going to explore what really happened there, what it means for AI security when we talk with Miriam Vogel, the CEO of Equal AI, out with new research on the challenges facing companies employing agentic AI. And only in Arizona, think about this, an election denier is nominated to run for governor the same day an emergency physician beats an establishment Democrat to run for Congress. We're going to talk midterms with new polling with our political panel, and it's all after a look at Wall Street. We're having a little trouble today, so we seek the help of Charlie Pellet. He's at World Headquarters in New York. Charlie, what do you have?
Hi, thank you very much, Joe Matthew. Indeed, stocks lower, oil higher, but just want to begin with a development involving trade. U.S. Trade Representative will be making an announcement about tariffs later today. That, according to the White House press secretary, we'll have any developments for you right here on Balance of Power. Stocks lower, as I mentioned, with the S&P right now down 1.3%, 7401 where we stand, 97 points lower on the S&P. The Dow down 527 now, a decline there of 1%. NASDAQ particularly hard hit, down 2.3%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, lower by 1%. The VIX right now holding below 20, very close to 20. We've got the 10-year 4.69% with the 2-year currently yielding 4.35%. The 30-year now up to 5.17%. Gold is down $81 the ounce to $4,048, drop there of 2%. Crude, major story today, West Texas Intermediate, $92.30 a barrel on WTI, up by 6.3%. This on Middle Eastern tensions. Barrel of Brent above $100, $100.50 now. A barrel of Brent crude up by almost 7%. Russ Kostrich is portfolio manager at BlackRock, and on surveillance this morning, he told us, yes, the economy can handle $100 oil.
You know, the reality is the economy is much less geared to oil than it was at the time of the first Gulf War 36 years ago. It's a smaller percentage of wallet share. We're now the largest oil producer. It's beneficial to the terms of trade. So in terms of the magnitude of the rise you need to see to create a real oil shock that would bring the economy down, I think it's a lot higher than $100 a barrel.
BlackRock's Russ Kostrich, and again, to put Brent in perspective, $100.61 right now. Alphabet lower after earnings. The Google parent raising its capital spending forecast to as much as $205 billion this year. Alphabet shares, they're plunging by 6.6%. Also out with earnings last night, Tesla. Right now, the stock is down 13.1%. We'll hear from Intel after the close today, down by 1.4%. Programming note, coming up, 5 o'clock Wall Street time. For the first time in 10 years, the United Nations is set for a leadership change. Join us at 5 p.m. New York time for a special town hall with candidates seeking to become the next UN Secretary General. Again, we'll have that for you live right here on Bloomberg. I'm Charlie Pellet. That's Joe Matthew. Lots going on. It's a Bloomberg Business Flash.
All right, buddy. Thank you so much. The great Charlie Pellet live in New York. He'll be back in about 15 minutes with more on the markets here as Charlie follows the beat on Wall Street every day for us. And yeah, big stuff coming up, 5 o'clock. If you're in the car, you'll be safe. Keep us either here on Bloomberg Radio or your satellite radio, channel 121. If you're home, dial it up on YouTube. You won't see anything like this town hall coming live from the UN at 5 p.m. Eastern. And I just want you to picture me and Kaylee with our popcorn watching TV at 5. It's not very often we get to do that. So welcome to the Thursday edition. Somehow we made it to Little Friday, and I'm glad you're with us here. With a lot of news to talk about, we're going to get to Capitol Hill in just a moment with Eric Wasson, but we do have news, important news on Iran, and that's why the markets are feeling a little tipsy here. How about it? $100 a barrel oil. Was Bob McNally right? He joined us last evening from Rapidan, suggesting we may well test the highs that we saw earlier in the conflict. $100 right now for Brent, up 6.5%. WTI is at 92. Would have seemed expensive yesterday, up more than 6%. And yeah, stocks are getting clobbered here today, with a few exceptions. It's interesting what we're buying on days like this, as we seek havens, not just energy, and we're seeing even the integrated oils get back up there. But healthcare seems to pop always on days like these, right? Lilly, J&J, Equivia, McKesson, all moving higher here. Micron is trying. Boy, this has become a pretty interesting story. It's bouncing off the mat today after some tough selling recently, up $31 or 3%. We're nibbling on a couple of things, but someone woke up today with plans to sell Nike. I just find that funny. You're selling Nike now? I'm wondering what this road has been like for you. Defense is popping higher, too, because the Pentagon is asking for a lot more money, and they're going to spend it on a lot of missiles. So you're seeing big bumps today at RTX and Lockheed, which brings us to the war in Iran. The president of the United States now, of course, threatening the Houthis that decided to go for it. We've opened a second front in the Red Sea. Shot at 2 boats, that's how you get $100 a barrel oil. And if you're the president of the United States, you take to Truth Social. He's out there saying a year ago, the U.S. attacked very powerfully the Houthis for their interference with commerce and trade by shooting at ships. Since that time, he says they've acted very responsibly. Unfortunately, now they're starting up again. The point of this, he says, please let this truth serve to represent if they do this again, the U.S. will hold Iran responsible in that the Houthis are a surrogate and or proxy of Iran. He promises major military punishment inflicted upon Iran. And, of course, the Houthis, with now a headline on the terminal from Axios. Trump says he's close to decision on massive Iran attack. So no wonder bonds are selling off. Interest rates are surging along with oil. Stocks are not in a good place, at least for the most part. We're going to have more on what's happening with Iran as we make our way through the program, but something pretty important just happened on Capitol Hill, and we're going to get into this with Eric Wasson. I wasn't sure we'd be talking war powers, but we are. The House, indeed, calling on the president to stop the war now for a second time. The jailbreak on the Republican side was exactly the same as last time, so not really a jailbreak. There were 4 R's who did this: Thomas Massie, Warren Davidson, Brian Fitzpatrick, Tom Barrett. And I'm sure they'll be hearing about it on Truth Social. The resolution passed 214 to 208, similar to what we saw in June. There's a separate one up there from Seth Moulton and Jason Crow that I believe has, over a dozen co-sponsors? Let's start off with Eric, because they passed a lot of stuff here in the last 24 hours. He is our great congressional correspondent, appropriately in seersucker. It's great to see you, Eric. War powers, not a surprise, I guess. You tell me, because I keep reading this has no teeth. Will it make any difference?
It doesn't have teeth, and more importantly, the president doesn't view it as an important message. You know, in the past, war powers votes that have been successful have sort of been a signal to the president, hey, you need to change course here. In fact, he's ramping up attacks on Iran and saying really he doesn't really care about the midterm impact. You know, there's a pair of votes here. We saw a $95 billion Iran war budget move forward yesterday, and we see this War Powers Act with almost all Republicans supporting the president. This is Republicans heading into their August campaign season, really saying that they're behind the president on the Iran war. And Democrats, I just came from a press conference with Hakeem Jeffries, the Democratic leader, and they're making this the centerpiece of their campaign. They're saying, you guys are all on board with this war. It's a disaster. There's no end game. I did ask Hakeem Jeffries how you would end it. He doesn't have an easy answer either. He's just saying that you've got to reconstruct massive diplomacy now that Trump has gotten us into this basically a quagmire.
Boy. Well, let's talk about what was passed. To your point, a couple of important votes here, and they're going to the Senate. The problem is John Thune has a different sequence in mind, right? He says they're not going to deal with reconciliation until the government is funded through this continuing resolution that would keep the lights on past the election. That means the Pentagon's going to have to wait a pretty long time, Eric. And I'll tell you what, I saw our interview. They were playing clips of our interview with Rand Paul on CNN last night as sort of the face of opposition on the Republican side of spending money without offsets. Where's this going to go next door?
That's right. You know, I said on Twitter that John Thune is putting this reconciliation budget in the same storage area where the Ark and the Raiders of the Lost Ark went. It's going away for a long time. We might see it in the lame duck session, in fact. This is the session after the election in December. Look, senators don't really want to vote on the Iran war budget. They certainly are very, very divided among Republicans between those who want to spend even more. Roger Wicker wants $350 billion for the military, you know, in this plan. And then you've got people like Ron Johnson, who's the newly anointed budget committee chairman, saying they want offsets. But those offsets will be unpopular. Look, even if you are just going after verifiable fraud in entitlements programs, those can easily be politicized by Democrats as cutting entitlements. So this is a real problem for Thune. He said you can't even get 50 for a budget. So he's putting that aside, looking at the more urgent deadline, which is September 30th for a shutdown, and trying to avoid that, which I think neither side really wants to see. I saw the president out there saying a shutdown is likely. I would tend to disagree and think that Democrats don't really see an advantage in doing that right now, but maybe they'll prove me wrong.
Yeah, I'm going with what Eric Wasson says on that one. The NDAA, this is the Annual Defense Authorization Bill. At one point, it looked like it might be DOA, but it got through the House. What happens next door is a question. This bill includes a number of items like renaming the Department of Defense to Department of War, blocking coverage for gender-affirming care, which is strange because we're doing the high T thing, and I don't know how that plays into it, and making it easier for troops to carry personal firearms on military bases. Are these deal breakers in the Senate?
They might not be deal breakers. Maybe there's something that fuels the compromise. The real problem, though, is the Iran war in the general sense that passing this would be a stamp of approval for Senate Democrats on the Iran war.
Yeah.
So they've blocked attempts to basically end a filibuster on the defense bill. I think it gets done eventually. There's a long tradition of doing this bill, again, after the election, after people have a sense of where this is all flowing. But, the NDA is, one piece, but if they're going to do an additional $350 billion in defense, there's just people, maybe on both sides, that are like Rand Paul saying, come on, this is a 50% increase in the defense budget. Doesn't make a lot of sense. So, this is not going to be resolved anytime soon.
Just quickly, we've got about a minute left. Eric Wasson, is Clarity dead, or is it also going to the warehouse in Raiders of the Lost Ark?
I think it's in deep trouble. There's an ethics provision in here that basically would prevent the president and others from issuing new cryptocurrency, but it basically green lights the existing cryptocurrency that the Trump company has been involved in. That's a real non-starter for Democrats. They think it's ridden with loopholes on the ethics side. So they came out and panicked. We were looking at people like Raphael Warnock and others who were potential swing votes, and when they said that they're not on board, that makes me think this is also going on ice. I believe there'll be a vote, certainly a big push from the crypto lobby to have a vote and let people know where they stand next week, but I don't see it passing.
Great reporting, Eric. You've had a heck of a week. Eric Wasson, Bloomberg News congressional correspondent. There's a lot of bills there in old Hangar 51. We'll see if Clarity finds some company. I'm Joe Matthew in Washington. We turn to AI and the hacking of Hugging Face. Miriam Vogel joins us next, only here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got oil holding above $100 a barrel. Brent crude, $100.17 now. It is surging 6.5%. West Texas Intermediate crude right around 92 a barrel, up now by 5.9%. That surge in oil spurred by the escalating Iran war, sending stocks and bonds lower. S&P right now down 84, drop there of 1.1%. We've got the Dow down 436, drop there of 0.8%. NASDAQ and the NASDAQ 100 index also lower. They're being rattled by earnings last night out of Alphabet and Tesla. We'll hear from Intel after the bell today. Right now, NASDAQ is down 2.1%. The NASDAQ 100 index down 1.7%. The Bloomberg Mag 7 index down 4.5%. With the SOX, the Philadelphia Stock Exchange Semiconductor Index down 0.7%. And the VIX, Wall Street's so-called fear gauge, holding just above 19. The 10-year, 4.69% right now, with a 2-year, 4.35%, and the 30-year, 5.17%. Spot gold, $4,050 the ounce, down 1.9%. And again, worth repeating on crude, WTI up 5.9%, $91.94 a barrel. Brent, $100.20 now, up 6.5%. We're seeing oil majors rally today. ExxonMobil up 2%. Chevron up 1.7%. ConocoPhillips up 2.4%. Higher energy hurting airlines in the latest reports. We do have shares of United moving lower, down by 3%. This after earnings from American Airlines Group. American down 7.7%. Delta down 2.8%. Also reporting Southwest Airlines. Southwest down by 4.7%. Recapping, stocks lower. S&P down 1.1%. Crude oil surging. A barrel of WTI now up by 5.9%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, thank you so much. He'll be back coming up in about 20 minutes' time. The voice of Wall Street and the New York subway with us every day here. How lucky are we on Balance of Power with the great Charlie Pellet? Even when the news is bad, we kind of want to hear it from Charlie, don't we? Boy, Alphabet really changed everyone's mood, huh? I thought this was going to be the report that brought us back to optimism when it comes to AI, but the hyperscalers are falling hard. There is an interesting reciprocal, though, as AI infrastructure names seem to be doing well, right? Because Apple's spending too much. That money's got to go somewhere. We'll be tracking the markets throughout the day here as we keep our eyes on something really important that happened this week. And there is a political side to all of this that we're going to get to. But I'm hearing words like watershed moment, inflection point, unprecedented. The hacking I'm talking about of Hugging Face. You've seen the story by now, and we talked about it here on the program. This is ChatGPT 5.6, which you may or may not be using. I'm guessing not. This is the new fancy one until the next one comes out. Its models were asked, this is a test that went wrong. They broke out of the sandbox, as you keep hearing. What does any of this mean? They were testing this model to solve a hacking challenge during pre-deployment at Hugging Face. The models decided on their own to break out of the so-called sandbox, this walled environment they're being tested in, try to figure it out on their own. They figured Hugging Face might have the answers. They used stolen credentials to break into this thing without anybody telling it to. So that freaked out a lot of people. This is the kind of stuff that the CEO of Anthropic likes to talk about, right? Dario Amodei. And in fact, the head of Anthropic's Frontier Red team, which sounds scary, Logan Graham, said he told his team to, quote, remember this moment as the first true AI safety incident. Little less extreme. The boss at Hugging Face, the CEO, called it an attack unlike anything we've seen before. So what's going on here? The White House is supposed to be testing these models before they're out in the general public, right? We've talked a lot about the posture that the administration has taken here. And there's a new AI protection bill that Ted Lieu's got up on the Capitol right now. They just can't seem to get anything off the launch pad when it comes to regulations here in Washington. Should this be scary? Should this be exciting? Or is it just another stop on the road to the next DeepSeek moment? I don't even know if I have the right questions, but I know someone who has the answers, and I'm really excited to say that Miriam Vogel is back with us. I told you she was coming in today. An important voice in all of this, and I think we can characterize her as an optimist, but also helps to reset our clock when the narrative gets to be a little bit too dark around an emerging revolutionary technology. She's the president and CEO of Equal AI and first joined us to talk about her book, Governing the Machine, How to Navigate the Risks of AI and Unlock Its True Potential. They're also out with a new white paper that we're going to talk about on the challenges that companies are facing in adopting AI. It's great to have you back with us in studio. Welcome back to Bloomberg.
Thanks so much for having me.
I don't know if I even described this properly because even I don't claim to understand what happened here. The fact is, though, you've got models who are acting on their own without prompts, apparently, and breaking out of the sandbox. Is this, in fact, a watershed moment?
This is a wake-up call. I would say two takeaways we all should think about here. First of all, we should not be surprised. We've been told for years that an algorithm will do exactly what it's told to do. There's a pleaser issue. It will not question or judge. It doesn't have judgment. It doesn't have context.
Yeah.
It will achieve the end goals that it is mandated to do.
A pleaser issue because it's been told to satisfy whoever's in charge of this model.
At all costs.
Okay.
And so what we need to do, the second point, is urgently act to put in guardrails. What are guardrails? What is governance? It's adding the judgment, the context, the end goal of human safety as one of the priorities that needs to be taken into account when it achieves this end goal, whatever that end goal is in any algorithm ever.
Wow. All right. So does a wake-up call present something we should be scared of or an opportunity to fix a vulnerability before it's unleashed on the
That's a great question, Joe. This is an opportunity. As you mentioned, we have this white paper just released. It's based on a summit we had very recently with leading deployers of what's called agentic AI. And that's what moment we're in now. This is not a future sci-fi scenario. Right now, 50% of leading companies are using agentic AI. And what does that mean? They are AI systems that operate to achieve a task. So as opposed to just summarizing an email or a report.
This has a specific job.
It will operate across a system. It will achieve an end goal of planning a trip, of operationalizing and increasing efficiency in a workflow. It will take multiple steps with limited to no human involvement. And so that means we have to be especially careful. And what we found at our summit is there's an urgency to make sure there's clarity on what is governance that we expect of all AI systems. Particularly now, as we're going into agentic AI and we're increasingly removing humans from the equation, we need to understand exactly what we're asking these AI systems to do and make sure it has the context to understand to prioritize human and society in each of these end goals.
This is lofty stuff. When you say governance, is this a self-policing situation right now, or are you suggesting the government needs to create regulations?
I think governance needs to be a multifaceted approach. It needs to be something, I think of it as an umbrella or a wheel where there are multiple spokes, there's multiple pieces of it. Government has a role for sure, but a lot of what happens when we're talking about AI system has to happen inside the organization. You can't regulate your way out of this. Now, government and other organizations can be helpful in clarifying the end goals, because right now, I have the privilege of working with organizations that are all prioritizing AI governance. They want to make sure that their outputs are safe and benefit society, but they are figuring out on their own in silos what those best practices are, and that's not where we want to be. We have this summit to align on the best practices so they can learn from one another, but we want to make sure everybody understands what these best practices are.
So these 100 companies you put in a room to create this white paper are already using AI, want to be using AI, or a combination?
They're all deep in agentic
They're
AI.
deep. All right. Okay. So they have embraced this as something that will make them more productive, more efficient. How many people were afraid of what could happen versus excited for what could happen?
It's a great question. I would say people are doing this work because they are hopeful at what the outcomes will be, but they are all very intentional in needing to put in the safeguards urgently, immediately, that they put in on their own systems across society. So a lot of our work was, what does a company need to have in place today to make sure they are clear on what their outputs are, to make sure they're not creating harm and risks. But there's also a societal piece. We need to make sure that there's alignment. And the place that we see that the most is in this distrust that the general public in the US feels towards AI. It is because we don't have governance in place across the society. We don't have expectations of what should AI be doing, what should it not be doing, and how do I use it safely.
Things have been getting pretty dark recently. Data center moratorium in New York. People are talking about their bills going up. Republicans, in some cases, the populist movement on both sides of the aisle are kind of lining up against this. It's even getting a thumbs down right now on Wall Street. How did we get to this point? Is this sort of an equal opposite reaction to the euphoria we were feeling around NVIDIA's visit, Jensen Huang's speech here in Washington a year ago?
Again, I think this is to be expected.
Yeah.
If you told people in the early 1800s to get in an elevator without ensuring that they would be safe when they got to the top floor, they would not put themselves in it. They wouldn't sit in an airplane. They wouldn't entrust their children in a car if they did not know there were safety protocols, that the brakes would be working, that there's an odometer, so you know how fast you're going, and so that you can speed up. Without these governance structures in place, people don't have reason to trust systems. So the more we can be talking about what smart companies are doing to build this trust, deserve this trust, the better off we all are.
I learned about the Tahiti problem from your study here. Participants offered the illustration of hundreds of agents simultaneously calling a small resort in Tahiti to make reservations, which could flood the resort's human-paced systems to the point of failure. Does everyone have the Tahiti problem in this collection of companies you talked to? And is this the reason why they adopted AI to begin with?
It's such a good question. What is the end goal? How does this play out when we have the machines versus the human systems we have in place? We came across many challenges we're going to confront. One, as you said, the Tahiti problem. A huge problem is data. You know, if agentic systems are operating, what are they operating on? The data that they're training and operating off of. So we need to make sure that there's context, that it's not the slop that is out there, that we have privacy protections in place. We talked about really interesting questions like consent. You know, when you're authorizing this agent to take actions on your behalf, how do we maintain what that consent you gave as the use changes, as the context change? It's going to be operating often with other agents across a system of operations. So you want to make sure that it's clear on what you've given authority for it to do. So visibility into how you're using AI is an absolute must in governance. Authority, accountability. Who is accountable at the end of the day in the C-suite for these operations and across the line to make sure that these tests that we've just seen that have gone off the guardrails are certain that there's authority, there's accountability in place.
Someday I want to do an hour with you. In our 30 seconds remaining here, remember you talked about the J-space last time you came on. Are we at the point now where we actually do not fully understand the technology we made?
There are many questions, to be sure. And the developers themselves will tell you there are open questions. What we do know is that the best practices in AI governance, the 5 best practices that we talked about 7 years ago, remain the best practices today.
You can't hear the music's playing. I'm going to get the hook. I'm so glad you came by. I told you would get something out of this. Miriam Vogel, Equal AI. Thank you as always. This is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got oil higher, stocks trading lower. We're off session lows, but still looking at a 1% drop on the S&P 500 index. Yes, a bounce off the bottom, but right now down 76 points. The S&P at 74.19. Dow Industrials down 445 on the Dow. A decline right now of 0.8%. Tech hit hard today with the NASDAQ 100 index down 1.5%. The NASDAQ Composite Index down almost 2%. The Bloomberg Mag 7 Index is down 4.6%. Alphabet shares down 6.5%. Tesla after earnings as well, down by 13.5%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, just turning higher, back in the green, up under 0.1%. 10-year at 4.69%, with the 2-year 4.34%. The 30-year 5.16%. Gold down almost 2% to $4,050. A major move in crude oil. West Texas Intermediate, $92.45 a barrel, up 6.5% right now. Barrel of Brent back above $100, up now by 7%. Energy traders do remain focused on the Strait of Hormuz, but with the Yemen-based Houthis claiming attacks on 2 Saudi oil tankers, attention is now shifting to the Red Sea. Jonathan Lieber is head of research at Eurasia Group. He was interviewed this morning on surveillance.
Over time, we think that obviously you're going to see a lot of displacement of energy shipping and other shipping out of the Strait of Hormuz. That's going to evolve over the next 5 years or so. And the Red Sea is going to become an increasingly important choke point in the global oil trade. And this week, what we're seeing is what that means is that choke point is not a safe choke point. It's one that the Houthis or other geopolitical risks could potentially affect as well.
Jonathan Lieber of Eurasia Group interviewed this morning on surveillance. Bottom line, crude holding above $100 a barrel. Brent up now by 6.9%. While a lot of tech names are lower, defense names higher after earnings. Lockheed Martin and RTX raising their full-year sales forecast as geopolitical tensions around the world boosted defense spending. Lockheed Martin now surging by 11%. They're based in Bethesda. And shares of RTX out of Arlington, Virginia right now, we do have RTX up by 7.6%. For the first time in 10 years, the United Nations is set for a leadership change. Join us at 5 p.m. Eastern for a special town hall with the candidates seeking to become the next UN Secretary General. They'll be discussing their priorities, and we'll have that for you live right here on Bloomberg. Recapping, stocks lower, tech hit hard, oil higher, S&P down 1.1%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, thank you, my friend. He'll be back 1 o'clock Eastern time, top of the hour, about 20 minutes away, even less than that, as we watch Wall Street throughout the day here in a trade that's clearly being impacted by the war in Iran. Charlie just gave you the numbers here. You can't deny the sentiment as the president hits the gas, threatening the Houthi rebels and Iran with far more intense attacks as we consider a new front here in the Red Sea. We've got 2 choke points now to worry about. Welcome back to $100 a barrel oil. That is our reality here for Brent. We're in the 90s, 92 for WTI. Interest rates are up because people are dumping bonds, and they're selling a lot of stocks, too. No thanks to Alphabet. Coming off our conversation with Miriam Vogel, the whole AI trade is mixed up today. It's not feeling good. With the president threatening to step up strikes on Iran, saying he will hold the country responsible for any further attacks by the Houthis, or the Houthis, depending on who you ask. Now, I'm going to add a couple of more numbers here. You heard $100 a barrel oil, mighty $2 a barrel WTI. How about $4.09 for a national average when you're buying a gallon of gas? In Arizona, it's $4.30. We're going to be talking about primary results in Arizona, which are also a little confusing, certainly the state's self-contradicting. But there's some new polling data that before we assemble our political panel, I want you to hear about. This is the baseline before the news of the past 24 hours. Okay, let's start with Emerson. They've got a great polling outfit there, as you've heard, with an 11-point generic ballot advantage for Democrats. This is maybe an outlier, but I'm giving you the facts as we know them. This survey of likely 2026 voters, okay, this isn't registered, this is likely, give Democrats an 11-point advantage over the Republicans on the generic ballot. We've got Fox reporting as well on its research. 53% of voters, if the election were held today, would back the Democratic candidate in their House district. 53. And 46% Republican, a 7-point edge just outside the poll's margin of error. Now, we will get into the results here. They just called one of the races we were waiting for in Arizona. But I want to get to these numbers first with our political panel. Bloomberg Politics contributor Jeannie Sheehan Zaino is with us, our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. And great to have John Seaton back, Republican strategist, founder and CEO of Echo Canyon Consulting, which, John, always makes me feel like I'm about to crack open a bottle of wine. It's great to see both of you. John, how are you feeling about these numbers here? You know, we hear typically that history is stacked against the party that's running the House, Senate, and the White House. But a 53% generic ballot advantage for Democrats, an 11-point spread. Do you buy those numbers?
Yeah, I think that maybe a bit of an outlier, as you mentioned, and it's always a challenge in the midterm year with the party in power, and in this case, party also in control of the White House and both houses of Congress. It's usually a challenge with the exception of 2002, right after 9/11. I will note, though, that before Democrats start popping champagne corks, they really should look at other numbers within those polls that show the favorability of the Democratic Party is very, very low as well. I just looked at the Real Clear Politics numbers, and I think the Democratic Party is minus 17 in that respect. So voters are clearly unhappy, but they haven't yet fully made the jump to the Democratic Party. The Democrats haven't yet sealed the deal.
I don't think Jeannie Sheehan Zaino even drinks champagne, but she is a pollster. Jeannie, I don't know if you want to pop a cork or something here, but what do you make of these numbers? Does an 11-point edge sound real right now?
I do agree that it is an outlier, I think, at this point. And some of this is going to depend on what happens in Michigan and Wisconsin. I don't think we can deny for the Democrats the issue of which candidates are chosen in these very contentious primaries. So that's a big issue for Democrats. Overall, though, these are good numbers for Democrats. And Joe Matthew, I'm going to quote Brett Hume, there's not much good news in this poll for Republicans, he said about the Fox poll. They are underwater on the economy. They're underwater on affordability. They're even underwater on immigration. Those are the key things the president ran on. And one would think that the president would be out there. He'd be in Georgia. He'd be killing it on the stump, trying to get those numbers up. And instead, what did we hear yesterday? Affordability is a hoax. It's a Democratic construction. The war is not a war. It's a skirmish. It's incredibly popular. So the president is doing nothing to help these poor Republicans. That's why I think they are skedaddling from D.C. as fast as they can to get back home and to try to resurrect, particularly in these purple districts, what's going to be a really, really tough year for this party.
Well, let's get into some races because we've got a few to talk about here. And we shouldn't look any further than Amish Shah at the moment, at least. This is another said to be knock on the Democratic establishment, an emergency physician beating the establishment candidate here and will face Republican Jay Feely, Jeannie, a former NFL kicker. What do you make of this race and what it means for the Democratic establishment in Arizona?
Yeah, I mean, this is what we're seeing over and over again. We're seeing it in New York. We're seeing it in Arizona, Wisconsin, Michigan, other states. It's like a food fight amongst the Democrats. We're seeing some of that on the Republican side. And I think there's a lot of concern amongst Democrats that they are going to walk themselves away from what could be a potentially good year, depending on how these candidates play in the general election. It's a real concern and it's a valid concern. You know, I just go back to Maine, Joe. You look at it and you look at somebody who in Graham Plattner, forgetting all of the other horrific things that he was accused of doing, he was literally running against the Democratic Party. That's what he was doing. And that's what resonated with so many Maine voters. So I think the pressure is really on the Democratic moderates, the party, to make a case for the Democratic Party. They haven't been able to do that yet. And I would just look at Kim in New Jersey talking about Medicare for all kids, Medicaid. This is a really popular, a great idea. We need to be offering those kinds of solutions, not just running against Donald Trump. Otherwise, the DSA candidates will run away with this, and we will have trouble in the general then.
We should note that Marlene Galan Woods, that was the DCCC-backed candidate, lost by 5 points. John Seaton is actually an expert in Arizona politics. He spent a lot of time managing campaigns there, and I'm wondering your thoughts on all of this, John, and also what's with the New York Jets in Arizona? Shaw's going to face Jay Feely, and I read in the AP today they were both Jets. Shaw was also a team doctor. Is this some sort of narrative we should be paying attention to?
I mean, that's the 6 degrees of separation, maybe the 6 degrees of Jay Feely. Yeah, it's very, very interesting.
Fair enough.
Tidbit. But I think the broader point here, and I'm in Arizona right now. It's a dry heat. Arizonans don't like being told what to do, and I think more and more people are very skeptical of advice coming from Washington. And so I think I personally was a little bit surprised that the DCCC tried to put their thumb on the scale for Marlene Woods. I was a little bit surprised by that. I was not terribly surprised that Dr. Shaw came away as the Democratic nominee. Again, Arizonans are extremely independent. My old boss, John McCain, was the original maverick. And Arizonans really don't like being told what to do. And when popularity of Washington, D.C. is really, it feels like an all-time low, you can almost run solely against Washington and do pretty well in some of these races. So it'll be a fascinating general election with two former Jets here in the desert. But yeah, I wasn't terribly surprised by the primary result.
Well, check this out for the general in the race for governor. Jeannie, you saw this one coming, and we talked about it the other day. Andy Biggs won. So you've got an election denier, Freedom Caucus member, running against Katie Hobbs, who used to be Secretary of State. Does it get richer than this?
No, it does not. And not only did Biggs win, not only did Colladone win in the Secretary of State race, but they ran away with it, Joe. I think the AP called these races, within an hour of poll closing. This was not a tough race on either side. And they are both election deniers. And this allows, as John was just talking about, a big question to arise in terms of where do the more moderate and independent voters go? And this is what has Republicans in Arizona concerned, because as we have seen, Donald Trump is something of an outlier. He can win and win handily in a state like Arizona, but they haven't been as successful with other MAGA right candidates. So I think a lot of pressure on Turning Point to turn out the vote. And also, you've got Katie Hobbs there, and she's known, I think now, Joe, as the veto queen. She has vetoed more than 500 pieces of legislation. I didn't make that up either, Joe. And that is what moderates and independents want sometimes. They want this countervailing force to stop this more MAGA right focus on a lot of these election bills, et cetera, coming from the Republican legislature. So she's going to have a leg up there, but it's going to be a tough race. She's incredibly vulnerable. And we see Biggs running as fast as he can to the center, knowing what happened to other folks in the last few years who didn't make that turn.
Well, it didn't work out real well for Kari Lake. John, you know the lay of the land. Could Andy Biggs win this election? And if he does, what does that say about the Republican Party in Arizona right now?
He absolutely could win this election. It's always hard to defeat an incumbent governor, but one thing that Congressman Biggs did very effectively was kind of unify the party early on in the process. He won by a huge margin, as Jeannie points out. That doesn't happen in Republican politics here all that often. Usually we have pretty bruising, ugly primaries. In this particular case, Congressman Biggs was able to start running to a more bipartisan approach in the primary. That very rarely happens. So I do think that he has a chance. I think it's a center-right state. I don't think you'll hear him talk a whole lot about the 2020 election. I think you'll hear him talk about kitchen table issues, about affordability. I think he will take the fight directly to Governor Hobbs. I'd say she's slightly favored right now, but I think it's going to be a fascinating race and extremely close.
It sure is, and I'm guessing pretty expensive as well. We've got a great panel for you today, and they're going to be back in our second hour. John Seaton and Jeannie Shanzano, thank you both. We'll have much more to talk about on the other side as we welcome our global television audience to the conversation. And what a lineup here. It's another parade of senators from the Republican side of the aisle after everything that passed the House last evening. We'll take the temperature of Senator Ted Budd, North Carolina, Senator Todd Young of Indiana on what they plan to do with this legislation. And guess what? The stock trading ban passed the House. We'll talk with the author, Brian Stile of Wisconsin, all next on Bloomberg.
Live from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
President Trump threatens heavier strikes on Iran if the Houthis hit again. Welcome to the Thursday edition. As the president responds to attacks on two ships in the Red Sea by Houthi rebels in Yemen. I'm Joe Matthew alongside Kaylee Lines in Washington. And Kaylee, the market is responding today to the idea of a new front opening in this war.
Yes, responding indeed with oil, Brent crude at least, topping $100 a barrel once again. We're looking at a more than 6 percentage point move on both Brent and WTI today as the president threatens to effectively hold Iran responsible for the action the Houthis, which are an Iranian-funded proxy, may take in the Red Sea. All of it pointing to escalation as the president, according to Axios reporting at least, is nearing a decision on a potentially, quote, massive attack on Iran.
The next 24 to 48 hours could be interesting here as we now include the Red Sea on top of the Strait of Hormuz for another potential choke point to consider. And interesting to see interest rates pop higher on all of this, along with oil prices, and it's really depressing stocks. We do have a great opportunity, though, this hour to talk with some stakeholders here on Capitol Hill. Another parade of senators coming up from the Republican side of the aisle, not only weighing in on the war in Iran, but a boatload of legislation that's now headed their way.
Yeah, including funding for the Pentagon related to costs to the Iran war. There's a lot on these senators' agendas, including speaking with us today. We'll speak with Republican Senators Ted Budd of North Carolina and Todd Young of Indiana. Plus, we'll speak with a member of the House of Representatives as well when Congressman Brian Stile of Wisconsin joins us, too. It's going to be a busy hour, so let's begin it right away as we get a check on the markets with Charlie Pellet. Big move in oil, big moves in a lot of other places, Charlie.
Indeed. Specifically, what's going on with a couple of the tech names that we heard from last night, both Tesla and also Alphabet. Got to begin with crude oil, though. Kaylee touched on it there. Right now, looking at a 7% jump in Brent crude, holding above $100, $183 for a barrel of Brent, up now by 7.2%. The move in West Texas Intermediate crude, equally as big, up 6.5%. 92.49 on WTI. Again, that is a move of 6.5%. We'll keep you posted on crude throughout the day. Right now, though, that is moving stocks lower. The S&P is down 87 for the S&P 500 index, a decline now of 1.2%. Dow Industrial is down 464 points on the Dow, a drop of 0.9%, while NASDAQ is down 526 on the NASDAQ Composite Index, a decline there of 2%. NASDAQ 100 Index down 1.7%. Last night we heard from two of the Bloomberg Mag 7 names. Today we've got that index down by 4.5%. Again, bears repeating. Alphabet down by 6.5%. Tesla, though, is down by 13.8% after earnings. The VIX right now is advancing. We've got the VIX holding above 19, Wall Street so-called fear gauge. The 10-year, 4.69%. Right now, looking at the 10-year, moving higher. We've got the 2-year, 4.35%, and the 30-year, 5.17%. Gold down $77 the ounce for the precious metal, a decline of 1.9%. 4,051. That crude move bears repeating, closing in on 101 for a barrel of Brent now, $100.85, up by 7.2%. I mentioned Alphabet, lower after earnings. The Google parent raising its capital spending forecast to as much as $205 billion this year. Alphabet down 6.6%. Tesla's profit tumbled despite strong EV deliveries in the most recent quarter, pressuring Elon Musk's plan to refocus the company on AI and robots. Tesla shares down now by 13.9%. Also out with earnings last night, we heard from IBM. It cut its full-year sales outlook. IBM shares down 0.2%. Intel will be reporting after the close of trading today. Intel shares down now by just about 1.2%. While we are on earnings, cannot ignore defense companies Lockheed Martin and RTX. They raise their full-year sales outlook as geopolitical tensions around the world boost defense spending. Right now, we got Lockheed Martin shares pushing higher by 9.9%, RTX up 7.9%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, a comprehensive look at the markets from Charlie Pellet. It's a very busy day. Thank you very much. It's a busy day here in Washington as well, and it's been, frankly, a busy week. The House of Representatives were able to finish their work on some of the must-pass items that the Speaker wanted to see cross the finish line before the recess break yesterday. We, of course, saw the passing of a continuing resolution earlier this week to try to keep the government lights on through to December. A passing yesterday of the budget blueprint, the resolution that would allow for more funding for the Pentagon related to the war with Iran, as well as aid for farmers and a few other things, including money for grants to states to enact voter ID measures. They also were able to pass the National Defense Authorization Act, something that typically happens on a bipartisan basis and indeed did in the House of Representatives. That's one chamber down. Now it becomes a question of the upper chamber, the United States Senate, Joe, which often brings with it its own set of stories and certainly its own set of procedures that sometimes make this battle a little bit more of an uphill climb.
Well, I guess this is going to be a sequencing issue here, right? John Thune wants to do this differently than Speaker Johnson did. And yes, we've seen this movie before. The idea is he wants the government to be funded before we get to any reconciliation or extra Pentagon money here. You know, I recall our conversation with Patrick McHenry yesterday, who described senators as a bunch of bulls sitting out in the sun in a field chewing grass. They are at a different pace and they approach policy differently. And we have one of those bulls with us right now. Senator Ted Budd, the Republican from North Carolina, joins us, a member of the Senate Armed Services Committee and the Select Committee on Intelligence. So we're going to have some issues to talk about here when it comes to the war in Iran. But Senator, welcome back to Bloomberg TV and radio. It's always good to see. I'm just wondering your thoughts on the approach here. Is this the responsible thing to do? Fund the government first, then deal with the extras later?
Well, thanks for the shout out. As a bull, I did grow up on a farm in North Carolina, still live there today. So
there you go.
Give them a shout out when I get back home. So look, I commend the House for what they did. Speaker Johnson is dealing with a very narrow margin. For him to get on the NDAA and get it passed in a bipartisan fashion, I think that's fine. Look, it's a very different way we look at it over here in the Senate. We want to make sure that the government is funded. We want to look at either regular appropriations rather than a reconciliation. And then let's get on to the NDAA. So we want to do all of these things as well. So I think we have a similar aims, but in a different sequence, as you pointed out earlier. But one of the things we've never seen before is the Democrats play politics with the NDAA. Usually they vote to advance it, and then we negotiate in conference between the Senate version and the House version. They didn't even vote to advance it. We've never seen this before. This just seems like they're punishing our men and women in uniform because of some policy disagreements. That's never been done before. You can have those policy disagreements, but let's make sure we're supporting our warfighters, especially in this unstable time right now. It's absolutely never been done like this, and I can't believe the Democrats are playing politics like they are this week.
Well, there were 6 members of the Democratic caucus in the House who did cross party lines to vote to advance the NDAA yesterday, Senator. But when we consider the defense authorization and the money for the Pentagon that is embedded in the budget resolution that the House also sent over, you testified or gave a statement at the same hearing that the Defense Secretary Pete Hegseth did before appropriations this week, in which he said the war already has cost $37.5 billion, and the war, as we speak, Senator, is still ongoing. By the time the Senate does get around to passing potentially this resolution or reconciliation getting across the finish line, is the price tag for the Pentagon going to need to be much higher?
Look, I'm very supportive of the point of the supplemental and making sure that we resupply our stockpile and our munitions. But let's remember that there's support in there for farmers. There's support in there for disaster in different parts of the country. Let's remember in Western North Carolina, just under 2 years ago, we had a major disaster with Hurricane Helene. So when they give us the number 0 for that, that's the wrong number. We want real support for Western North Carolina, especially if it's going to include something broader than just defense replenishment. We want to make sure that they have what they need, that the Pentagon has what it needs. But if you're going to include disaster, you make sure that you include Western North Carolina.
I want to ask you about the war in Iran, which appears to be escalating by the moment. And to that end, we're now seeing $100 a barrel oil once again, Senator. From your view on the Armed Services Committee and Intel, I'm wondering what you're hearing from the administration. Axios is reporting the president is soon to decide on a major escalation, a major assault on parts of Iran. He's threatening bridges and power plants. Is this about to intensify?
Well, the goal is to open the strait and make sure that we keep our warfighters safe and eventually bring them home. We don't want a forever war. So the president wants all options on the table. He wants the best military advice. He wants to be decisive. He's tired of playing games. Look, he was serious about negotiations and the ceasefire to use for negotiations to end this diplomatically. But the Iranians were only using it to delay and diffuse, delay things into perpetuity, which is part of their strategy. They know that they can't win, but they can succeed through delay and then operating in a diffused manner through proxies, through the Yemenis and the Houthis, or through Hamas, or through Hezbollah. So all of those are Iranian proxies. So if you cut off the head of the snake, you fix so many problems. But the president wants to end this decisively and get our troops home.
Well, and as you say, Senator, you don't want to see another forever war. So how long should the president have to try to bring this to an end? You and your colleagues voted down another war powers resolution in the Senate today, even though one did pass the House this morning. Will there come a time ever that you would cast a vote on a war powers measure? What would be the line for you?
Well, the challenge with the war powers resolution, while it may sound great on its face, and we certainly need to have those constitutional debates, the president needs every option at his disposal, especially when he's navigating very complex waters in the Middle East. Anytime you pass a war powers resolution, as we've seen pop through the House or the Senate at any particular time in the last several weeks, it weakens the president's hand, which is really putting our war fighters in danger. We want to end this quickly, and so we need to present a unified strength, or unified front and full strength, and that way we can win more quickly. Anytime they see us fractured internally, our opponents will use that to their advantage, which hurts our men and women in uniform.
You know, we're looking now at a potential double choke point, and you don't need me to tell you, as Houthi rebels attack a couple of ships headed for the Red Sea. Do people in North Carolina need to brace for higher prices? We're looking at triple-digit oil today, and gas is well above $4 on a national average. If this is another choke point, Senator, what does it mean for consumers?
Well, the goal is to get energy prices down. They were trending down under President Trump because we've basically been pro-energy. That's what puts us at this position. When you look under Joe Biden in 2022, when Russia invaded Ukraine, you saw these prices skyrocket, well over $100 a barrel, gas, $5 a gallon in some parts of the country. And that's because they were anti-energy. We're having a significant conflict in the Middle East, and yet we're $3.50, $4, and we want to get it back closer in that $2 or $3 range. But we can certainly do that because we've been pro-energy. If we allow the broader administration policies to take place, those choke points in the Middle East actually matter less. So we need to make sure that we're pro-energy for domestic production here in the U.S., and that actually makes us safer and less dependent on these Middle Eastern choke points. But I will say, there are so many allies that we have over there. We have troops in the region, even before this conflict. So we need to make sure that we defend them, and we don't let the chief state sponsor of terror metastasize and actually get a toehold again. We need to end this, and we need to do it decisively, and we need to do it quickly and bring our troops home safely.
All right, we will leave it on that note. Senator, thank you so much for joining us. The Republican representing North Carolina in the United States Senate, Ted Budd, thank you for being here on Bloomberg TV and radio. And as we reflect on our conversation with the senator and on congressional matters, we turn now to our political panelists. Jeannie Sheehan Zaino, a Bloomberg politics contributor, Democratic analyst, and democracy visiting fellow at Harvard Kennedy School's Ash Center, joins us alongside John Seaton today, a Republican strategist and founder and CEO of Echo Canyon Consulting. Welcome to you both. John, we were just hearing from the senator there that the Senate is likely going to try to do things in a different order than maybe the House or the president would desire. We may see some changes to this budget reconciliation effort, and it will be under the leadership of the majority leader, John Thune, who the White House press secretary, Caroline Leavitt, said today Trump's patience with Thune is, quote, running out, to which John Thune responded to reporters on Capitol Hill saying, well, maybe she or somebody else ought to get on the phone and get the votes. Are we about to see a real breakdown here between the White House and the Senate leadership?
I'm not so sure. I do think that there's, a little bit of saber rattling from time to time. But from what I understand, Leader Thune and the White House have a very good relationship. I mean, look, at the end of the day, you've got to be able to count to 50 and sometimes 60 when you're trying to get things through the Senate. And as much as the leader or the White House might want to get something passed, you're still kind of at the mercy of each individual senator, a lot of whom have very strong opinions, have very strong beliefs on how things need to get done. Some of them are in for very tough re-election fights, and so I do think that there may be a little bit of saber rattling. I don't think that there's going to be a full-on collapse of relations there. I think that the relationship is still pretty good.
Jeannie, you heard Ted Budd talk about the NDAA.
pointing directly to Democrats for playing politics with what we always refer to as must-pass legislation, the last bastion of bipartisan agreement. How would you respond to him?
Yeah, I think the response is pretty clear. It's that the Republicans have been weaponizing this bill. It's a hyper-partisan bill. There's poison pill amendments in it. There's culture war agenda items in it. They haven't even addressed the issue of this unauthorized war. And so this is where Democrats are ready for this fight. They want to take this fight on. And I would just note the interview you guys did yesterday with Rand Paul. I mean, they are talking about a 1.5, and I understand NDAA is not appropriation, but they're talking $1.5 trillion for defense. That is essentially going to support a war that is unauthorized and widely unpopular without any offsets at a time when our budget is closing in, our deficit rather, is closing in on $40 trillion. You add that to things about gender care, the Save America Voting Act, all of the other things that they have coupled together here. And they are the ones playing politics with this. And that's why Democrats, unlike in the past, feel confident in saying that this is not your grandfather's NDAA, Joe. I guess that's how I would put it. It's a hyper-partisan bill coming from the Republicans.
Well, and obviously coming during active wartime, John, as we mentioned with the senator, the Senate did not advance a war powers resolution today. The House did this morning, but these are all pre-August recess votes. And I wonder, once we're back from recess, it's past Labor Day, the midterms are literally around the corner, if you think this is going to be a different story.
I think an NDAA is going to pass. It might be slimmed down somewhat or a lot. And whatever your opinion of the conflict in Iran is right now, our warfighters do need to get the resources that they need to finish the job. So I do think that something will pass, and whether it's exactly what the White House wants or what House leadership wants remains to be seen. In fact, I would go so far as to say it probably will not be exactly what they want. That's part of governing. But I do think an NDAA has to pass and will pass.
How about war powers, John, just to pick up on what Haley was referring to? We get past primary season. Is it open season?
I think these are largely symbolic votes. I don't think that they're going to make much of a difference. I do think that you saw, even though it did pass the House very narrowly, Republicans are largely unified and continue to support the president, continue to support the effort in Iran. I expect the same on the Senate side as well. So I don't know that a War Powers Act will come up for a vote. And if it does, I'm not sure how much teeth it really has.
All right. We've got a lot more where this came from with our political panel. John Seaton and Jeannie Shanzano will be back as we also spend some time ahead with Brian Stile, the congressman from Wisconsin who authored the stock trading ban. And we'll be speaking as well with Senator Todd Young, the Republican from Indiana, continuing our conversation today with lawmakers after a flurry of bills are passed in the House of Representatives. Alongside Kaylee Lyons, I'm Joe Matthew. Thanks for being with us on Balance of Power. It's the Thursday edition. As we make our way through the trading session, we'll get an update as well from Charlie Pellet. The news from Iran sending oil prices back to triple digits and stocks sharply lower. This is Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story headline right off the Bloomberg. The government will begin rulemaking aimed at shoring up car door safety. Vehicles designed with flush electrically operated door handles made by Tesla and other car makers have been involved in a series of incidents in which occupants have been trapped inside their cars after accidents. Today we're looking at Tesla shares. They are down, way down after earnings. They're plunging now by almost 14%. Stocks lower, oil higher. West Texas Intermediate Crude, $92.72 a barrel, up 6.7%. Barrel of Brent has just topped $101 now, up by 7.4%. Oil higher, stocks lower. S&P down 1.2%. Tech selling off. NASDAQ 100 down 1.8% with a 10-year at 4.69%. Recapping, S&P 500 index down 1.2%. I'm Charlie Pellet, Joe and Kaylee. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet with us live from New York, and he'll have more on the markets coming up in about 20 minutes' time. We have been talking about some of the legislation that actually managed to pass the House of Representatives. It's some pretty big bills, including a stock trading ban that we haven't had a chance to invest ourselves in much this hour, but one that is extremely important to our audience. Now, House lawmakers, for the most part, are leaving town and leaving, as we just discussed with Congressman Ted Budd, a boatload of legislation in the upper chamber. One of them includes a ban on lawmakers buying stocks, along with the continuing resolution we saw passed this week and the supplemental funding bill that will become potentially law through the form of reconciliation. But we talked about the stock trading ban, something that has been debated and considered a high point of controversy in the House, not for months, but for years. With Congressman Chip Roy, the Republican from Texas, had a competing bill that actually would have required members to divest their holdings as they joined the ranks of the House. Here's what he told us.
If you have insider trading, you can go get convicted of that right now. It's about trust. It's about believing that your members of Congress are actually making decisions in their committees and on the floor that are in their interest, the people's interest, not the interest of their financial interest. You've got people who believe they've got the right to do it, right? That as a member, as a citizen, they have the right to trade stocks, that we can't limit that. I disagree. It is a privilege to serve in the United States Congress.
Well, they're not going to be able to trade stocks, or it seems buy new ones based on the law or the bill, I should say, that just passed. We'll see if it becomes a law as we spend time with its author. A familiar voice on this program, Congressman Brian Stile, the Republican from Wisconsin who chairs the House Administration Committee, joins us now. Mr. Chairman, it's great to see you. Congratulations on the bill passing the House of Representatives. What becomes of it now?
Thanks for having me back on, Joe. Excited to see the Stop Insider Trading Act pass the House yesterday with strong bipartisan support. We now look to our colleagues in the United States Senate. I've had a lot of good conversations with folks on that side of the Capitol. And I think there's actually real energy to get this done. The bill hits the target. It prevents members of Congress from buying and selling individual companies' shares of stock. The bill has real teeth. It's common sense, it's practical, and it works. I'd love to see the Senate take this up and move it. The American people understand the importance of this legislation, and I think there's a real chance, despite the fact that the Senate's got a lot on their plate, that this ultimately gets across the line.
Well, and if it does get across the line, should this effort end here, Congressman? Is just banning the buying and selling of individual stocks while in office enough, or does this need to go a step further in future legislation to include divestitures like your colleague Chip's Roy bill, or to include other branches of government like, say, the White House and the president?
Washington often makes incremental progress, but I think this is a big step forward. Yes, I do agree that there are additional reforms that we can make, in particular, not just as it relates to Congress, but executive branch employees and the judiciary as well, things that we're looking at. But we have a time and a moment right now to begin making progress. The progress the House made yesterday, the Senate should be able to pick this up and move it across. And then let's go back and continue to make progress on the reforms I think are needed to clean up Washington.
Interesting. Congressman, the Clarity Act, we'd like to hear more from you on the future of crypto here, because the narrative this morning is that this bill could be dead based on not only disagreement over the ethics language, but now there's renewed concern over what we thought was an agreement on stablecoin yield. Few people know this matter better than you.
Is clarity in risk of dying?
Sometimes it's the darkest before the dawn, and that's my hope as it relates to market structure legislation that the Senate has been struggling with for over a year. The House passed this bill now last July. Now is the time for the Senate to complete the job. I'm hopeful that a resolution is struck. The Democrats in the Senate understand the need to put regulatory clarity in the space. It's important that the United States is leading, that these technologies are not being developed offshore in locations like China, but also that there are appropriate consumer protections as the House passed clarity bill has. And so right now we're watching how the sausage gets made a little bit. There's frustrations in the Senate. They're not able to finalize the agreement. My hope is that now that there's actual text on paper released on the Senate side, the final negotiations will come. We'll actually get this done before the Senate leaves for the summer.
Well, and on the ethics provisions specifically, which sunset on inauguration day of the next president, don't include all family members of elected officials and are enforced by the DOJ, I wonder if you really think that has teeth, Congressman, or if that reads as something that the president is willing to sign off on because it may not really affect him greatly.
Well, maybe two pieces of this. One, I think that is the opening salvo over on the Senate side. I would expect that there be adjustments and reforms to that language before a final deal is struck. Again, that's this final negotiation that's taking place. And two, to the folks that think we need more regulation in this space on the ethics side, that is in many ways the point of clarity, is to provide a regulatory framework so that bad actors can be held accountable. The good actors in the broader crypto space also want to remove the bad actors. This is our real opportunity to clean up what I view as the mess that was created in large part by Gary Gensler and the Biden administration for failing to provide a functional regulatory framework in the digital asset space.
All right, Congressman, thank you so much for joining us, and congratulations again on your bill passing yesterday. We'll see what becomes of it in the Senate. Republican Congressman Brian Stile of Wisconsin here with us on Bloomberg TV and radio. Now, as we shift our focus from domestic to foreign affairs, we, of course, have a fresh threat from President Trump against Iran today, threatening to hold Iran accountable for the action of Houthi rebels after the Houthis said that they targeted two Saudi ships in the Red Sea, igniting concern around a two choke point situation for global energy markets and sending Brent crude back above $100 a barrel today. So we turn for more insight to Mona Yacoubian now, who is director and senior advisor of the Middle East program at the Center for Strategic and International Studies. Mona, when we consider, and welcome back to Balance of Power, the president continually escalating his rhetoric and threatening to escalate attacks in tandem, is Iran likely to respond, or are they willing to call the bluff?
I think Iran is likely to respond with escalation of its own. We don't see any signs that Iran is relenting in the face of increased U.S. military pressure. Quite the contrary. You note the action by the Houthis, throwing into peril now the choke point at the Bab el-Mandeb. We're seeing Iran also hit back with strikes. There's no indication at this point that Iran is going to back down.
So is this now a two-front war?
Well, it already is a two-front war if we think about Lebanon, but I think we could say, Joe, this is absolutely an expanding war, and I fear that we are really on the verge of an all-out confrontation once again that encompasses the entirety of the Middle East, but that also has enormous implications for the global economy. Again, given this potential for a double choke point blockage, which would have terrible repercussions for the global economy.
How would an all-out confrontation look different in July compared to what it looked like in March, Mona? I just wonder what realistically you think could be changed, could be more dramatic than when we saw the first round of Operation Epic Fury.
You're absolutely right. There's no question. I think a couple things are different, though. We now, as I said before, we now have the Houthis engaged, which was not the case in the earlier iteration of this conflict. We also see the Iranians striking much more intently and intensively on U.S. military targets. Note, of course, the tragic loss of 4 service members over the weekend. And we're also, I think, seeing Iran again returned to hitting critical infrastructure, and the U.S. also hitting critical infrastructure. There is a concern, I don't know that it's going to happen, but there is a concern that the U.S. could even be preparing for some kind of ground incursion. So all of those elements would differentiate what we might see in the coming days from what's already happened.
With that potential for a ground incursion that you mentioned, Mona, is that why we saw a B-1 bomber reintroduced, at least one of them, long-range bomber that can carry dozens of cruise missiles, 2,000-pound bombs? This is the first time that the bomber was used in this latest series of attacks. We're clearly preparing the ground for something here, right?
Well, yes, I think the 2,000-pound bombs, et cetera, suggests an intensified air war, which of course was the case early on. I think, Joe, what's more important to watch is where the U.S. is striking. So there's reports of the U.S. striking along the Iran-Iraq border, for an example. And that is raising questions as to whether the U.S. might be making preparation to insert special forces somewhere in Iran. Again, hard to know, and I'm wary, quite frankly, of speculating too much because we simply don't have that information.
Mona, I'd like to ask you as well about the civil nuclear deal that was signed between the U.S. and Saudi Arabia yesterday, but which President Trump now suggests today is actually going to be contingent on Saudi Arabia joining the Abraham Accords. He said it will be approved, but is subject to that Abraham Accords expansion. Does that mean all of this is likely to happen?
I think the president's latest statement adding that condition throws the deal into doubt. The Saudis have been very clear that they are not ready to normalize ties with Israel. They want to see significant progress made toward a Palestinian state. And so they are saying the deal's been signed already, and that wasn't one of the conditions. And so I think, at a minimum, we could say this deal, which has caused quite a lot of consternation, I might add, for those that are concerned about nuclear nonproliferation, I think we could say that at this point, the deal has really been thrown into question as to its actual status and what happens.
All right, Mona, thank you. It's great to have you back. Mona Yacubian, Director, Senior Advisor, Middle East Program at the Center for Strategic and International Studies. I'm pretty sure this is all going to come up in an important program that we have for you teed up for 5 p.m. Eastern Time today here on Bloomberg TV and radio with an important town hall with the candidates to be the next Secretary General of the UN. This will be moderated by Bloomberg's Romaine Bostick live from the UN in New York. And Kaylee, this is going to be a fascinating listen. I don't know the last time you and I have been able to watch TV together at 5 o'clock.
Yeah, it's going to be a nice change of pace for us. But of course, our work is not over for the day yet. We still have more of the early edition of Balance of Power coming up. We're going to go back to Capitol Hill. We'll be joined by Republican Senator Todd Young of Indiana for more on the war with Iran and the matters facing his chamber. That's straight ahead here on Bloomberg TV and radio.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. Oil pushing higher right now. Barrel of Brent taking out $101, 101.15 on Brent now, up by 7.5%. West Texas Intermediate Crude back above $92 a barrel, 92.70 now, surging 6.8%. Oil higher, stocks lower. Right now, the S&P 500 index holding just above 7,400. It is down 98 points, looking at a loss of 1.3%. Dow Industrials down 574, decline there of 1.1%. Nasdaq Composite down 576, a drop there of 2.3%. The Bloomberg Mag 7 index is down 4.7%. Last night we heard from two members. We heard from Alphabet. That stock now down 6.5%. We heard from Tesla. Tesla now down by 14.3%. The 10-year, 4.69%. The 2-year, 4.35%. And the 30-year, 5.17%. The VIX, by the way, above 19 now. Spot gold down 2.1%, 4,042 the ounce. And again, crude WTI bears repeating, up 6.9%. Barrel of Brent 101.29, up by 7.7%. Our Eric Weiner will have a whole lot more on the markets coming up for you in just a moment. In terms of earnings, American Airlines cutting its 2026 guidance for the second time in 3 months. Higher fuel prices will do that. We've got American now down by 9.6%. Tough day for airline names. United down 3.2%. Delta down 2.6%. And right now we've got Southwest lower by 5.2%. For the first time in 10 years, the United Nations is set for a leadership change. Join us at 5 o'clock Wall Street time for a special town hall with candidates seeking to become the next UN Secretary General. I'm Charlie Pellet. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie, we're going to have a viewing party down here at the D.C. Bureau. You should join us. It's going to be something else. 5 p.m. Eastern, we will all be watching with some important debate and analysis here on Bloomberg TV, as always, as you would expect. Interesting what is up today, as Charlie just made clear, it's interest rates and oil, and that has everything to do with what's taking place in Iran and what may be about to take place. Because you could argue that this is a market that has been whistling past the graveyard, with the President of the United States now threatening further escalation now that the Houthi rebels are involved, attacking 2 ships in the Red Sea. We talked about this with Bob McNally from Rapidan Energy, who sees the potential for much higher prices for oil and distillates. Here's what he said.
There's enormous optimism in the price. One of the distinctive features of this whole thing has been an entrenched optimism among traders. Look at equities, haven't even looked back since early April. And I think that optimism is unwarranted. And I think that bubble could burst. And if so, we are going to reprice much higher, I'm afraid.
All right, let's get to what's happening in the markets right now with Eric Weiner, who joins us live from New York, senior editor for Equities. Eric, it's great to have you back. Is this as simple as Iran sends bonds lower, interest rates higher, oil prices higher, and unfortunately stocks lower?
And one other thing, AI spending. So what you're seeing, this is a
Throw
huge
Alphabet in the mix.
Yeah, and this is a huge big tech sell-off. That's really what's driving all of this. Last night, Alphabet came out and said it's going to spend like $200 billion this year on AI. And the big change is that used to be considered good news. The idea that companies were spending on AI would send their stocks up. In the last, it started happening in the first quarter, but really in the last couple of months, they are getting punished. And we are seeing it. And a lot of, you can't take that away from what's going on in Iran and what's going on with oil prices, because if growth weakens and if inflation is sticky, which are the two things that happen with war, then this whole thing does have to get repriced. And the ability to keep spending on AI, the ability for that to be the pillar of growth for the economy, really starts to look wobbly. And that's what we're seeing today.
Well, yeah, as you consider companies wanting to spend more capital and higher oil prices risking higher rates and therefore a higher price, a higher cost of capital. Eric, so maybe these stories can't be completely unwound from each other, but if it really is also in part a tech-driven market, what other earnings should we be looking forward to, whether it's after the bell today or over the course of the next week, to potentially be catalyst? Do we expect it's going to be a very similar story where it's really the CapEx number, not EPS or revenue or anything else that the market's watching for?
It's not just the CapEx number, it's the CapEx outlook. But yes, so next week we've got Meta, we've got Amazon, we've got Microsoft. All of the big spenders come next week. So that's really, it used to be that NVIDIA was the one we need to watch, and that's usually towards the end of earnings season. But right now, it's the capital expenditures. And the other thing about rates is if these stocks fall, the ability for them to raise money by issuing more stock becomes less. So then they have to go into the debt market, and those rates are not looking great. So it just becomes much, much more expensive to do what they were planning to do at the very beginning of the year.
Indeed. All right, Eric Weiner covering the equity markets for us. He's our senior editor for equities at Bloomberg, joining us from New York. Thank you so much. And as Eric was just running us through, a lot of this could ultimately come down to the outlook for rates, inflation, and how that is driven by the price of oil, which, as we've told you, is north of $100 a barrel for Brent crude once again today. A lot of that having to do with the ongoing difficulty around the Strait of Hormuz and now potentially with the Red Sea. We heard from President Trump about Hormuz in particular and how much the U.S. should care about that waterway yesterday as he spoke in Georgia.
We don't need the Hormuz Strait, but we do it because we have to do it, because we cannot let Iran have a nuclear weapon. They're getting hit so hard, and they want to make a deal. But I say they're not ready to make a deal, because every time they make a deal, they want to change it and everything. They're not ready. They'll be ready very soon.
So for more, we go back now live to Capitol Hill, where we're joined by Republican Senator Todd Young of Indiana, who is a member of the Senate Select Committee on Intelligence. Senator, welcome back to Bloomberg TV and radio. We heard the president there talking about the Strait of Hormuz, but it seems no longer to just be about the Strait, but also about the Red Sea in the aftermath of the attack Houthis say they conducted on 2 Saudi ships yesterday. The president is now threatening to hold Iran accountable for any such Houthi attacks. But if this has indeed spread to a second waterway, if the front is widening, how much more difficult is it going to be for the United States military to maintain control?
Well, it is going to be more challenging, Kaylee. It does look like the Houthi movement, which is affiliated with and a franchise of this regime in Tehran, looks like they are complicating efforts to deliver oil and other supplies through the Red Sea by closing off the Bab el-Mandab Strait, which is another choke point in addition to the Strait of Hormuz. So this is why the president believes that we, of course, need to get more leverage and then get the Iranians back to the table for a negotiated settlement. But as they have proven time and time again, they're not feeling the heat enough. And so, unfortunately, it's going to require the threat of more military force, perhaps more military force. It's the president's job to make the case that we need to do that and to lay out a more clear strategy on a going forward basis. But the number one goal of this conflict we can't lose sight of, and that is to secure the nuclear materials, remove them if possible, and then establish a verifiable enforcement regime for whatever political settlement might ultimately be agreed upon. Looks like we're a long way away, and there is going to be elevated prices that flow throughout our economy on account of the heightened energy prices and lingering uncertainty, and that, of course, is something we're feeling at home.
Yeah, we're seeing American Airlines shares now down 10% on this jump in oil prices alone, Senator. It's good to have you, and we remind our audience that you are a captain in the United States Marine Corps, a graduate of the Naval Academy, and I'm wondering your thoughts on the targeting selection and the fact that we used a B-1 bomber apparently last evening for the first time since the resumption of hostilities. What are we planning for here, Senator, if not the potential for a ground incursion?
Well, again, I don't believe that the president has made a decision on that. As he makes that sort of decision, one would hope he'd let members of Congress know and make the case to the American people. But The use of a B1 platform typically involves both operational needs, but also psychological. If we can get into the minds of the IRGC leadership, which is really, by so many accounts, really in charge of the country, but also to the dear leader's mind, then perhaps we can get them back to the table and change their risk calculus as it relates to coming up with a negotiated settlement. So that's what I make of both an operational and what we call in the military a PSYOPs decision to employ the B1.
Well, obviously, there's the kind of tactical military pressure that the U.S. is trying to apply on Iran. There's the question of economic pressure as well. And President Trump has pushed for sanctions and secondary tariffs being able to be applied to buyers of Russian oil to be included in the sanctions bill that was intended to be targeted toward Russia, authored by your late colleague, Senator Lindsey Graham, which I know you signed on to as a co-sponsor. Punchbowl News reported today that your majority leader, John Thune, says Iran sanctions have been attached to the Russia sanctions bill. Do you support that? Does it complicate its passage?
I don't think it does complicate its passage significantly. I sure hope not. I think even if some of my Democratic colleagues oppose continuing to use military force to accomplish our ultimate objective here vis-a-vis Iran, they still should continue to favor economic sanctions. In fact, one would argue that in the absence of this military force, you'd even need more economic sanctions to bring this regime into a position of better behavior. So I think the addition of that to the Ukraine sanctions, the Russia sanctions in the Ukraine context should be a sweetener as opposed to anything that would undermine its appeal to my Democratic colleagues. But with that said, it's a political season, and I know that electoral politics play into these decisions a lot, unfortunately. So let's see if we can get it passed.
Well, the NDAA is making its way to the Senate right now, and that was actually in question until that passed the House. Your SHIPS Act, bill to promote domestic shipbuilding, made it through as part of the NDAA. What will be its fate in the Senate?
Well, I believe the SHIPS Act will ultimately pass. Two-thirds of this legislation found its way into the National Defense Bill. We have already a strategy teased out to get the additional third done, but the National Defense Bill broadly has been a bipartisan piece of legislation among for a number of years now, and I think that ultimately, perhaps not until after the election, we'll see this version of the NDAA being signed into law, and the ships component of it is really essential. I mean, the fact that we built just one ocean-going vessel in this country last year, and China has the capacity in a given year to build over 1,000, is an acute national security situation. I've laid out the case for this multiple times, but blessedly, this happens to be the sort of issue where the solution is appealing to most Americans. Not only do we have an opportunity to remedy the defects of our sea power, but we can put a lot of manufacturing workers to work, earning good wages throughout the industrial Midwest, building vessels, and so it's really appealing at home as well. So we will be making American ships again. I think in short order, working with the South Koreans, the Japanese, and others to relearn this discipline, but also to crowd in private capital as we implement this bill.
Well, so we'll see the timing around that and the wider NDAA passing in the Senate.
There's
also the questions of the continuing.
Here. We're dealing with your
All right, well, we'll leave it there. We thank Senator Todd Young for his time. We were running out of time anyway. The Republican from Indiana joining us. So great to have him back on Bloomberg TV and radio. I was going to ask him about the other many matters that the Senate's now going to have before it, not just the NDAA, but a continuing resolution to fund the government beyond the election, a budget resolution to provide more money to the Pentagon and farmers, and even provide grants to states for election integrity purposes the president has been pushing for, and a congressional stock trading ban. It's not clear if any of those things are going to get done with the next, week and change before the Senate breaks for its August recess?
This is why we might be waiting, or the Pentagon more specifically be waiting for the supplemental money that is requested for operations in Iran. John Thune wants to do government funding and a continuing resolution first. But we've been told from Pete Hegseth and the top brass that they need that money now, that this will be an urgent matter by the time this gets to the Senate.
Of course, a number of Democrats, including Senator Alyssa Slotkin, who you both spoke with yesterday, suggested there is money there for the Pentagon to access. They just
need the big, beautiful bill.
Decide to do it.
We'll figure this out one of these days. Make sure you're tuning in 5 p.m. Eastern for Romaine, live from the UN and the town hall for the next UN Secretary General.
This is Blue.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg